Hi guys, welcome to BCCA. This is Ravi Teja and I am your faculty for corporate financial reporting at CMA final level. The image which I am using on the screen is CA Talapati Vijay sir. You have to take inspiration from him because nowadays if you observe, every person is thinking about this person. This person, his of course his movie journey and acting is next level, but his political journey is something which we have to draw inspiration from. So I just want to take some inspiration from him, and I have decided to name my revision marathon series as Beast Mode Revision Marathon. Last time it is CMA Final CFR Endgame Marathon, but this time it is Beast Mode Revision Marathon. If you are a first attempt student, you have to give your 100% just like how this person CM Vijay sir have given. Even if you are a repeater, you have to do that much hard work which this person have did in order to become this much. Guys, he's sensation. Correct. So coming to the marathon, this is not a separate recorded video, guys. So the recent exam oriented batch which I have taken at Hyderabad, I have recorded, I have uploaded all the recordings. This will be released in part A and part B. In part A, what I have decided is all the standards have been summarized. This time, short, crisp, more useful. So 16, 36, 102, 38, 23, 21, 108, 116. Everything will be summarized in part number A. For 113, since I have released a separate one-shot revision, you cannot, it is not covered here. So for 113, you can aram se check that one-shot revision cutting. And 115, it is not possible for me to cover in exam-oriented batch. So what I have did is, or you can watch the previous marathon for the time being, or in future, I will be uploading one-shot revision also for that chapter. Okay, so part A, all the specific Indian accounting standards are covered. When it comes to part number B, there I will be covering financial instruments, NBFC. 103 brilliant summary I have once again did in part B. One short revision is also there for this brilliant summary of 103 concepts. And coming to another set of chapters like CFS, theory chapters, MCQs. You have to refer to previous marathons only, guys, because those are only next level. CFS, theory chapters, MCQs, you have to refer to previous marathons. 110 also one short revision already I have released. Correct? Yes, sir. So the only thing which I have not covered in this marathon is valuation of shares and goodwill. For that, you can refer to previous marathon. And one more thing I have forgot to mention, which is nothing but economic value added and market value added. If time permits, I will be even releasing a separate one-shot revision video for this chapter also. Okay, so with that notion, this marathon has come up at next level, guys. So I wish you to watch all these questions, all these chapters, and super 75 questions also maximum I have covered in this marathon only. So you just have to properly watch this marathon, and if any question I have left, that question though you have to solve in this super 75 questions. Okay, so I think that's it, guys. This is a little intro about the, what should I say, Evo batch which is being uploaded. So part A will be released today only. The moment it is uploaded, it will be released the same day, and part B will be released just 2 days later. Okay. So with this notion, let us start the video. Thank you so much. Okay. So good morning, everyone. In last class, what standards we have covered? In last class, we have covered leases. 38 also we have covered intangible assets. Share-based payments also we have covered. And two standards also, small standards, 21 foreign exchange also we have covered. Okay. So that's it. So online students, please confirm is the audio fine? If yes, we will start with new chapter, financial instruments. From this also compulsory 7 marks is expected. Limited chapter. Coverage is very limited. Okay. Yeah. So we will cover this nicely. So first of all, before starting the chapter only, I am saying financial instruments, CA final also this chapter is there. Basically, this chapter consists of 3 standards, which are very in-depth. So approximately 40 plus hours will be taken to understand this financial instruments chapter. But coming to CMA final level, the coverage itself is very limited. So what we have to do, we will cover all the concepts and all the concepts in this chapter from our study material. Plus not only that, past exam questions also I have covered. Plus your institute have released something which is called as workbook questions. So those workbook questions also, 2 questions I feel those 2 are important. So those two questions also I will discuss in this financial instruments chapter. Okay, fine. So coming to the concept book, page number 83, financial instruments chapter is started. So let us quickly understand this. Okay, so first let us understand the meaning of financial instruments. Financial instrument means it is nothing but a contract which creates financial asset for one entity, and for another entity it should create a financial liability or equity. Okay, I will explain with the help of some examples, but for the time being just understand financial asset means contractual right to receive the cash. If you are having any contractual right to receive the cash, that is called as your financial asset. Okay. Similarly, in last class also, I have explained you the definition of financial liability. Financial liability means contractual obligation to pay the cash. Contractual obligation to pay the cash. If you observe these two things carefully, financial asset is nothing but contractual right to receive the cash. Liability is nothing but contractual obligation to pay the cash. For example, Mr. X is there. Mr. X have made an investment. Let us assume in Geo Limited. This person have purchased some debentures. This person have invested in 10% debentures, whose worth is 10 lakh rupees. Okay, Mr. A have purchased 10 lakh rupees worth 10% debentures in Geo Limited. Now you have to tell me, sir, what is the journal entry which this Mr. A will pass in his books of accounts? What? Investment in 10% debentures. Correct? Investment in debentures. You can say debentures account debit also, totally fine. But the correct wording is investment in 10% debentures to bank he have to write. Correct? Sir, from this investment in 10% debentures, Mr. A is having contractual right to receive coupon amount also he will receive. Along with this coupon amount, he will also receive redemption amount also, which means principal amount also he will receive. Which means what? I can say that this investment in 10% debentures is nothing but a contractual right to receive the cash for this Mr. A. Therefore, this investment will be treated as financial asset for Mr. A. That's it. For Geo Limited, if you observe, sir, what is the journal entry which this Geo Limited will pass? Obviously, Geo Limited will pass bank account debit to 10% debentures account. It will pass this entry. Sir, for Geo Limited point of view, if you observe, this 10% debentures is nothing but a liability. Geo Limited is having a contractual obligation to pay the cash flows. Correct? It can be coupon also. It can be principal amount also. Which means what? For Mr. A, the same instrument is a financial asset. For Geo Limited, the same instrument is what? A financial liability. This is only nothing but financial instruments concept. Financial instruments chapter is nothing but for one entity, it should be a financial asset. For another entity, what? It should be a financial liability. or it can be equity also. Sir, what is the meaning of equity? Let us understand. Instead of debentures, assume this person have purchased equity shares. Instead of debentures, this person have purchased equity shares. In Mr. A books of accounts, he will pass entry investment in equity shares account debit to bank. Investment in equity shares also is like a financial asset only, because from that equity shares, that person will be receiving dividend. And if the company is going into liquidation, the person also may receive capital amount also, which means what? Investment in equity shares is also a financial asset for Mr. A. But if you observe Geo Limited books of accounts, that amount is not financial liability. That amount will be equity share capital for this Geo Limited, which means what? For one entity, it will be a financial asset, and for another entity, it can be either equity or it can be financial liability. This is the concept of financial instruments chapter. Okay. So if you take more examples, I can give other examples also. For example, debtor. In your books of accounts, if you are having a debtor balance of 1 lakh rupees, I can say that I am having a right to receive cash from the debtor, correct? So this debtor will become financial asset. Similarly, loan given. Assume I have given loan given to any person. I have given loan to any other person, which means what? I am having a right to receive the cash. This loan given is also treated as financial asset. Tell me prepaid expenses. What is the meaning of prepaid expenses? Already you have paid something. Maybe in future you will receive goods or you will receive services. Will you receive cash in prepaid expenses? If you won't receive cash, that is not a financial asset. It is not a financial asset, because in future I will be receiving services or goods, but not cash. Therefore, prepaid expenses is not a financial asset. Important definition. And one more thing, income tax refund. If you observe, I have paid some excess tax, so income tax have to refund me that income tax. Sir, in refund, which means I will get cash only, but it is not contractual right, because me and income tax department have not entered into any contract. That is legal right. Therefore, IT refund is also not a contractual right, and it is also not a financial asset. Okay, important definitions we are covering. So fine. If you observe the definition of financial asset, just highlight, understand whatever the definitions which I have covered. These three, if you understood, more than sufficient. Other 3 points, whatever they have given, they are more in relation to derivatives concept. So that much in-depth is not there in our syllabus. That's what I'm saying. Our syllabus is having very limited coverage. So try to focus only on these 3 important areas only. If you are having cash, that is always your financial asset. If you are making any investment in equity shares, that is also always said as a financial asset. And if you are having any contractual right to receive the cash or any another financial asset, here cash is printed 2 times, so you can strike off 1 time. Contractual right to receive the cash or another financial asset. This is the definition of financial asset. Okay, simple thing. Now, I will directly start with accounting treatment. Sir, how to do the accounting treatment for this financial asset? Let us understand. Classification of financial assets is very, very important. For the purpose of exam, they will focus on this aspects only. More than financial assets, financial liability is important. So high chances they will ask financial liability, but in order to understand financial liability, we have to understand financial asset accounting. Sir, what we have to do is very, very simple. Financial assets are classified into 3 categories. First one, amortized cost method. Amortized cost method. Second one, FVTOCI. Third one, FVTPL. 3 categories financial assets are categorized. What is the first category? Amortized cost method. Second category, FVTOCI. Third category, FVTPL. What is the full form of FVTOCI? Fair value through other comprehensive income. Very good. FVTPL means fair value through profit and loss account. Very simple. These 2 are very, very easy. In the question, they will also give you fair value. What you have to do is you have to measure your instrument at fair value. If it is OCI, difference will be transferred to OCI. If it is P&L, difference will be transferred to P&L account. So the most important discussion is this amortized cost method only. In this amortized cost method, I will be calculating something which is called as effective interest rate. What I have to calculate? I have to calculate something which is called as effective interest rate. Effective interest rate is nothing but IRR. IRR in your SFM, how you are calculating, in the same manner, we have to calculate something which is called as effective interest rate in this amortized cost method. Sir, how to calculate that effective interest rate? I think you all know something which is called as interpolation. Interpolation is there in your SFM. I will take trial and error. 2 discounting rates I will take. My interest will be lying in between that. Like that same process we have to follow for this IRR calculation. Maximum cases they will give in the question. Effective interest rate. Very less cases, some 1% or 0.1% cases, you have to find out the effective interest rate. But that is very simple. Okay. Now the question is, sir, when we have to classify an asset under amortized cost method, when to classify an asset under FVTOCI and when to classify an asset under FVTPL. It is not whatever you want. You cannot choose whatever you wish. They will prescribe some conditions. Based on the satisfaction of those conditions, I have to classify whether it is an amortized cost, whether it is an FVTOCI or FVTPL. Okay. How to classify also, let us understand very quickly. So check this. First of all, investment in debt instruments, bonds, loans given. For these assets, we have to follow these items. Sir, what about equity shares? Equity shares I have explained here. Okay, most importantly, equity shares and debt instruments only they are going to ask. But the two first let us understand debt instruments or bonds or loans given. In this case, 3 methods are possible: amortized cost, FVTOCI, FVTPL. First of all, sir, I will select this amortized cost method based on 2 tests. First test is a business model test. What is the first test? Business model test. Second test is a contractual cash flow characteristic test. How many tests are there? 2 tests are there. So, very good. First one is business model. Second one is a contractual cash flow characteristic test. Sir, what is the meaning of business model test? Means you have to understand your objective of purchasing any financial asset. For example, if you are purchasing investment in debentures, you have to check your objective. If your objective is to hold that asset till maturity, for example, if the maturity is 5 years, you don't have any intention to sell that asset within the 5 years. If your intention is that, plus your objective is to collect the contractual cash flows. Sir, contractual cash flows is nothing but interest as well as principal. If your objective at the time of purchasing is only to get the principal and interest, and that too your objective is not to sell in the meanwhile, your objective is to hold it till maturity, then business model test is satisfied. Second test you have to check, contractual cash flow characteristic test. Sir, contractual cash flow characteristic test means I should get only principal and interest. That's it. I should only get principal and interest. Dates are also decided. Dates are also decided, which means fixed amount of cash flows, and moreover, dates are also decided. Specified dates, specified amounts, and it should consist of only what cash flows? Principal and interest. If you observe most of the debt instruments, for example, debentures, bonds, etc., many of those will fall in this amortized cost method categories only, because 99% they will hold till maturity and they will receive the cash flows. At the same time, they will only receive principal as well as interest. Therefore, 95% instruments will be classified under this amortized cost method only. Now, we may get a doubt, sir, when we have to classify under this FVTOCI. Contractual cash flow characteristic test is exactly same as above, which means you should get only principal and interest. But business model test will change. Sir, there the business model test is holding till maturity. Here our objective is not to hold it till maturity. Okay, here our objective is very simple. My objective is without holding till maturity, I can sell, but I will receive contractual cash flows. Okay, simple classification, sir. What they will say? See, first of all, I have purchased debentures, for example, at 50 lakh rupees. What have happened is the price of the debentures is increased. The price of the debentures is increased. Let us assume it is increased to 60 lakhs. Tenure is 5 years, but after completion of 3 years, suddenly the price of the debentures increases. So what I have decided? I have decided to sell this debentures. Which means my objective is not to hold till maturity. If price increases, I will sell. If that is my intention, then I have to classify under FVTOCI. Very simple. Contractual cash flow exactly same. Sir, then what will be classified under FVTPL? Very, very simple. Anything which is not FVTOCI or ACM. See, first of all, FVTOCI business model test, till you are selling that asset, if you are receiving cash flows, this is satisfied. Sir, but what when it comes to FVTPL, for example, very short-term investments, if you observe, very short-term investments like derivatives, etc. These derivatives, even without receiving the cash flows, sometimes they will sell. Even without receiving the cash flows, they will book very short-term profits or losses. Therefore, the standard is saying, okay, if your objective is very short-term, without even receiving the cash flows, if your intention is to sell, then you have to classify this FVTPL. Okay, that's it. That is more than sufficient. What we have to remember. 3 methods are there. What are those 3 methods? Tell me. Amortized cost. Second, FVTOCI. Third, FVTPL. Sir, which test we have to check? How many tests we have to check? 2 tests. What is the first one? Business model. Second, contractual cash flow characteristic test. Amortized cost method business model test is holding till maturity by receiving the cash flows. FVTOCI without till maturity by receiving the cash flows. FVTPL something which is not both. Something which is not ACM or FVTOCI. This is the concept of debt instruments, bonds, loans. So when it comes to investment in equity, observe, if you observe amortized cost, it is not possible. Because, see, if I am investing in equity, first of all, I will hold till maturity. That is different point. But CCFT test, if you observe, there is no possibility, there is no compulsion that I have to receive the cash flows. Correct? If the company is earning profits, it may pay me dividend. At the time of liquidation, if the company is having funds, it will pay me redemption, which means I'm not having any right to receive the cash. Therefore, ACM is not possible for equity shares. ACM is not possible for equity shares. 2 methods are possible. What are those 2 methods? FVTOCI and last one, FVTPL. If you observe carefully, by default, equity instruments are classified under FVTPL. By default, if nothing is said, I will select this FVTPL only. But in the question, if they have given these kind of hints, long-term investments or strategic investments, if you are making investment in these, standard is giving a choice, but that choice is irrevocable, which means you cannot reverse in the future. Once you have selected, you have to continue that choice only. For such instruments, for these instruments, they have given a choice of FVTOCI. And one more thing, investment in equity shares, if it is classified as FVTOCI, it is a non-reclassified item. It is which item? Non-reclassified item, which means if I further sell this asset, OCI balance should not be transferred to P&L account. OCI balance should be transferred to retained earnings or other equity, just similar to revaluation reserve, what we have discussed in PPE standard. If you sell that asset, any OCI balance, I will not transfer to P&L account because it is not a reclassified. It is not a reclassifiable item. Therefore, same logic applies here also. But this is investment in equity, not debt. Okay, investment in equity shares classified as FVTOCI is a non-reclassified item. So copy this point in your book. Investment in equity shares classified as FVTOCI is a not reclassified item. Copied. Okay. Now, most important concept is this accounting part. Very, very important. So check this. Accounting will be initially recognized at a cost. Initially recognized at cost. Whether it is PPE also, I will recognize at cost. Even if it is financial asset, my first recognition will be at a cost. But most important point you have to understand is this transaction cost. Transaction cost, here I have given the treatment. You have to remember this, very, very important. In questions, they are compulsorily testing this point. If any financial asset is classified as FVTPL, financial asset, we are having three methods, correct? If you have selected FVTPL, what they are saying, transaction cost like brokerage, etc., will be expensed off in P&L account. See, while purchasing any debentures, for example, if I am taking in, for example, stock exchanges or something, I have to encourage some brokerage or commission I have to pay. Those costs, if I have selected FVTPL, I have to transfer to which account? P&L account. Will not capitalize. But if it is classified as ACM or FVT OCI, what they are saying, they will be included in the cost of the financial asset. Most important, I will give an example, so we have to understand with the help of that. See, I have purchased 10% debentures of 1 lakh rupees. 10% debentures of 1 lakh rupees I have purchased. Along with this, I have also incurred 1000 rupees brokerage also. 1000 rupees brokerage also I have incurred. So tell me, what is the total cost? 1 lakh 1000. If I have selected this instrument as amortized cost method, if I have selected this instrument as amortized cost method, I will include this 1000 also in the cost of financial asset only, which means I will capitalize this 1000. Tell me, sir, how much amount I have to make payment? I will make payment of 1 lakh 1000. So, sir, what is the journal entry which I have to pass? This is investment. So, I will write investment in 10% debentures account debit. To what I have to write? To bank I will write. Sir, how much amount I am making the payment? 1 lakh 1000 I am making the payment. Actually, my debentures value is 1 lakh only. Plus, since it is ACM, I will also capitalize what? 1000 also, which means total investment in 10% debentures will be how much? 1 lakh 1000. This is in which method? Amortized cost method. Sir, even if it is FVT OCI also, I will follow the same treatment. I will follow the same treatment. Sir, but what if it is FVTPL? If it is FVTPL, transaction cost will be transferred to P&L account only. Whether it is FVTPL or not, my payment amount will be same. I have to pay this much only. Correct? Which means I will write to bank. Payment amount will not change. To bank 1 lakh 1000. But investment amount will change. Very good. Here, investment in 10% debentures account debit, I will write only 1 lakh. Sir, but entry will not match. Correct? How much is the difference? That 1000 will be transferred to P&L account. Most important, we have to understand this. Transaction cost in case of financial asset will be capitalized. In case of financial asset will be capitalized. In case of which methods? Amortized cost, FVTOCI. If it is FVTPL, it should be expensed off in P&L account. Okay, questions are there. We will understand through that questions also. Don't worry. This is very, very important thing. Now, second part. Sir, okay, initial recognition is same for all the methods. Initial recognition is same for all the methods, but this point we have to understand. Transaction cost related treatment. But one more thing, sir, subsequent recognition means at every reporting period, what I have to do. At each reporting period, which means at every year end, what I have to do is, again, that depends upon which method you are choosing. For example, if you have selected FVT OCI, the name is only saying, I will measure my instrument at fair value. Difference will be transferred to which account? OCI account. Very simple. I will give some examples. You have to tell me the correct answer. See, I have purchased for 1 lakh 1000. But end of the year, its value is increased to 1 lakh 5000. That's it. 4000 rupees will be transferred to which account? OCI account. Can you tell me the journal entry? Asset account debit to OCI, because investment value have increased, therefore I have to increase that value to 4000. OCI amount also I have to transfer 4000 only. Reverse also can happen. Reverse also can happen, which means instead of 1 lakh 5000, assume it is 98,000. Assume it is 98,000. How much is the difference? 3,000. Is it upward increase or is it downward? So what is the entry? Very good. OCI account debit to asset account. That much simple it is. Okay. Investment in debt instruments. If you are choosing FVT OCI, simply I will measure fair value. Difference will be transferred to OCI account. Sir, what if it is P&L account? Difference will be transferred. Sorry, what if it is FVTPL? Difference will be transferred to P&L account. Okay, that's it. No more complications. Based on the method you are choosing, we have to decide the accounting method as accounting purpose. Okay, and next. This is most important. Amortized cost method. So what we have to do for this ACM? First, what they have given, read the first step. Step number 1 will be initial recognition will be made at what cost. Transaction cost will be included in the cost of the financial asset. This point already we have known. Correct? We have to capitalize. Second step what? Effective interest rate in brackets, right? It is IRR. Effective interest rate means we have to calculate IRR. Third step, what we have to book? Recognize financial income for each reporting period based on what? Amortization table, which means you have to prepare something which is called as amortization table. Year, opening balance, finance income, amount if you are receiving anything, cash flows received, last you will get closing balance. Based on that, I have to recognize financial income, but based on effective interest rate. Okay, this is the important thing which you have to focus. Step number 1, 2, and 3, very, very important. Maximum cases, they will give in the question, effective interest rate. If they have not given, then only we have to calculate. Okay, simple. Financial liability also let us understand a little bit. Financial liability is nothing but exact opposite of financial asset. Financial asset means contractual right to receive the cash. Therefore, financial liability means what? Contractual obligation to pay the cash. And one more thing, there is difference between equity share capital and financial liability. Equity means it includes equity share capital as well as other equity. But the thing is, we all know that financial liability and equity share capital both are different. But from standard perspective, they will say like this, sir, why this equity share capital is not a financial liability means if I am an equity shareholder, I don't have any right to compulsorily receive the dividend. At the same time, I don't have any right to compulsorily receive the capital also. Correct? Therefore, it is not a financial asset for the shareholder. Even from the company point of view also, company is not liable to pay dividend to the shareholder. In case of equity, it is not mandatory. At the same time, capital also, company is not having any obligation. Therefore, it is not a financial liability. Okay, simple. These points are not required. Derivative points you can simply ignore. Third point and fourth point not relevant for our exam. But third point, fourth point we can ignore. But this concept is important, which is concept number 6, classification of financial liability. Classification of financial liability. Here what will happen is two methods will be continued. First one, amortized cost. Second one, FVTPL. First one, amortized cost. Second one, FVTPL. FVTPL, brackets I have written, derivatives, financial guarantee. FVTPL. Derivatives, no questions are there. But this financial guarantee, in our study material, there is no question. Previous exam also there is no questions. But workbook, suddenly they have included one question. So we will cover that workbook question, whatever is there with respect to financial guarantee. Amortized cost method is very common thing. So that same test we have to follow. Business model test and contractual cash flow test, exactly we have to follow. But reverse we have to follow. Contractual rights you will get in financial asset. In financial liability, you are having contractual obligations to pay. Okay, simple. This is more than sufficient. So now what we'll be doing is, let us quickly try to solve any question we can solve or what. Okay, so check this. We will check this question number 2. Question number 2. Question number 2, page 173. 173. So carefully let us understand. This question seems little bit small question, but definitely they can ask for 7 marks. Content is there in this question, but the length of the question is very small. Okay, but this is very important. Multiple standards are included in this question, so very, very important. Let us cover this. What they are saying is X Limited granted a loan to Y Limited amounting to how much? 40 lakh rupees, repayable in 2 years. X Limited initially gave a loan of how much? 40 lakhs. But repayment terms are you have to repay in 2 years, but how much amount you have to pay? 46 lakhs you have to pay. See, if you check, they have not given any instrument, they have not given any interest amount. They have not given any interest amount. See, but if I am paying 40 lakhs right now, and if I am receiving 46 lakh, obviously some interest component will be there. But they are not directly saying, but interest component will be there. Okay. If I say directly 6 lakh, which means I don't know time value of money. Correct? I cannot say directly 6 lakh. Therefore, we have to do something calculations. So what they are saying, let us try to understand. See here what they have given. Effective annual interest rate for that loan is how much? 6% per annum. This 6% I will use for discounting purposes. This 6% is the effective interest rate. If they have not given, I have to find out the effective interest rate. Okay, but our institute have given that part. But read this. However, due to an economic recession after 1 year, which means 1 year is completed, which means I have to get my amount after completion of next year. But what they are saying, okay, after completion of 1 year, the repayable amount has revised at 44. Initially it was 46, but now situation is not that much good. Therefore, the company is asking to change these terms. The company is saying, okay, after completion of 1 more year, you don't need to pay me 46 lakhs. It is sufficient if you make the payment of 44 lakh. Like this, the company is saying. The loan processing cost was 2 lakh rupees. Sir, what is the meaning of loan processing cost? It is nothing but transaction cost. Bank charges, but it is nothing but what? Transaction charges. What they are saying is X Limited accountant is asking us. X Limited accountant means, tell me for X Limited, is it a financial asset or a financial liability? For X, it is an asset. Because X have given loan to Y. Correct? For X, it is what? Financial asset. Right to receive the cash. Sir, it is financial asset. It is financial asset. Plus, if you observe this part, here I am not having an intention to sell this till maturity and all. If nothing is given, financial assets, we will always assume it as amortized cost method only. Don't make more complications and try to treat that as FVTPL, FVT, Here no fair values are given, nothing we can do. Therefore, most in default, I have to assume financial assets as amortized cost method only. Specified time everything will be there. But if nothing is said also, we will assume at amortized cost method only. Okay. So first thing, what they are saying. X Limited accountant have decided to do this. Read this. X Limited accountant is asking us to charge the processing cost to the P&L account. Is it correct or not? Why it is no? Very good. It is amortized cost method. If it is amortized cost method, will I capitalize the transaction cost or do I have to charge that to P&L account? I will capitalize. Correct? Now you have to tell me, sir, I have given loan of 40 lakhs. I have given the loan of 40 lakhs. Plus I have to capitalize this 2 lakhs also. So can you tell me what is my initial recognition amount? Very good. Initial recognition amount is 42 lakhs. Correct? So let me show you the solution also. Initial recognition amount is 42 lakhs. So check this. Initially, it will pass this entry, financial asset account debit to bank account 42. Correct? Sir, now what will happen? I have to prepare something which is called as amortization schedule. Amortization schedule, I will have the following columns here. Opening balance. This is my financial asset. Therefore, I have to recognize finance income, not cost. If it is liability, I have to recognize financial cost. Since it is financial asset, I have to recognize financial income. Correct? Sir, asset is 42. Have to give an effective interest rate in the question. 42 into 6%. 42 into 6%. Enter 2.52. This is financial income. My asset have to increase. Therefore, the entry I have to pass this. Financial asset account debit to finance income I have to charge. Correct? See, if it is liability, what is the entry I will pass? Finance cost account debit to financial liability. Just opposite, it is asset. So I have to recognize income. My asset balance also will increase. Now tell me, initially I have recognized this much. Now I am increased it to 2.52. Can you tell me what is my net value? Carrying amount. At the end of year 1, it is how much? 44.52 it should be there. Okay. For example, let us assume nothing is changed. This they are saying something due to economic recession and all 44 lakh is only receiving. They are saying, let us assume it is not there. Do 44.52 into 6% once again. 44.52 into 6% plus 44.52 plus 44.52. Approximately you have got some 47 something you have got, which means if this recession is not happened, the company may receive that much amount. But the question is also saying directly, they are saying economic recession is there, correct? Because of economic recession, how much amount they are expected to receive? They are expected to receive only 44 lakh, but they will receive after 1 year. Now we are standing at the completion of year 1, but that 44 lakh will be received at the end of year 2, which means 1 more year will be there, correct? How much amount I will receive? 44 lakh, but not enough. I will receive after 1 year. Therefore, I have to calculate the present value. So just do that 44 lakh by 1.06. 41.51, which means this should be my carrying amount. And this is my carrying amount. This is my existing amount. This should be my carrying amount. If you observe carefully, this is impairment. Because this is my carrying amount. This is my recoverable amount, kind of a thing. I have not calculated value in use, but indirectly I have calculated how much amount I am recovering from that asset. Correct? Therefore, this will become my recoverable amount. Now understand from the point of impairment standard. This is carrying amount. This is recoverable amount. Is there any impairment or not? How much is impairment? 3.01. Therefore, the entry what I will pass? Impairment loss account debit to financial asset account I will pass. 3.01 I will write. Now, 3.01 will become impairment loss. Sir, already I am having this much balance. If I charge this impairment, my financial asset balance will be how much? 41.51. 41.51. Now what will happen? Next year, I will get 44. My balance is 41.51. 1 more year I have to book finance income. Correct? So into 6%. This will become finance income, and corresponding amount I also have to add to the financial asset. Okay, simple calculations, nothing complicated, but very, very important question. Because in this question, impairment loss is also related. Okay, very simple question. So you have to practice this nicely. Okay, so second question we have completed. Fine. Now, I am having very, very important discussion, and from your exam point of view, this is the most highly probable area of being asked in the exam, which is nothing but compound financial instrument. Compound financial instrument. Based on this only, number of times already they have asked questions, and even in the recent MTP also they have once again asked this compound financial instrument. Okay, which makes it very, very important. So let us understand carefully about this compound financial instrument. If you want to understand about this compound financial instrument, first you have to understand about this which is called as preference share capital and something which is called as debentures. Preference share capital and debentures. If you remember your accounting standard days, in our balance sheet, if any preference share capital is there, I will show this preference share capital in the share capital section of my balance sheet. Correct? I will write in my old balance sheet share capital. I will write equity share capital, reserves and surplus. One more item I will write what? Preference share capital. But this is old AS days. Ind accounting standards. Ind AS will say whether it is preference share capital or whether it is debentures, both are same. Whether it is preference share capital or whether it is debentures, both are same. This is said by Ind AS. Because Ind AS is asking you to check something which is called as a substance over form. So why it is treated as a financial liability, let us understand. If it is, assume one company has issued 10% preference share capital, same company have issued 10% debentures also. Okay. Let us assume 5 years is the time limit for this preference share capital. It is redeemable preference share capital. It is also repaid at the end of 5 years. If you observe, if I am a debenture holder, the company have to pay me interest. Sorry. If I am a debenture holder, the company will have to make me the interest payment. Along with that, at the end of 5th year, what the company will do? The company will make a principal payment also. Correct. If I am a preference shareholder, what the company will pay? The company have to pay preference dividend. At the end of 5 years, it should pay me preference share capital. Correct. Company have to pay me redemption of preference share capital. If you observe both the features, the names are only different. Names are only different. Here they are paying principal. Here they are paying preference share capital. Here they are paying dividend. Here they are paying coupon. If you observe, whether it is a preference share capital, company is still having a contractual obligation to pay the cash. Whether it is a debentures also, still the company is having a contractual obligation to pay the cash. Therefore, Ind AS have given both are same, just the names are different. Therefore, let us give same accounting treatment for both of these items. What they are saying, let us give same accounting treatment for the both of these items is suggested by Ind accounting standards. Okay, sir, what they will say, let us understand this. Sir, what they will say is, see, at this point I have explained preference share capital and debenture, this is the thing. But one thing can possible. In case of irredeemable preference share capital means company will not repay them. Plus, if the company is not having any obligation to pay the dividend, this case, it is not treated as financial liability. But I think you all know that as per company law, a company cannot issue irredeemable preference share capital. Therefore, it is not possible practically, but exam point of view, they may give this question also, but very less chances are there. Which means if it is irredeemable preference share capital, which means the company is not having any obligation to pay the share capital. Along with that, if the company is not having any obligation to pay the dividend also, in this case, it is not a financial liability. So what they will say, it is entirely equity. Entirely equity. Most important discussion will be this. However, sometimes it can be a hybrid instrument also. Hybrid instrument means compound financial instrument. So here what we have to do, we have to break this into equity component and financial liabilities separately, and we have to do the accounting respectively. Sir, what respectively? If it is financial liability, I have to select either amortized cost method or FVTPL method I have to select, correct? So, but if it is equity, okay, what we will do, I will explain, don't worry. First, read this point. If the instrument is redeemable after fixed period and fixed dividend or interest will be paid. It can be preference share capital or dividend. Sorry, it can be preference share capital or debentures. Both we have to check the terms of the instrument. If the terms are redeemable after fixed period, for example, the company is there, 5 years is the tenure I have given, debentures 10 lakh rupees I have given, which means what, after 10 lakhs, am I having the contractual obligation to pay that 10 lakhs or not? Yes. At the same time, 10% coupon also I have to pay. If this is the case, I have to treat that entire instrument as fully financial liability. Coupon also I have to pay. Principal amount also I have to pay. Both will be treated as financial liability. That is called as fully financial liability. Questions are there. If you are having any doubts, after those questions, everything will be clarified. Okay. Second thing. If it is irredeemable or convertible into equity shares. If it is irredeemable, which means I will not pay any capital. If I am not paying any capital, I am not having any obligation to pay. At the same time, discretionary dividend will be paid. Discretionary means if the company wants, it can pay. In this case also, company is not having any obligation. Therefore, it is treated as fully equity. It is treated as what? fully equity component. Check this last part. This is most important. Check this last part, what they are saying. Compulsorily convertible along with fixed dividend or interest or optionally convertible also. Sir, what they are exactly trying to say, let us try to understand. 10% debentures are there. 10% debentures are there. Assume these are compulsory convertible debentures. Compulsory convertible debentures, but the tenure is 5 years. Understand what will happen in this case. For 5 years, every year I will receive 10% coupon. For 5 years, every year what I will receive, 10% coupon I will receive. But after completion of year 5, will I receive cash or will I receive equity shares? These are compulsory convertible, which means I will not receive cash. Think from company point of view. In this case, company is having a contractual obligation to pay this coupon only. To pay this coupon only, which means some part is financial liability. Some part, this is not fully financial because at the end the company will not pay me cash. Company will issue what? Equity shares. Therefore, this is partly financial liability, partly equity. This point is only tested in the exam. If it is both, what we have to do? We have to do the bifurcation. Okay, here I have given the treatment what we have to do. If it is compound financial instrument, which means what they are saying, if instrument has both the components, equity and financial liability, it is called as compound financial instrument. Bifurcation should be done. Sir, first what we have to calculate? Financial liability component. Financial liability component means it will be amortized cost method only in maximum cases. And one more thing, fair value of financial liability will be calculated by using normal rate of return. Here you can write present value of future cash flows. Present value of future cash flows using normal rate of return. Present value of future cash flows using normal rate of return. Okay. We will solve some questions, then you will get the total correctly. Don't worry. Okay. Let us understand this. We will solve one more question. So check this part, question number 3. Question number 3. Question number 3, what they are saying, let us understand. In your calculator only you can complete this solution. Let us check this. They are saying company issued 2,50,000 6% convertible debentures at the rate 10 each. Which means these are number of debentures. 10 rupees is the face value. Can you tell me what is the total amount which is raised by the company? Very good. 2,50,000 to 25. 25 lakhs. On which date the company have raised it? 1/4/2021. What they are saying? The debentures are due for redemption on 31st March 2025 at a premium of how much? 10%. At a premium of 10%, comma, convertible into equity shares to the extent of 50%. Which means this total debentures I will not pay. 50% I will convert into equity shares. Balance 50%, what I will do, I will pay in cash. But at the time of making the cash, what I will do? At a premium of 10%, I have to make the payment. Correct? Cash plus 10% premium or equity shares 50%, which means, see, total instrument is 25 lakh. Out of which 50% equity shares. Balance 50% cash. But while making cash, I will make 10% extra payment because it is premium. Correct? Let us do calculations, don't worry. But what they are saying, check this. The interest rate on equivalent debentures, this is most important. Without the conversion rate says how much? 10%. They are asking me to separate the debt and equity components at the time of issue and show the accounting interest at initial recognition. Very, very simple. First of all, tell me, in this instrument, what is the coupon rate? Company will pay me 6%. interest. That's it. But they have given this 10%. Sir, why they have given this 10%, you have to understand. Sir, whatever the debentures which the company is paying me 6%, those are not pure debentures. Those are debentures with conversion option. Those are debentures with what? Conversion option. Indians want me to calculate fair value of the pure liability. If I want to calculate fair value of that pure liability, also I have to consider discounting factor of such instrument which is not having any conversion. Correct? Then only I will get pure liabilities fair value. They have given that only in the name of 10%. Without a conversion option, interest rate on equivalent debentures is 10%, which means this will become my normal rate of return. This 10% will become what? My normal rate of return, which means I have to discount at this 10%. Okay, let us understand the question. See, we will solve this. So check this. Little theory we have to write. Okay, little theory we have to write in this question. See, nothing more is required. This 1 point is more than sufficient. What we have to do is, sir, this is a debt instrument. First of all, it should contain some part of financial liability also, some part of equity also, because I have to issue shares also at the end. These are compulsory convertible debentures. Therefore, what I have to do, I will write, since the instrument contains both the features, it is treated as a compound financial instrument, its accounting will be as follows. First, what I have to calculate, I have to calculate financial liability component. Financial liability is nothing but present value of future cash flows using normal rate of return. Sir, in this question, what is the normal rate of return? 10%. Sir, tell me here, what are the cash flows which I will get? Coupon I will get. How much coupon? 6%. Calculate 25 lakh into 6%. 1,50,000 is not per year. Every year I will get, which means annuity. Correct? Present value annuity factor 10% 4 years. Present value annuity factor 10% 4 years. Approximately. And one more thing, at the end of year 4, 50% only will be paid in cash. Correct? Out of this 25 lakh, 50% only I have to make the payment, but I will not make exactly at face value. I will pay premium amount also. So into 110%. You can do plus 10% also, but anything is fine. 25 lakh into 50% into 110% also. The company is having contractual obligation to pay the cash. Therefore, I am including this in financial liability calculations. How much is this? Is this correct or not? 13,75,000 into, this is not annuity, one-time payment. So present value interest factor 10% 4th year. This will become my financial liability component. This will become my, add these two figures. Is it correct or not? This will become my financial liability. Correct? But how much amount I have raised from the debenture holders? 25 lakh. Correct? From this 25 lakh, deduct this financial liability. From this 25 lakh, deduct this financial liability. That is nothing but equity. That is nothing but equity component. Easy accounting. This only they will repeat in 4 to 5 questions. You have to understand, sir, what amounts are financial liability? Financial liability is nothing but how much cash I am paying. What is the contractual obligation I am paying? That is only my financial liability. If it is equity shares, it is not a financial liability. Okay. So here what I am paying, coupon I will pay, principal also 50% only I will pay, that to 10% premium I will pay. Okay. So simple calculations. This is my equity component. Second step, I have to also calculate the equity component also in this question. Divided కాదు ఈ వాల్యూ దాని వాల్యూ ఓకే 25 lakh into 50% into 110%. 110%. ప్రీమియం 10% పే చేస్తున్నావు కదా 110%. అదే 10% ఎక్స్ట్రా పే చేస్తున్నావు కదా, సో నువ్వు ప్లస్ 10% యాడ్ చేసినా పర్లేదు. ఒకసారి ఇది ఎంత చెప్పు అమౌంట్, నేను అంత పే చేయను ప్లస్ 10% చేయి. ఇంకొక వే ఇలా కూడా చేయొచ్చు, ఇంటూ 110% కూడా చేయొచ్చు. ఓకే, నీకు అలా వస్తే అలానే చేయి. ఇంటూ 50% ప్లస్ 10% యాడ్ చేసుకో, ఎక్స్ట్రా ప్రీమియం పే చేస్తున్నావు కదా 10%. ఓకే, దిస్ ఈస్ ఈక్విటీ కాంపోనెంట్ 10,85,376.69. Most importantly, this you have to understand. Sir, journal entry what I have to pass. How much amount you will receive, tell me? 25 lakhs you will receive. There is no change here. But internal accounting will change. Company will do accounting differently. Sir, what? It will pay, it will receive, the company will issue 6% debentures only. But some amount is financial liability, some amount is equity. Sir, how much amounts we have calculated? Okay, same I have to continue. Easiest question. Okay, 2-3 questions we will solve like this only, then you will get the total clarity. Bank account debit, 6% debentures financial liability, 6% debentures equity. See, out of this total 25 lakh, how much amount is financial liability, tell me? 14,14,623. While doing amortization table, I will apply finance income and all on this amount only, because this is only my financial liability, which means what? I will take year, opening balance, finance cost, this is liability, therefore I will write finance cost, closing balance, all those things I will write. I will not do it 25 lakh, because the total is not my finance cost. Sorry, the total is not my financial liability. How much is financial liability? This only financial liability accounting I will apply. Correct? Sir, then what you will do with this amount? This is equity component. In last class I have explained, equity component means no fair value changes will be recorded. This amount will be kept as it is. This amount will be kept as it is. Sir, if the company later issues equity shares, this will be transferred to share capital. This will be transferred to share capital. But till then, no fair value changes are entertained with this equity component. But financial liability, I will do amortized cost method accounting. Okay, one question is there. There I will explain the journal entries also. Then you will get total clarity. So one more question let us solve. Check question number 4. Question number 4. I think this is same question. Okay, let us read this question. Moon Limited issued 1,08% debentures of 100 each on par value basis on 1st Jan 2023. The only difference, their financial year, here calendar year. Okay, they are saying debentures are redeemable at a 12% premium. Here not 50% redemption. Total debentures, if you want redemption, how much they will pay? At a 12% premium, or exchangeable for ordinary shares of Moon Limited on 1:1 basis. Option is given to debenture holders only. If after completion of the tenure, if debenture holders opted for cash, the company will pay in cash. If debenture holders opted for shares, the company will issue shares, which means these are not compulsory convertible debentures. These are optionally convertible debentures. These are what? Optionally convertible debentures. But in the last question, there is no such option. Last question, they are clearly saying it is compulsory convertible debentures, but partly convertible debentures, not fully convertible. 50% is only compulsory convertible, but here what? Total amount is partly convertible debentures only. Sir, understand, if it is partly convertible debenture, that is also a compound financial instrument. How we have to do the accounting is, understand whatever I am saying. The company have to maintain sufficient amount of cash, even if all the debenture holders at the end have asked the cash. Which means the company have to maintain, see here the option is there with the debenture holders. At the end of the period, for example, if any debenture holder comes and asks the cash, the company cannot say, I will not issue the cash. Correct? The company cannot say, because option is there with the debenture holder. Therefore, what the standard is saying is, in case of optionally convertible debentures, what you have to do is, you have to take an assumption that even if all the debenture holders have come and asked me cash, I should be in such a position to pay that cash. which means while finding out financial liability, I will include principal amount also as financial liability component. Because even if all the debentures holders asked me, I cannot say no. I have to maintain sufficient amount of cash. Therefore, at the end, total amount will be included in financial liability calculation. Sir, what you are trying to say? Let me show you the solution. Question number 4. Check this. I will write little theory about compound financial instrument, and I will write it should be broken down into financial liability and equity as per Ind AS 109. I have to calculate present value of financial liability. Correct? Sir, financial liability means if you observe carefully, 4 years I will receive coupon. Coupon I will receive. Sir, what is the total amount? 1 crore into 8% is the coupon. Calculate 1 crore into 8%. 8 lakhs. Find out the discounting rate in the question. Discounting rate in the question have they given or not? See, without a conversion, it is 12%. This is the fair value of actual debentures. Therefore, I will consider this 12% only as the value. So now understand, 12% is the discounting factor. 8% is coupon. That's what I'm saying. 8% is coupon. 12% is discount. Do this calculation. This is annuity. So 1 by 1.12, 4 times annuity into 8 lakhs. Approximately. Even if rounding off is there, we can ignore. At the end, I also have to pay principal also, but at premium. Correct? Total also. So 1 crore into 112%. 1 crore into 112% I have to pay. Why I have included 1 crore means because it is optionally convertible debentures. I can't say no if the debenture holder asks cash. Therefore, the company will maintain sufficient amount of cash. Okay, so this much. Present value is totally how much? Just add these two figures. Add these two amounts. Coupon redemption. Is it matching? 95 lakh 53,600. This is pure financial liability. But what is the instrument? Amount is wrong. I think here I have written wrong, but figure is correct only. Present value interest factor only we have to take. Okay? Right. ఎంత వచ్చింది ఒకసారి అప్రాక్సిమేట్లీ చూడండి సరిపోతుంది ఒకసారి చూసుకోండి ఓకే దిస్ ఈస్ మై ఫైనాన్షియల్ లయబిలిటీ అమౌంట్ కాంపోనెంట్ వాల్యూ is 1 crore financial liability is this much what is the difference this is my equity component this is my equity component sir tell me the journal entry what I have to pass bank account 1 crore 2 financial liability this much 2 equity this much correct sir every year I have to pass finance income finance cost this is liability so I have to recognize finance cost on which amount I have to recognize this amount correct very good year 1 end what I will do is see this is my initial liability what is my discounting rate which I have used tell me which means I have to calculate interest on this amount. Calculate 12% amount. Calculate this into 12%. Enta? I think I have taken some different discounting factor. Rounding off mistake. So 432 I have got. Okay. For the 2 rupees you should not fight. Same means fine. Now, at the end of the year, how much the company will pay? Tell me. Company will pay me only 8%. Whatever the accounting which I have done, that internal accounting. Company don't know. Company only know I have given 100 lakh. Sorry, I have taken 100 lakh into how much? 8% they will pay. Which means coupon they will pay 8 lakh. Coupon they will pay 8 lakh. Okay, that is the reason why I have taken different discounting factor. Different discounting factor I have taken because that is not the effective rate of this debenture. Because without any conversion option, the debentures are issued at 12%. Therefore, that is only correct. Okay, let us come to year 4. Like this, I will pass every year. Like this, I will pass every year. Let us assume year 4 have come. All the debenture holders opted for cash. Assume all the debenture holders have opted for cash. Sir, if all the debenture holders have opted for cash, how much amount I have to pay? 1 crore 12 lakhs I have to pay. Correct. If I follow amortization table, my last year balance should be this much. Try. If you want, after going home, you can try. Try this amortization table. You will get 1 crore 12 lakh rupees. I will cancel my liability. I will cancel my liability. Sir, but initially I have recorded this much also. Equity amount also I have recognized. Now I am paying cash. Therefore, that amount is not required for me. Therefore, I will cancel that to retained earnings. Therefore, I will cancel that amount to retained earnings. Sir, another thing also can happen. Sir, what if debenture holders opted for equity shares? If they have asked equity shares, will I pay cash? I will not pay cash. Therefore, I will write to equity share capital, to securities premium. My liability also have to be cancelled because I will not pay cash. Therefore, liability also will be debited. Equity also will be debited. Equity share capital and securities premium will be credited. Your institute is only asking to pass the entry in the first year only. First year means this entry, this entry, this entry. This I have explained extra as to what exactly will happen at the end of the tenure of this period. But our institute is only asking to pass the journal entries only for year 1. Year 1 only they are asking. Year 1 what we have to do? First I will calculate the value of financial liability. Financial liability means I should use the discounting factor. Normal rate of return I have to use. See, you can't use discounting factor 8%. If I use 8% here, I will get 1 lakh, I will get 1 crore only. No point of using 8%. Correct? I have to use different discounting rate. Which discounting rate? Normal rate of return I have to use. Okay? This is very, very important question. This question also. So whatever I am discussing only the super 75 questions. So every question I am discussing, you have to practice nicely. One more question. One more question. Question number 7. Come to question 7. Exam question. Okay, exam question, question number 7. So let us understand this. I have already said that, sir, if it is transaction cost, if it is transaction cost, if it is ACM or FPT OCI, assume it is financial asset, then what I have to do? I will add to the cost of the asset. Correct? But sometimes what can happen is, there may be a financial liability. And in this financial liability also, sometimes they may give transaction cost. Sir, when this can happen? For example, I am taking a loan from HDFC Bank. That is my loan. That is my financial liability. Correct? Assume the company have granted me 10 lakh rupees loan. They have deducted some 25,000 rupees charges. Now tell me, those 25,000 also will repay, but this 25,000 also transaction charges or not? These are also transaction charges. Same treatment we have to follow. Sir, if you are following amortized cost method, FET OCI is not there for liability. Correct? If I am following amortized cost, I will adjust this in the financial liability. Adjust this means I will not add. Because this is financial liability, I will deduct. If it is financial asset, what I will do? I will add it to the asset. Correct? Basic common sense. Financial liability, I will deduct the amount. If it is financial asset, I will add to the cost of the asset. This I will do if it is ACM. Sir, if it is FVTPL, I will record my liability at 10 lakhs only. Transaction charges will be transferred to P&L account. With this understanding, let us check this question. Very important question. So check this. Bees Limited borrowed a sum of 20 crores from Sindhu Limited on 1st April 23, repayable as a single bullet payment. Single bullet payment means payment will be made at the end. Repayment amount. Repayment amount will be made. See, here they have used the word repayable, which means they're talking about principal. Interest every year they will pay. But principal, single payment at the end of 5th year. Correct? They are saying interest thereon at the rate of 5% per annum is payable at yearly rests. What they are saying? 5% per annum interest they are paying. Correct? Since the market rate of interest is 8%, this is discounting rate. This is discounting rate, IRR or normal rate of return, whatever you can say. 5% is the actual interest which is paid by the Bees Limited, but I will not discount at 5%. I have to discount at 8% because this is the market rate of return. And one more thing, Bees Limited paid an origination fees of this much. What is this amount? Tell me. Transaction charges. Who have paid? Bees Limited. Is the Bees Limited taken the loan or is it given the loan? If B Limited have taken the loan, tell me for Bees Limited, is it a financial liability or a financial asset? Liability. If it is a liability, transaction cost is there. What I have to do? If nothing is said, ACM only. Liability, I have already said. See, in the notes only, liability. Only for these two, FVTPL. Financial guarantee, incompati derivatives. But most of the cases, they will give amortized cost only in your exam. Okay, fine. They are asking, Bs have to pay 2.395 crore to Sindhu Limited to compensate Sindhu Limited for the lower rate of interest. Apart from the above, there are no other transactions. You are required to calculate the annual amount at which this much they have given. Question also carefully observe. They are saying, you are required to calculate what? Amount at which, who will recognize? Bs Limited would recognize the loan. Bs means, for that Bs, is it a financial liability or a financial asset? For Bs, it is a financial liability. Next. And Sindhu Limited, they are asking initial recognition for Bs, interest income for Sindhu. Initial recognition for Bs, interest income for Sindhu, they are asking. Okay, carefully understand. Now, what they are asking to do is, they have given the present values, strike off the solution. This solution has mistakenly given here. Okay, but what we have to do is, since this is our exam question, you can check our suggested answers. There you will match the solution. Okay, just strike off the solution and please write suggested answer. Copy this. I will show you the suggested answer and discuss also. Don't worry. Suggested answer you have to copy. Okay, one mistakenly printed this question, so we have to ignore this. Let me show you the suggested 176 page this question. So check this part. Bs Limited, it is a financial liability. If it is a financial liability, transaction cost, what I have to do? I will deduct. Correct? So 20 is the initial amount of loan. 2.3954 is the transaction cost. Therefore, this is the total amount which will be recognized in the books of Bs Limited. Correct? Which will be recognized in the books of Bs Limited. How much is the amount? 17.6046 crores. 17.6046 crores. Now what have happened? They are asking finance income in the books of Sindhu. They are asking. Don't get confused. Sir, if it is financial liability for Bs, it will become financial asset for Sindhu. If it becomes financial asset for Sindhu, normally transaction cost, what I have to do? I have to add Don't confuse like that. I will add if I have paid the transaction cost. Here, who have paid the transaction cost? B's have paid the transaction cost, which means B's will do this adjustment and this will become ultimate initial recognition amount. Okay, but this transaction is not done at a market rate. Therefore, Sindhu Limited also will record this amount at this amount only. Don't confuse and don't do 20 plus 2.3954 and record it 22.3954 because transaction cost is not paid by Sindhu. You cannot treat same transaction cost Sindhu have also paid, B's have also paid. It is not that like that. Okay, so here this is the initial recognition amount which will be recognized by Sindhu Limited. Correct. Read the discount rate in the question. What is the discount rate in the question? 8%, which means I will recognize finance income based on that 9%. So type this amount in calculator. Type this amount in calculator into 8%. Into 8%. Is it matching or not? Minus year end, I have to pay how much? 5% interest. 5% interest means 1 crore. So find out this closing balance. Find out this closing balance. Opening balance plus interest minus payment. Huh? This minus this you can do. Here they have already added these two figures. Okay. Huh? Here opening balance, finance income, amount received. If you are receiving any amount, you have to deduct. 1 crore you are receiving, correct? Similarly, check for all years. Check for all years. Very important question. Check for all years. Is it matching or not every year? Here, you will not take this total here, but they have given, but totally fine. Opening plus interest minus payment, I will get my amortized closing balance. Okay, easiest question. But if you don't check this, you will make mistake. Okay, again, transaction cost, I will not add in the books of Sindhu because Sindhu have not made the payment. Okay, if it is financial asset and ACM, I will add. If it is financial liability and ACM, I will deduct the transaction cost. Very important question. One more question we will solve. Is it? Sindhu ke? Oh no. If Sindhu for financial asset, but is Sindhu paying that cost? Cost is paid by these only. See, assume you and me have entered into transaction. 1 crore rupee loan. You are paying 10 lakh rupees transaction charges, for example. For you, what I have given the loan to you. Okay, you have taken the loan, which means for you it is financial liability. You are only paying the cost means it will be added, it will be deducted from your liability. If I am paying the cost, I will add to my asset. How can one cost will be paid by both the parties? Okay, here they have clearly given. If you read the question, see, to compensate this lower rate of interest, which means normally it should be 8%, but Sindhu is charging only 5%. Sir, why it will charge at 5%? Because they are collecting this much amount from Sindhu, or this much amount from B's. Therefore, they have compensated lesser interest by accepting this amount. Okay, so that is the reason. They are not paying the transaction cost, Sindhu. Okay, same amount we have to recognize. If you still have doubts, let us discuss in the break time. 8%. 17 point. Okay, we'll discuss at break if you have any doubts. One more question. December 25. December 25 question. December 25 question. So check this. Rakesh Limited borrowed 18 crore 75 lakh 18 crore 75 lakh from Central Bank of India on 1st January 2024. Terms of the loan they have given. Interest rate is 11%. The difference between last question and this question is, in the last question, principal is single payment. But here they are saying repayment of principal in 5 equal installments, which means every year how much I will pay, tell me? 18.75 by 5. How much? 3 point something. This much I have to pay it every year. Principal. Interest also I will pay. This is principal amount I am saying. Okay. Now, what is this? Upfront processing fees means what? Transaction charges. Therefore, what I have to do with this transaction charges? Adjusted in transaction cost. Correct? It will depend on whether it is financial liability. Here they are asking in the books of Rakesh Limited, which means for Rakesh it is what? Liability. Therefore, I will deduct this 22,01,286 from my books of accounts. Effective interest rate they have only given 11.5%. If they have given, take that rate. If they have given, take that 11.5% rate. Okay. They are asking us to prepare a statement showing the amortization of the loan based on effective interest rate. So what we'll be doing is, let me show you the suggested. So check this part. Here, nothing is complicated, but you have to write zeros properly. If you have written 1 0 extra or 1 0 less, answer will be wrong. Okay. Question is very simple. See, nothing is there. Date. One more thing, they have followed the calendar year. Calendar year they have followed. They have given January, I think. We have borrowed on January. Okay. 1st January, 31st December, which means we have to follow the calendar year in this question. So check this. 18 crore 75 lakh is the initial amount. Initial charges I will deduct, and this is the initial recognition which I have to record in my books. 18 crore is my total amount, but this I will record. This is my ultimate closing balance. Tell me how much it is. 18 crore 52 lakh 98,714. What is the effective rate of interest? Tell me. This into 11.5. This into 11.5. Oh, sorry, this one. 2 crore 13 lakh 9,352. Carefully check this. Okay. This here they have written interest at the effective interest rate 11.5%. This into 11.5%. Now what have happened? Year 1 is completed. I will pay how much interest I will pay? Tell me. What is the interest rate which they have given in the question? 11 they have given, which means 18 crore 75 lakh into 11%. How much? Understand, even though transaction charges have debited, banker will charge interest on this total amount. Banker, you cannot say, banker, you have to charge interest only on this. No, they have given a loan of this much. Therefore, my actual interest will be this into 11%. This into 11%, I have to make the payment. Interest payment. Principal also I have to make the payment. Principal, how much I have to make? 3 crore 75 lakh. Correct? 3 crore 75 lakh principal I have to make. This is the interest which I have to book. This is the interest which I have to book. This is the interest I have to pay. This is the principal I have to pay. Okay, understand? Sir, what I will get is, just take this amount in your calculator. 1852,98,714 plus this interest, effective interest rate I have to book, plus this interest, minus these two figures. Minus these two figures. I think you have taken some wrong figures. You have to take this. It is matching. Is it matching? Very good. Next year also, I will calculate effective interest rate on this amount. I will make this much principal will not change, but interest will change. Because I have repaid this 3 crore 75 lakh. Next year, while calculating interest, I will calculate on this minus this. Basic common sense. If I am paying already some principal, will I calculate interest also on that amount? No. Correct? So 18.75 crore minus 3.75 crore. On the remaining amount, my interest will be calculated. Okay. So one small thing I can do. I think some are confusing in the solution. See, what I will do is, let me write like this, amortization table year. First year calculation I will do, all others I will not do, year. Let me write finance cost. Next, I have to write repayment. Repayment includes principal, interest. Let me write year. Opening balance I will write. Last I will write closing balance. After adjusting the transaction cost, tell me after adjusting the transaction cost, what is my initial recognition amount? 1852. This is my opening balance. On this, calculate 11.5% and tell me. 2 crores. 9,000. At the year end, I have to pay the 3 crore 75 lakh something. I will pay 3 crore 75 lakh. Along with that, I also have to make how much payment? Interest of how much? 11% will be calculated on 18 crore 75 lakh. 18 crore 75 lakh. And the 2 crore? Now tell me the closing balance. 1480. And then this will become my opening balance for the year 2. Let me do for second year also, others I will not do. Second year, 1484.83.066. Tell me finance cost into 11.5%. 1 crore 70 na 70. 3. And then how much principal I will make at the end of year 2? 3 crore 75 lakh is common. Tell me actual interest. Interest I have to calculate on 18 crore 75 lakh minus this principal is repaid now. How much? 1 crore 65 lakh ante na. Now tell me the closing figure at the end of year 2. 61. It is matching. But ఏం చేస్తారంటే ఓపెనింగ్ బ్యాలెన్స్ ముందు ఇయర్ లో తీసుకున్నాడు, but we can follow the normal table. If you are confusing, we can follow this normal table. Like this we can solve all years. Okay, fine. This question is also done. 2 more questions we will discuss and we'll stop this chapter. Those are extra questions, workbook questions I want to discuss. First, let us discuss this last question, question number 9. Easy question only. Question number 9. So carefully check this. Easy question. This is workbook question. Okay. On 1st April 2020, S Limited provided what housing loan of how much? 15 lakhs. To an employee, interest rate is how much? 6% per annum. What is the amount of loan? What is the interest which they are charging? 6%. They are saying loan is repayable in 5 equal annual installments plus interest. What is the principal amount? 15 lakhs. Divide by 5. 3 lakh plus interest also they will pay. We will calculate slowly, don't worry. The employee is not required to provide any specific performance obligation in exchange for this benefit. See, what they are saying is market rate for similar loans is how much? 10. Think from company point of view. Normally, for any person, the company have to, if the company wants to give any loan, how much interest it have to charge? But since he is employee, the company is only charging 6%, which means this is not pure loan. This is not pure loan, because why would I charge someone at 6%, which I have to charge from outsiders at 10%? Some benefit is there. Since he is employee, I have taken that. Correct? So what the standard is saying is, first calculate the fair value of the pure loan amount. Pure loan amount means take the discounting factor 10%. That only I have calculated first. Later you can check this, but just cross check the calculations. Loan amount initially it is 15 lakhs. 3 lakhs I have to pay. Interest income 6%. Like this, if I do the total calculations, my fair value of the loan will be this much. 13,54,602 will become my fair value of the loan. Okay? Understand from the company point of view. How much amount of loan the company have given? 15 lakhs the company have given. Out of that 15 lakhs, sir, what is the fair value of pure loan? Pure loan is this much, but difference is there. How much difference is there? How much amount? Tell me. 15 lakh minus this. 1,45,328. The standard is saying, company, you have not actually given 15 lakh salary, 15 lakh rupees loan. You have actually given this much loan. You have actually given this much loan. Whatever the interest which you are charging now, that is not 6%. For outsiders, it may seem that is 6%. But if I actually calculate the fair value, that is not correct. The actual normal rate of return is only 10%. If I take 10%, the loan amount is this much. But company will say, but I have issued 15 lakh rupees now. Now the standard is saying whatever the difference which is there now, you have granted at lower amount of interest just because that person is your employee. Therefore, what they are saying is, okay, this much is only the loan. Then what about extra payment? Extra payment is nothing but salary paid in advance. Extra amount is nothing but what? Salary paid in advance. Salary paid in advance is nothing but prepaid salary. Correct? This much is only loan. Balance amount is prepaid salary. But you have designed the transaction as it is a loan. Okay? So therefore, the standard is saying very simple. This is the entry which I have to pass initially. This is prepaid employee cost have to come here. Prepaid employee cost, which means prepaid salaries. Like this, we have to pass this journal entry. Very, very important question. Okay, prepaid salary question. So I think we have completed financial liability chapter. All concepts we have seen. All exam questions also we have seen. This embedded derivative is nothing but they will talk about those optionally convertible debentures. That same point they will say, which means optionally convertible debentures. We have already solved those questions also, so we can even ignore this concept. We know how to solve the questions. Okay. So with this, we have completed financial liability chapter also. I recommend you workbook questions related PDF. This PDF we have to download. Sir, in this, what questions you recommend us to solve is, let me quickly show you that part. 1 second, guys. Financial instruments, sir, which page it is there? Just a moment, guys. I'm searching that. Financial instruments. Question number, I guess, This one. Brilliant question. Illustration number 12, page number 52. I recommend you to check this question. I will be just making you go through the crux of this question. You just have to practice this nicely, guys, because I don't know why this question is seeming to me as a direct question which is coming in your exam. So I recommend you to definitely practice this question. So can you please tell me the crux? I am here to discuss that now. So first of all, I recommend you to write this text in your concept book. I will, I want you to pause the video for at least some, 1 second, where is this? I recommend you to pause the video for 5 to 10 seconds and copy whatever the content which I have written here. Okay, this is very important point to solve our question, guys. Okay, sir. Now let us understand. After pausing this, let us understand what I have written. So first of all, if any transaction is done at off market terms after bifurcating financial liability and equity, transaction cost should be bifurcated in proportion to their initial balances. So first of all, what is the meaning of off market terms? Let us understand with the help of the question. Sir, first of all, if you check, sir, X Limited issues convertible bonds. Sir, coupon rate is 5.5%. Carefully understand. Sir, they are saying it is a convertible bonds. Sir, off market terms means, sir, if similar bonds are issued without the conversion option, what will be the discounting factor? That is called as off market, which means it is not normally how the market is going to enter. Market, if you want to enter any non-convertible debentures, if they want to issue bonds, they will give a coupon rate of 8%. But the entity is only issuing 5.5%, which means it is a transaction of market transactions. Sir, what we have to do? We have to calculate future cash flows based on this rate. But discounting I have to do using this 8%, which means, sir, 8% का discounting factor. Cash flows I have to take normally. Sir, this is the value of instrument 1.2 crores. But if I calculate the present value, na, I will be getting this. Sir, this is called as financial liability and balancing figure will be called as equity component. I think till here, most of you guys have understood whatever I'm trying to say. But the question is having one more twist. Sir, what is the twist in the question? They are saying, sir, some transaction cost is also there, not 10 lakh rupees. This is most important. Sir, if they have given any transaction cost, if my instrument is having both financial liability as well as equity, you have to bifurcate with both financial liability as well as equity. Sir, what you are saying, this 10 lakh is there now. This 10 lakh should be bifurcated here also. I mean, liability component also, and this component also. Understand, sir, this is a liability. If it is financial liability, it will be adjusted from the financial liability, which means it will be deducted from the proceeds now. Sir, this should be my normal financial liability, but I have to bifurcate. This is the thing. Issue cost will have to be allocated between the liability and equity in proportion to their balances. Sir, issue cost is 10 lakh rupees. I have to allocate 10 lakh in this ratios. That is the only point which you have to understand, guys. Sir, this will give me my initial recognition ka amount. Sir, such a nice institute na, they have only given effective interest rate, which means this I have to use to recognize finance cost. This I have to recognize to book finance cost. Most important question in this question, for calculating discounting, for calculating present value, I will use this 8%. But once I calculate this 8%, this will not become my effective interest rate because transaction cost is also there here. If transaction cost is there, I have to adjust with my financial liability. Sir, but I am having both financial liability as well as equity. Now, how do I allocate transaction cost? That is the reason. That is the point which I have written here. Transaction cost should be bifurcated in proportion to their initial balances. Just to do the initial recognition normally, and according to such balances, I have to do the bifurcation. I hope this point is pretty clear. Next part, now, easier question. Next, what I have to do? 9.5% I will be booking interest normally at the end of year 8. It will become 1 crore 20 lakhs. Your institute may not give for 8 years, but definitely they can give for 4 years. Definitely they can give for 4 years. So this is the question which I recommend you to definitely solve this. I hope this point is pretty clear. So yeah, one more last brilliant concept. This question also can be asked for straight away 7 marks. Let us understand this because this is the question which I still remember. This they have asked in my CA final exam. Financial guarantee topic. Very, very interesting and very, very important. So let us understand with the help of an example first, then we can solve the question and I will tell you how to solve this question also. Don't worry. Let us assume, sir, Reliance Limited is there. Reliance Limited is there. And one more entity is also there. For example, Geo Limited also. For example's sake, let us keep this Reliance Limited as a parent company and let us understand this Geo Limited as a subsidiary company. Now understand the story. Sir, this Geo Limited want a loan from HDFC Bank. Sir, HDFC Bank is charging 11% per annum interest. This poor Geo Limited went to its parents Reliance Limited and started crying. Sir, I want a loan from HDFC, but those people are charging 11% per annum, which is a little bit painful. But now this Reliance Limited, it have immediately asked Ambani to call to bank manager of HDFC. And Ambani have called to HDFC and he have said that I came to know that you are charging 11% per annum interest to my company, which is Geo Limited. That is my company. Reliance ka subsidiary it is. Therefore, you cannot charge that much amount of interest. You can just reduce the balance only to 8% per annum. Because, but this HDFC banker will say, I have trust on you, but I don't have trust on this Geo Limited. I can definitely trust you based on your terms. I can grant the loan to Geo Limited at only 8%. But what if the default? This is the question of this HDFC manager. Now, Ambani said that, okay, I have understood you. I will ask my company Reliance Limited to give you something which is called as guarantee. If Geo Limited defaults, Reliance Limited will make the payment. This is the concept of financial guarantee. Understand, Geo Limited will record normal financial liability at 8% per annum. This is the normal market rate of interest, but this is the interest which they are charging. So Geo Limited will do normal financial liability accounting. But there enters this Reliance Limited. It is providing some financial guarantee to Geo Limited now. This is also treated as liability and this will be valued at FVTPL. This is what I have written here, sir. Financial guarantees will be valued through where I have written FVTPL. Financial guarantees will be valued to FVTPL. I hope this point is pretty clear, guys. Now comes the logic. Sir, what we have to do here? This Reliance Limited have to measure something which is called as, sir, what is the value of my financial guarantee? If you observe in the AS will says, if something you don't know at which value we have to record, they will suggest one thing which is called as fair value. Now understand the fair value. Sir, first of all, what is the value of this guarantee? What is the value of this guarantee if you carefully understand now? Sir, this 11% is the normal rate of interest which this HDFC bank will give if there is no guarantee. With the guarantee, it is only giving 8%. Understand? Without guarantee, it will give 11%. With the guarantee, it will give only 8%, which means the difference 8% is the value of the guarantee. Savings jo hai na 8%, that is called as fair value of the guarantee. Understand? Sir, what is the value of the guarantee? Value of the guarantee is, sir, what will be the interest which you will charge if there is no guarantee? What will be the interest which you will charge with the guarantee? Difference is called as fair value of the guarantee now. Which means, sir, 3% per annum is nothing but savings. Sir, if it is 3 years loan, I will save 3% per annum. At the end of year 1, I will save some amount. At the end of year 2, I will save some amount. At the end of year 3 also, I will save some amount. Financial guarantee का initial recognition is nothing but, sir, present value of savings in interest. That is the concept of financial guarantee. That's it, guys. Sir, with the guarantee, 8%, without guarantee, 11%. So 3% is the savings. That 3% का present value of future savings is nothing but your financial guarantee का value. That's it. Yes, sir, that's it. Sir, this is my initial recognition. Sir, subsequent recognition means year 1 end. At what value I have to record, sir? Year 1 end though, you have to record at present value of balance cash flows. Present value of balance cash flows is nothing but my financial guarantee, because 1 year is completed, balance 2 more years are pending. So I have to calculate the present value of those 2 years. That have to be compared with one more thing. This is the thing which you have to check. Sir, that value should be compared with which thing, sir? That value should be compared with expected loss due to default by borrower, which means, sir, after 1 year, I came to understand that Sir Geo Limited is making some defaults. It is not making payments effectively, because of which they are estimating some 10% they are going to default. If they are making default of 10%, I have to make the payment of 10%. That is the concept of guarantee now. Therefore, calculate those two amounts. Whichever is higher is going to my fair value at the end of reporting period. Difference will be transferred to P&L account. One more thing, your institute is not giving this thing. Your institute is not giving this thing. But what we have to do when they have given this also, I will explain. Okay, sir, but proper comfort you will not get before solving the question. After solving the question, you will get the comfort. So quickly come to one more question, which is nothing but financial guarantee question is there. So let me open that part. This thing, guys. Just to check this question, illustration number 16. Sir, I will read the crux. Sir, normally financial guarantee is there, loan amount to 1 crore. Sir, it is, what should I say? Subsidiary, parent relationship is there. Interest rate is 7%. If the guarantee is not given, they will charge 10%, which means what is the value of guarantee? 3% is the value of the guarantee. That's it. Sir, 1 crore into 3% if you do, 3 lakh, year 1, year 2, year 3. But I need present value now, sir. This will become 7,46,005. Sir, but what is the entry which we have to pass? Since holding subsidiary relationship is there, I will debit investment in subsidiary account to debit. Credit I will give to financial guarantee. That's it, sir. Sir, next to what I have to do is just prepare amortization schedule. Just prepare amortization ka schedule. Sir, now what will be happening is, understand, sir, initial balance is this. Year 1 balance to this. Difference will be transferred to P&L account. That is the thing which you have to follow. Difference will be transferred to P&L account. In the same manner, so this is my year balance. This should be my year 2 ka balance. Difference will be once again transferred to P&L account. Last year also, same accounting I have to do. That's it. In this question, they have not given percentage of default, because this is what they have said, nil probability that they will default the loan. If they have given some default, I will calculate both, and whichever is higher will become my reporting period ka value. Difference will be transferred to P&L account. Very, 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 very interesting and important concept. I recommend you to watch this and solve the question. Once again, I am saying this is the rate which they will charge without guarantee. This is the rate which they will charge with guarantee. Difference is nothing but value of the guarantee. Okay? Every year, just to calculate present value of future cash flows. This is only they have calculated in through this amortization schedule. Anything you can do. Anything you can do. I hope this point is clear. With this, I have completed the quick revisionary of financial instruments in 25 minutes. Along with that, I have solved two very, 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 very finely important concepts also. So that's it, guys. Thank you so much. And comment the video, comment the next chapter what you are waiting for. And RBI will give you too many too many ratios we have to comply. So many compliance requirements are there for those bankers. So what they will do for all those persons, they will not give banking company license. So most of the companies will start their business in the form of NBFCs. In these NBFCs also, all companies won't accept deposits, but some big NBFCs are there. Those big NBFCs will accept deposits, and for those NBFCs, RBI also will place some guidelines. For our exam purpose, remember these three NBFCs. First type of NBFC is NBFC deposit taking. Shortly, I will write as NBFC D. NBFC D means deposit taking. Second one, NBFC non-deposit taking. They won't take deposits, but they are systematically important. If they are not taking deposits, they have further classified into two categories. First one, systematically important. Second one, not systematically important. Sir, how can you say whether an NBFC is important or not? Based on asset size, we have to check. If asset size is greater than or equal to 500 crores, it is systematically important. If it is less than 500 crores, it is not systematically important. Okay, to conclude, three categories of NBFCs are there. First one, deposit taking. Second, non-deposit taking. One is systemically important. Another one is systematically non-important. Not systematically important. For our exam purpose, nothing you need to understand the differences between all these NBFCs and all. We have to only remember these provisioning requirements. Provisioning requirements, that to this you have to remember. Okay, if any asset is performing or standard assets, if you are NBFC deposit taking and NBFC non-deposit taking, systematically important, they have given you same percentages for provisions. But if it is NBFC non-deposit, non-systematic important, then they have given some less percentages. Okay, if it is deposit taking and non-deposit systematically important, RBI also will interfere. Therefore, they have given some more amount of percentages. But if it is not systematically important, they have given less number of percentages. These percentages you have to remember. What they will say, if it is performing or standard asset, we have to provide 0.4% of the provision. If it is non-performing and if it is in substandard category, I will provide 10% provision. Doubtful, more than greater than or equal to, greater than 0 but less than 1 year, it is less than 1 year. Small correction, it is less than 1 year. This is less than 1 year. Here also less than 3 years. Okay, 20%, 30%, more than 3 years, it is 50%. If it is loss asset or unsecured asset, we have to charge 100% provision, we have to charge. These provisions simply you have to remember 0.4%, 10%, 20, 30, 50, 100. If it is not systematically important, the first thing only will change. First thing will be changed to 0.25, rest of the percentages are exactly same. Okay, and one more thing. Sir, what is the meaning of this performing, standard, non-performing and all? Let us understand. If any asset, see, basically these NBFCs will have advances, which means loans given these NBFCs will have. Okay, if you observe, sir, the meaning of performing or standard assets is overdue is happened, but that overdue is very less. Overdue means the time have elapsed, but from some advance I am not getting the payment. EMI payment I am not getting. If it is less than 3 months, if it is less than 3 months, it is still performing or it can be called as standard assets. If the overdue is more than 3 months, if the overdue have already exceeded 3 months, then from the end of 3 months, for the next 12 months, it will be called as a substandard category. After overdue completed, after the overdue, 3 months is elapsed, from then onwards till 1 year, it will be there in substandard category. Once this substandard is also completed, which means overdue for 15 months. If overdue from 15 months is completed, it will become doubtful debt. You have to check. Again, in that doubtful also, if it is up to 1 year category, it is called, it will be classified in this category. If it is in doubtful and it is exceeding more than 1 year, but up to 3 years. So you can change this to less than. Here also less than. Okay, less than 1 year, less than 3 years. Last greater than 3 years, it will be appearing in 1 to 3 years. Loss assets means sometimes auditor of that NBFC or RBI of that NBF or RBI, what these two will do is these two will declare some assets as loss assets. From those assets, you are not receiving any amount. So what they will say, you have to charge 100% amount of the provision on those assets. Okay, simple. You just have to remember these percentages. In exam, what they will do, we can solve one question directly. Come to NBFC's chapter. So check this. Here directly they will give you. Directly they will give you. And one more thing, if nothing is given, here I have written, assume this if nothing is mentioned. If they have not given whether it is deposit taking, non-deposit taking, systematically important or not, I will assume this thing. I will charge the percentages like this, 0.2, 0.4, 10, 20, 30, 50, 100, I will charge. Okay, simple. And one more small correction, change these months. Page 88, these you can strike off and write same as NBFC deposit taking, same as NBFC deposit taking, or NBFC non-deposit taking, systemically important. Same, which means for next 1 year, for next 2 years, after 1 to 3 years, same category we have to continue. Okay, next. Let us directly solve this question. So carefully check this. They have clearly given the assets. Standard assets, it is 8,400. 8,400 into 0.4% I have to make. Substandard assets also directly they have given you the amount 910 into 10% I have to charge. Doubtful assets directly multiply with the percentages into 20%, 30%, 50%. These were secured. If there is any unsecured portion on that also I have to charge 100% of the debt. Okay, I think here I have given. Just right here only loss assets. Here I have written loss assets or unsecured for both 100% we have to provide. Okay, simple question. Like this also they have asked in one attempt of your past. So we have to check this. Here they have given a note. Percentage of provision for standard asset is 0.25 as per NBFC, non-systemically important, non-deposit taking company. If you want, you can write this note point also. Okay, simple question. One standard question they are going to ask from this chapter NBFC. One more question is there, which is nothing but this new question they can ask, which is Samaveda Limited is a NBFC. This is a little bit good question, so we have to understand. Without solving this question, before solving this question, let us understand this part also. This is important. So what they will say is, if any NBFC gives an advance to finance higher purchase asset or leasing equipment. Higher purchase asset or leasing equipment. In the question, they will specify these two things, don't worry. So if they have given these items, you have to understand, we have to solve like this. For example, if you want to go to purchase any bike or car, if you go to any showrooms, they will generally provide you finance. Those are called as providers of finance for higher purchase asset or leasing equipment. Sometimes they can give you on lease also. So here what they will say, you have to create general provision on all those advances. Sir, what is the meaning of general provision? General provision means I have to calculate these two items. First, what I have to calculate? Outstanding loan amount I have to calculate. From that outstanding loan, I will calculate net book value of the asset. Net book value of the asset after calculating depreciation at the rate 20% SLM they are saying. Sir, what they are exactly trying to say means, see, for example, you have taken the loan of 10 lakh rupees, installment amount is 1 lakh. You have paid 2 installments. If you have paid 2 installments, tell me what is the total amount of outstanding loan? 10 lakh cheppana. So total outstanding loan is how much? 8 lakhs. Assume default is made. Now what I can do, I have to take that asset and I have to sell that asset, correct? Assume the cost of the asset is 10 lakh rupees, but since 2 years is completed, I will not get exact value of 10 lakh rupees, correct? Some depreciation have to be done. This assumes a 20% depreciation you can charge. So just tell me 10 lakh, assume the useful life is 20% they have said, so 10 lakh into 20% into 2 years. I will get depreciation of how much? 4 lakhs I will get. But cost is 10. So written down value is how much? Book value 6 lakhs, which means what they are saying is your value is 8 lakh rupees, your loan value is 8 lakh. If you sell the asset, you will get only 6 lakh. Correct? Which means what is the loss which I am suffering? 2 lakh rupees is the loss. You have to create the provision for the 2 lakh rupees. You have to create the provision for the 2 lakh rupees. Okay? I have to calculate outstanding loan minus I have to find out net book value of the asset. Net book value of the asset, how I will get depreciation at the rate 20% I have to provide for completed years. Okay? One question is, in that question I will explain how to do that. And one more thing, this is general provision. In all cases, I have to provide this. Sometimes they will give additional provision also. Sir, additional provision I have to calculate based on overdue period. If the EMI is overdue for up to 12 months, there is no need for creating additional provision. But if it is more than 12, up to 24, 10% you have to create. More than 24, up to 36, this much. More than this much. More than this much I have to provide. And one more thing, this additional provision will be only applicable if overdue is there. Whether overdue is there or not, always I have to charge this general provision. Okay, general provision will be calculated in all cases. Additional provision only if default is there. Default also, if it is up to 12 months, no need of creating. More than 12 months, then only I have to create. Okay, now let us understand this question. So check this. Samveda is a non-banking finance company. It accepts public deposits and deals in, here they have given hire purchase business. Hire purchase business means we have to solve this question. Here it will be applicable. So see, it provides you with the following information. On 31st March 19, few machines were sold on hire purchase basis. The hire purchase price was set at how much? 100 lakhs as against cash price of 80 lakh rupees. Cash price is 80, but hire purchase price is how much? 100 lakhs. If I am a customer, if I want to purchase any asset, I will take the loan for that cash price. Correct? I will take the loan for cash price, which means I will take a loan of 80 lakhs. Repayment, including repayment, my total amount I have to pay will be 100 lakh rupees. Along with interest, higher purchase price I will get, which means it is around 100 lakh rupees. They are saying they will give me 80 lakhs loan. They will give me 80 lakhs loan, but what I have to do, the amount was payable as 20 lakh rupees down payment. 20 lakh rupees down payment I have to make, and the balance in how many installments? 5 equal installments I have to make. Again, they are saying the higher vendor have collected first installment on 31st March 20, but could not collect the second installment, which was due on 31st March 21. First installment the person have made. Second installment it is not collected, which means overdue is there. Second installment is due on which date? 31st March 21. Okay, first installment is already paid 31st March 20. What they are saying? The company was finalizing the accounts for the year 31st March 21 till 15th May 21. The date on which the board of directors, they have given some story, second installment is not collected. This one, IRR they have given, which is 10.42% is the IRR, which means I have to use this as discounting factor or amortization, whatever it is. Required. First one, they are saying what should be the principal outstanding on 1/4/20? 1/4/20, should the company recognize a finance charge for the year 2021 as income? And one more thing I want to explain, I think this you already know at your inter level. If there is any NPA, if there is any non-performing asset, I have to stop recording my income on accrual basis. I cannot recognize income on accrual basis. If it is non-performing, I have to start recording income on which basis? Cash basis. If I receive, then only I will record. Then only I will record the asset. If it is non-performing asset, if it is performing, I can record on the basis of accrual basis. Okay. So first one, they are asking us to calculate principal outstanding on 1/4/2020. So what we'll be doing is, let me calculate that part. So carefully check this. So see, loan taken is 80 lakh rupees. Repayment price is 100 lakh. Okay, but you have to pay totally 100 lakh rupees to that person. You are already paying 20 lakh rupees down payment. You are already paying 20 lakh rupees down payment, which means the balance part I have to pay 80 lakh rupees. In 5 installments they are saying, which means at each payment how much I have to make? 16 lakhs I have to make. Check the question on which date amortization, sorry, on which date outstanding amount they are asking. 1/4/2020 they are asking. Correct. I think they have calculated. Okay, do one thing. I think this is mistakenly given. This should be appearing in question number 4. Okay, this table should appear in question number 4. This solution have to appear. So you can write here question number 3 continuation. This amortization table is related to question number 3, but unfortunately it have come down. So this is question number 3 continuation. This is question number 4. This table is question number 4. Okay. So now understand. See, my initial loan amount outstanding is 80. I have to pay down payment of 20, which means my total closing outstanding amount will be how much? 60. 80 loan, 20 down payment I have to make, which means my initial outstanding amount is how much? 60. On this 60, what I will be doing is I will be calculating effective interest rate. 100 is higher purchase price. 100 is higher purchase price. I will take loan of only 80. I will take only loan of 80 and additionally I will take 20 lakh rupees down payment, which means from that 80 lakh only I will pay 20 lakh rupees down payment. Effectively, I have taken outstanding loan of 60 lakh rupees. So from this 60 lakh rupees only I will be calculating 10.42% effective interest. So just in your calculator type 60 into 10.42%. 60 into 10.42%, how much? 6.25 lakhs. Correct. And one more thing, I also have to make a repayment of how much? 16 lakh at the end of first year. At the end of year 1, I have to make 60 lakh rupees down. First installment I have to make. If you check the question, they are saying first installment is paid. The hire vendor collected the first installment on 31st March 20, but second installment he is unable to receive. Correct. Which means first installment, this is 16 he have received. So now do the calculation. 60 plus 6.25, 60 plus 6.25 minus 16, please do the calculation. 50.25 will become the closing outstanding amount. But if you observe carefully, this is 16 includes interest amount also. This 16 is installment amount, which means what? This 16 also includes interest amount also. Sir, if you observe carefully, out of this 16, if this 5.24, sorry, this one, out of the 16, if 6.25 is related to interest, can you tell me what is the principal repayment? 16 minus 6.25, if you do, you will be getting this 9.75 as principal repayment. Correct. Therefore, this 50.25 will become my closing outstanding loan. Closing outstanding loan will be this 50.25. If I also collected the second installment, then my closing outstanding amount will be this much, 39.49. But in the question, first point they are asking me to find out the closing balance on which date? 1st April 2020. 2020 means if you observe 31st March 2020 closing balance, 31st March 2020 closing balance 50.25 will become my opening balance as on 1st April 2020. 1st April 2020, this is my opening balance, which means 50.25 lakh. 50.25 lakh is nothing but my first installment, which is outstanding. Okay, first question is done. Second, they are asking, should the company recognize finance charge for the year 2021 as income? If you observe carefully, in 2021, no default is made. Correct? Default is made on which date? Second installment, that too on which date? 31st March 21. At that time also, it will not be become immediately non-performing. It have to stay in 3 months. 3 months it will be still called as performing. After completion of 3 months, then only it will be called as non-performing asset. Which means in this date on 1st April 2020, the asset is very well performing. Therefore, I have to recognize the interest income on accrual basis only. Okay, here they have clearly said that in the year ended 31st March 21, it is not received. However, it is due on 31st March 21 and therefore it will be still classified as standard asset. It will recognize its normal 5.24 lakh interest income included in that due installment only, which means first installment it will recognize the principal and interest income. It will be normally recording on accrual basis. Okay, this is the first point. Second point, if you observe, they are asking me to calculate net book value of the asset on 31st March 2021. So far, Samveda Limited is concerned as the NBFC prudential norms requirement for that provisioning. Here what they are saying is one more thing they are asking. First of all, can you tell me what is the date of purchase of the asset? Date of purchase of the asset, if you observe, 31st March 19. Correct. They are asking me to find net book value on which date? 31st March 21, which means how many years are expired? 2 years are expired. Net book value means how I will get? Total cost minus depreciation for those 2 years. Correct. Total cost is 80 lakhs minus depreciation for 2 years at the rate 20%. If you do, you will get this 32 lakh. You will get this 32. If you do 80 minus 32, you should get 48 lakh as your net book value. Net book value as on 31st March 21. 31st March 21 net book value, we have got 48 lakh rupees. Your institute will solve in different manner. But ultimately they have got 48 lakh only. Okay, so this is easiest method. You can directly take, here you can write cost of the asset minus depreciation for 2 years at the rate of 20%. Cost of the asset is 80. అది యాక్ట్లో ఉంటుంది ఎన్బిఎఫ్సి. ఓకే, క్వశ్చన్లో ఉంటుంది, యాక్ట్లో ఉంటుంది. Depreciation for 2 years at the rate 20% will be 32 lakhs right here only. So the difference amount will be net book value, which is nothing but 48 lakhs is my net book value. Okay, 48 lakh is my net book value. Last point they are asking, what should be the amount of provision to be made as per the prudential norms for NBFC laid down by RBI. Okay, first of all, right beside the question only, here default is not more than 12 months. Default is not more than 12 months. Hence, only general provision will be considered. We will consider only general provision in brackets. Specific provision will not be calculated. Sorry, it is 12 months, I think. Here you have to write 12 months. If default is not more than 12 months, hence only general provision in brackets, specific provision will not be created. Specific provision won't be created. Specific provision won't be created. Okay. Last step, what they have to calculate is general provision. We have to find out. Sir, general provision means General provision means copy the solution somewhere. General provision point. If you have space there at the question, so copy this part. General provision will be loan outstanding on this date minus net book value of the asset I have to calculate. So copy this somewhere. This is called as general provision. General provision to be made. Loan outstanding minus net book value I have to calculate, then I will get my general provision to be created. 7.49 lakhs I have to create. Okay, so carefully understand. Loan outstanding on 31st March 21. Stop it. Loan outstanding on 31st March 21. If you observe from the table, this is 31st March 21. Closing balance is 39.49. But here I have taken, how much we have taken in the solution? 55.49 we have taken. Sir, why we have taken that 55.49 is carefully understand. They have not repaid second installment. If they have repaid this installment, this will become my closing balance. But since they have not repaid this installment, 50.25 should be my normal principal amount. Plus on that interest will be calculated. Therefore, 50.25 plus 5.25 will become a total outstanding before receiving the second installment. Correct? If you add 50.25 and 5.25, how much you have got? Tell me. 50.25 and 5.24, how much? 55.49 you will get. From that value, I have to deduct net book value of the asset as on 31st March 21, which we have calculated in the above step. 31st March 21, loan amount is 48. Therefore, 7.49 lakh is the amount of provision which I have to create in this question. Specific provision is not required. Okay, because overdue is not more than 12 months. Okay, this is standard question. 99% they will ask that provision question, whatever first question we have studied. Rates only we have to remember. But this is one more question wherein you just have to remember net book value calculation, provision amount calculation. That's it. Other thing you will easily get from the amortization table only. Okay, this is also standard question, so which you should not miss. Generally, in last 5 attempts they have asked it. Last 4 out of 5 attempts they have asked it from financial instruments only. 1 attempt they have asked it NBFC question. That too, first question they have asked it provision question. Since 4 attempts are already completed, they may think that most of the students have ignored this chapter. Therefore, there is a chance that they can pick this provision question. If they ask financial instruments, already all questions we have covered in this chapter, financial instruments. Okay. So this financial instruments also we have did, NBFC also we have did. Now we will start with internal reconstruction chapter. Internal reconstruction theory I have written in business combination chapter only. So if you come at the end of the business combination, you will find that theory. Very short theory will be there. Concept number 14, page 102 if you check. Here only I have explained internal reconstruction. Easiest chapter. Internal reconstruction. Just open that. Okay, so one or two internal reconstruction. So let us check this. This internal reconstruction is also called as capital reduction, also called as capital reconstruction also. Okay, in your question they may give you capital reduction or internal reconstruction or even capital reconstruction also. Everything is same. Sir, here what will happen is, in your law, I think there is a concept which is called as compromises and arrangements. Most of the students will take this chapter as choice. I have also taken choice, but exam 25 marks I have asked from this only. Okay, but still. Compromise and arrangements, what will happen is, if the company is continuously getting losses, if the company's cash flows are negative from the past few years, company is continuously getting huge amount of losses, there what they will do is, they don't want to liquidate that company because they have been started the company with all too much of interest. They have started the company. Suddenly, since the company is getting losses, they will not directly liquidate. First, what they will do is, they will set up a meeting with creditors. They will include all the, for example, if any creditor, if any major amount of bank loans are there, they will call that bank persons also to that meeting, and every person will sit, and what they will do is, they will come to an agreement. Every creditor, for example, if there is any creditor whose balance is 50 lakh rupees, creditor, the company situation is not going good. So what we can do is, we cannot pay you total 50 lakh rupees. If you want, if you agree, if we can do any compromise, I will not do 40 lakh payment. I will do only 30 lakhs payment. One creditor will agree to this. And another, for example, bank loan is there. That bank loan amount is 1 crore rupees. But now, since the company is not performing well, we will not pay you this total amount of bank loan. So what we'll be doing is, we'll be paying only 70 lakh rupees. Which means, if you observe carefully, in this capital reduction or internal reconstruction, what will be done is, liabilities will be reduced. If my liabilities are reduced, it is like a profit for me. Correct? If your liability is being cancelled, it is just like a profit for me. Similarly, if equity shareholders are there, those equity shareholders have to do some sacrifice. Debenture holders have to do some sacrifice. Creditors also have to do some sacrifice. All these sacrifices, what I will be doing is, because of all these sacrifices, the company will be getting some profit. Those profit, what I will do, company is already having some losses. Correct? Huge accumulated balances are there. Debit balances of some items which are not written off. All these points are there. So what we are doing is, I will be using such balance to write off all those assets. I will be using such balance to write off fictitious asset if anything is there. From that fictitious asset, no, there is no benefit which I will be getting. So what I have to do, I have to write off that asset. In order to write off that asset, I should have some balance. I will get that balance through all these sacrifices. Okay, very simple journal entries easily you can get. Even if you don't know, minimum 5 marks you will get from this question. You may not get 7 out of 7 if you don't practice, but even if you don't know completely, still you can get 5 out of 7 easily. Okay, so let us carefully understand. First of all, companies with huge accumulated losses or fictitious assets, company have no option but to reduce its capital and other liabilities, and profit from such reduction will be used to write off such losses. And next what they will say, such reduction will be done by equity shareholders, preference shareholders, debenture holders or creditors, etc. See what we have to do. For example, one creditor is there. One creditor is there. Creditor balance is 50 lakh rupees. Now, that creditor have convinced and that creditor have said, okay, I will agree to accept only 30 lakh rupees payment. Which means, how much sacrifice that creditor have made, tell me? How much sacrifice that creditor have made? 20 lakhs he have made. Now tell me the journal entry. In my books of accounts, creditor balance is 50. Now I no need to pay 50. How much I no need to pay? 20 I no need to pay. I have to only pay 30, which means 20 I should not pay. Correct? Which means, if you want me to pass the journal entry, I will debit this creditor. Creditor account debit. I want to cancel this creditor of 20 lakhs. Will I write it to bank? I am not making payment. Therefore, I will transfer this to one temporary account which is called as a capital reduction account. This is called as capital reduction or internal reconstruction or internal reconstruction also. Anything, capital reconstruction also. Anything this can be called. Okay. I will write 20 lakhs here. One more thing can happen. One debenture holder is there. That debenture holder balance is 1 crore. He agreed to forego 20 lakh rupees. If he agreed to forego 20 lakh rupees, he wants to sacrifice this 20 lakh. If he wants to sacrifice this 20 lakh, what the entry which I have to pass, tell me. Debentures will be cancelled. Debenture is my liability. Liability I have to reduce. Therefore, I have to debit the debentures. How much? 20 lakhs. To capital reduction account at 20 lakhs. Like this, because of some sacrifices, my capital reduction balance will increase. Sir, what I have to do with that capital reduction balance? I will write off the useless assets from my balance sheet. If any fictitious assets, if any debit balance of P&L account, if any asset is there, from that asset I am not receiving any cash, all those assets will be written off. Okay, simply this is the concept of internal reconstruction. Let us directly check the journal entries. So carefully check this. This is the logic which you have to remember. If any asset increases, sometimes asset balance also may increase. I have did revaluation, because of which asset value may increase. Sometimes this can also happen. This can also happen. If asset balance is increases, tell me what journal entry I have to pass. Asset account should be debited. Credit, don't write OCI, don't write all those items. This will be transferred to internal reconstruction account, because I have revalued my asset only for the purpose of this internal reconstruction. This you have to understand. Second, sometimes asset balance can reduce also. If asset balance can reduce, I have to credit my asset. If asset is credited, debit, what I have to write? Capital reduction account debit I will write. Correct, simple. Liability also can happen. Sometimes my liability will decrease. If my liability decreases, what I have to do? I will debit the liability account debit. To what I have to write? Capital reduction account. Sometimes it may be possible that my liability will be increased. If your liability is increased, I have to debit capital reduction. And I will credit to liability account. After doing all the adjustments, if any capital reduction balance is still there, normally it should be exhausted completely. If any balance is there, that will be transferred to capital reserve account. That will be transferred to capital reserve account. Okay, this is the important point which you have to remember. Sir, how do I know how much balance is there in that capital reduction account? You can do from journal entries also, or if you want, you can prepare ledger also. Capital reduction account, even if you open this, whatever the closing balance which is there, the closing balance should be transferred to capital reserve account. Okay, last but not the least, this point you have to understand. Contingent liability, if they have given in the question, if contingent liability, first of all, I will not record in my books of accounts. I will just disclose that item in my notes to accounts. Correct. So if there is any contingent liability, if that liability is cancelled, first of all, I have not recorded that liability. If I have not recorded that liability, even if it is cancelled, I will not do anything. I will do adjustment if I have recorded, correct? Or at least I have to make some payment, then only I will pass the journal entry. If it is not recorded, plus I will not pay that amount also, it is already cancelled. Therefore, no entry will be made for that contingent liability. But because of that reduction, if I want to settle that contingent liability, there I have to make an adjustment. Because of that capital reduction, because of that internal reconstruction, if any liability I have to settle to bank, I have to write. I have to write because I have to make the payment. So I will credit the bank, and the debit, I will directly write capital reduction account debit. This is the very important point which you have to remember. Contingent liability, if it is foregone, no entry will be made. But if it is settled, then I will credit a bank. Capital reduction account debit to bank is what the journal entry which you have to remember. Okay. Now let us solve some questions. You will only directly say, by seeing the question, you can say that much easy chapter it is. So what we'll be doing is, first let us start with easy question. Let us start. Let us check this question number 30. Come to question number 30. Come to question number 30. So carefully understand this. What they are saying is ignore the balance sheet and directly come to the information what they are asking us to calculate. Okay. So if you read the question carefully, first one they are saying due to heavy losses and overvaluation of assets, the following scheme of internal reconstruction was framed. In that first point they have given preference shareholders would sacrifice how much 20% of their claim and they will be allotted 9% preference shares for the remaining amount. Understand carefully what you have to do. First check the balance sheet, how much preference shares are there, how much preference share capital is there. Check the balance sheet and tell me how much preference share capital is there. 8 lakh preference share capital, but it is how much? 8% preference share capital. 8% preference share capital is how much? 8 lakhs. Now, what is the terms of internal reconstruction? 20% will be sacrificed. And balance amount, what will be done? Balance amount, they will be showing new preference shares. Correct? So, entry what I have to pass is, see, first I have to cancel 8% preference share capital. Because 8% preference share capital will not be there in my balance sheet. That will be cancelled. Sir, how it is cancelled? 20%, which means 8 lakh into 20% will be transferred to capital reduction account. 8 lakh into 20% will be transferred to capital reduction account. Sir, balance preference shares, I am not making payment. What I am doing? I am issuing new preference shares. I am issuing new preference shares. Therefore, 8% preference share capital will be cancelled and I have to write 9% preference share capital. Like this, you have to close the journal entries. 8% PSC should be cancelled. Sir, I am not making payment in cash. Therefore, I will not write 2 bank. What I will write? 9% preference share capital. Whatever the amount which they are sacrificing, that sacrificed amount should be sitting in capital reduction account. Easy journal entry, nothing complicated. Okay. Let us read the second point. Let us read the second point. Read this. What is this? You have to tell me what it is. Two adjustments are there in the second point itself. Carefully think and tell me what we have to do. See, A class debenture holder is having a charge on plant and machinery of Uttarakhand factory. So A class debenture holder is taking Uttarakhand factory plant and machinery and he have settled. First check the balance sheet, sir. What is the value of A class debenture? 9 lakhs. Sir, what is the value of PPE of Uttarakhand factory? Understand? My asset is gone, liability is also gone. Asset is gone, liability is also gone. If both are at same amounts, the difference will not be coming. But here difference is there. Sir, my liability of 9 lakh is cancelled. But asset of 8 lakh 50,000 is only gone. What about that 50,000? Capital reduction. What about that 50,000? Capital reduction. Very good. So just check this journal entry. My total 8% debentures of 9 lakh will be cancelled. My asset of 8 lakh 50 will be gone. Balance amount will be transferred to capital reduction account. Okay. You may get a doubt, sir, why we are transferring this capital reduction? Because full settlement that person is done. They have given the word full settlement. Therefore, amount will be settled completely and balance, if there is any, that will be transferred to capital reduction account 50,000 rupees. Very important question, very important point. One more point is also there in that. One more point is also there. What is that? Unsecured debentures, what they are doing, 20% reduction and remaining amount is to be converted into 9% preference shares of 100 each. First of all, tell me what is the value of unsecured debentures? What they are saying, 20% they are sacrificing. If 20% is sacrificing, that 20,000 should be transferred to capital reduction account. How much balance is there? For that balance, what they are doing? 9% preference share capital. Correct? So check the journal entry. 10% BD, 10% BD ventures. Ravi, ఒకసారి వాటి నేమ్ చూడండి. Unsecured means in our books of accounts, this is a ledger name. So I have written 10% debentures account to capital reduction 20,000, 9% preference share capital 80,000. Very, very important point this also. Okay. Check the next point. This one. Trade creditors agree to take over the stock up to the value of 6,20,000. First check the trade creditors value. Check the trade creditors value in the balance sheet. Have they given? 6,20,000 is there. Main balance sheet they have given, not in notes. Main balance sheet they have given. 6,20,000 trade creditors have taken inventory of 6,20,000. Trade creditors of 6,20,000 have taken inventory of 6,20,000. First check what is the value of inventory. First check what is the value of inventory in the balance sheet. 13 lakh is there, but they have not taken total 13 lakhs. They have taken only 6,20,000. Balance inventory is still there. So my liability of 6,20,000 is cancelled. Trade creditors. Inventory is also 6,20,000 gone. So what is the entry which I have to pass? Trade payables account debit to inventory account 6,20,000 I have to pass. Very easy question. Okay, 6,20,000 will be debited, 6,20,000 will also be credited also. And check this point what we have to do. What we have to do with this fourth point. They are saying equity share capital. First of all, check equity shares. What is the paid up value of original? Original paid up value is how much? Original paid up value is how much? 10 is the original paid up value. Here they are saying paid up is reduced to 6. If paid up is reduced to 6, which means they are sacrificing how much? 4 rupees per share. How many number of shares are there totally? Which means I will debit my equity share capital and I will credit my capital reduction account. I will debit my equity share capital and I will credit my capital reduction account. But one more thing, sir, earlier the paid up value is 10. Earlier the paid up value is 10. But now I have to change that paid up to 6% paid up. Now I have to change that paid up to 6% paid up. So first what I will do, I will directly cancel the total amount of equity share capital. I will directly cancel the total 10 rupees paid up and I will newly record 6 rupees paid up. Tell me what is the total number of shares? 1,80,000 into 6 I will transfer to 6 rupees paid up account. Balance 4 rupees what? Capital reduction, because it is sacrificed. Balance 4 rupees, it is sacrificed capital reduction. Sir, if you understand carefully, sir, what will happen if the shareholders have reduced their paid up? What will happen means, first of all, earlier it is 10 rupees paid up. But now if they have reduced it to 6 rupees paid up, which means the value is what? 4 rupees unpaid amount is still there. Later, if the company wants any cash in future, the company will ask you that call amount, you have to pay that call. Which means you have sacrificed your portion. Earlier you were 10 rupees paid up, but now what is happening? 4 rupees is only paid up. Sorry, 6 rupees is paid up. Which means 4 rupees is sacrificed. Important point. Very, very important adjustment. You have to remember that. Okay. Next part. Read this. 60,000 was receivable against loans and advances. First check what is the value of loans and advances in the balance sheet. I think it is in assets. How much? 77,000. But how much you are receiving? Which means balance is 17,000 you will not receive. That is similar to sacrifice. Similar to sacrifice. It is asset. Asset I have to sacrifice. So what I will do? Capital reduction account to debit to loans and advances account. 17,000 I have to cancel. 17,000 I have to cancel. Capital reduction account to debit to loans and advances. 17,000 I have to calculate. I have to cancel 17,000. Check the next entry. Remaining stock. First of all, is there any remaining stock in the question? What is the total stock? Minus how much stock is taken over? Which means balance is 6 lakh 80,000. Just see 90% only you are getting, which means how much is loss? 10% is loss. Therefore, trade receivables and remaining stock, both items calculate 10%. We have to pass in single entry. If you want, you can pass separate entries also, but single entry is totally fine. See, trade receivables have to reduce by 1 lakh 20. Inventory have to be reduced by 68,000. So total 1 lakh 88 should be given in capital reduction account. Net effect I have to give in capital reduction account. Okay, easy point. Nothing is complicated. And one more thing, they have said directors would forego their loan in full. First, check the balance sheet. Is there any loan from director? Is there any loan from director? 1 lakh 15,000. Is it liability or asset? Liability cancel means what is the entry? Loan from directors will be debited, capital reduction will be credited. So loan from directors account debit to capital reduction account 1,15,000. I will close my loan from directors amount also. Okay. Last point. Check the last point. Patents, copyrights, goodwill have no value. Therefore, I have to cancel all those items. Check the balance sheet. What is the patent? What is the copyright? Goodwill. Read next. Debit balance of P&L account means P&L account is having debit balance. Now I have to cancel, which means I will credit that balance. Correct. So I can write it to P&L or retained earnings because it is not current year. It may be related to previous years. Therefore, I have written retained earnings. If you are assuming it is related to current year, you can even write P&L account also. Take the total. 60, 35, 7 lakh 18,000. How much? 8 lakh 13,000 will be transferred to capital reduction account. 8 lakh 13,000 I will transfer to capital reduction account. Sorry? Because that balance may contains opening balance. One more thing here, if you observe carefully in the balance sheet, check other equity is there. This is subtracted, which means it is losses. Correct? One more thing also you have to check. If in the balance sheet, if they have given debit balance of P&L account, that should be cancelled. Okay? Debit balance of P&L account, which means it is from over. The purpose of internal reconstruction itself is to set off those losses. Okay? I think the point is already there in concept book also. So check this part. Here I have written capital reduction will be utilized to write off the following assets. Okay, you can write here, even if not asked in the question, we have to follow this. Even if not asked in question, still we have to write off all these items. Still we have to write off all these items. Okay. And one more thing. After doing all the adjustments, you have to close this capital reduction balance also. Okay, ultimately, if it is having debit balance, still I have to close. Even if it is having credit balance also, still I have to close, and the balance will be transferred to capital reserve account. Okay, if you want to find out this amount correctly, I recommend you to prepare capital reduction account. You can do like that also, or you can do separately also. See, separately means what? Here, capital reduction of 1,60,000 is credited. Here 50 is credited, 20 is credited. Like this, we have to take all the credits and all the debits. If you subtract, you will get the closing balance of the capital reduction account. Okay. And next, one more question we will solve, and then we will stop. One last question we will solve. Let us check this question 31. Let us solve this question number 31. Okay. So if you check carefully, let us read. Directly, let us check the points, because balance sheet we can read from the points. Which point is necessary, we will directly read that point only. So check this. The following scheme of internal reconstruction was framed, approved by the court and all the concerned parties and implemented. Okay. Read the first point, what they are saying. Read the first point. Preference shares are written down to 25 each and equity shares to 5 each. Again, they are saying each class of shares are then to be converted into shares of 100 each. First check the what is the paid up value in the question. Balance sheet we have to check. Balance sheet, what they have given, equity share capital 35. I think 20 is the equity, 15 is the preference share. Correct? Sir, the value of, see, you can change this, it is 20,000 equity shares. It is not 20 lakh equity shares. So please make this correction. 20,000 equity shares of 100 each. Okay? 20,000 equity shares of 100 each. Here I will get a 20 lakh. Preference share capital, I have got 15 lakh rupees. Okay? Now what have happened is, sir, here initially each share value is 100 rupees, paid up value. What they have did is, first they have written down to 25 each. Preference shares also same thing. Equity shares, what they have did, they have reduced it to 5 rupees each. Correct? Which means, sir, in case of preference shares, if I have reduced it to 25, how much amount is sacrificed? 75 is sacrificed. Similarly, in case of equity shares, sir, if reduce it to 5 rupees, how much amount is sacrificed? 95 rupees is sacrificed, because the value is 100. Each share value is 100. So first understand this journal entry first. Understand this journal entry first. First 8% preference share capital 100 will be cancelled, and 8% preference share capital 25 will be issued. Balance amount will be directly transferred to capital reduction account. Reconstruction or capital reduction, whatever you can call it. It will be transferred to this account. Okay. One more thing. Equity shares also same treatment I have to pass. What I will have to write? Equity share capital account 100. To equity share capital of 5. To reconstruction 19 lakhs. This 19 lakh, how I have got 2 lakh rupees into 19, I have to write 95. 2 lakh into 95 I have to write. If I write 2 lakh into 95, it will be 19 lakhs. 20,000 into 95. 20,000 number of shares into 95. If I do, I should get 19 lakhs. That balance 1 lakh rupees is nothing but the new equity shares which I have issued right now. But again, they have did some adjustment. Again, they are saying each class of shares are then again to be converted into 100 rupees each. Which means what they have did is, sir, here my new value is 3,75,000, but here the value is only 25. Amount is not changed, but this value is changed. Which means what I will write, see the journal entry, 8% preference share capital, 25 will be cancelled. 8% preference share capital, 100 will be issued. Amount will not change. Amount will be same. Internal values are changed. Paid up values they have changed, or face values they have changed. Same with equity share capital also. Equity share capital 5 will be cancelled. Equity share capital 5 will be cancelled, and equity share capital 100 will be issued. Two entries we have to pass, because they have entered this transaction in two cases. Okay, first I have to change the old face value to 25 in case of preference, 5 in case of equity. Again, with this increased amount, with this changed amount, I have again converted into, what should I say, 100 rupees paid up of preference share capital and 5 rupees paid up, 100 rupees paid up of equity share capital. Okay, important point. Two adjustments I have to do in this question. Rest of the question is very simple. So please check this question number 2, point number 2. They are saying the B class debenture holders decided to take over assets of Karnataka factory at a valuation of 7,50,000 in a part repayment of their holdings. First check the question. Sir, what is the value of B class debenture holders? B class debenture holders how much? 10 lakhs. Huh? Now, sir, what those debenture holders have taken? They have taken Karnataka factory. Sir, first check what is the value of Karnataka factory. Karnataka factory is 20 lakhs, but how much they have taken? 7 lakh 50,000. They have taken total factory, but at a value of 7 lakh 50, which means first of all that building value is lost. Correct? That factory value is, I think I have to pass one entry like this: capital reduction account debit. Two, Karnataka factory, assets of Karnataka factory. How much I have to write first? 12 lakh 50 is the loss. First I have to record that loss. So first I will record 12 lakh 50. After that, what I have to do, tell me? Debentures I have to cancel. This asset also I have to cancel. Correct? So debentures, how much I have to cancel, tell me? 7 lakh 50 only cancel, because it is not full settlement. It is with settlement? Part settlement. Which means balance amount will be paid later. Okay, in last question they have given full settlement, therefore I have cancelled the total amount. But here those B class debenture holders total value is 10 lakh, but they have agreed to cancel only 7 lakh 50,000 debt only. Okay, therefore this is the entry which you have to observe carefully. So check here, first of all, reconstruction account debit to PP of Karnataka factory 12 lakh 50 I have to pass. One more entry, 9% B debentures account debit to PP of Karnataka factory. One more thing I have to pass. Okay. Next 2 points are very simple. Let us quickly cover those 2 points also. So check this part. Debenture holders agreed to waive accrued interest in full. Check the balance sheet and tell me what is the accrued interest. What is the accrued interest in the balance sheet? Is it liability or asset? If it is liability, I have to cancel that liability. So what is the entry? Accrued interest account debit to capital reduction account. Correct? I think they have passed the same entry. Accrued interest account debit to capital reduction or reconstruction, where anything is fine. And now check this last one, what they are saying. Last 2 points, I will only pass one combined entry. Stock of 50,000 is reduced. 12. అంతే ఫ్యూచర్లో చేస్తారు, లైబిలిటీ అలా ఉంచేసారు. Capital reduction. Tell me this 2 points, what is the journal entry? Stock 50, debtors 12,500, profit and loss account balance also I have to remove, trademarks also I have to cancel, goodwill also I have to cancel. Everything in a single entry I will do. Check this journal entry. Check this journal entry. Check this journal entry. All these assets. Profit and loss account, I think the balance is 16,35,000. Provision for doubtful, inventories, goodwill, trademarks. Here what they have did is reconstruction balance also they have cancelled here only. Which means closing balance is there now. Closing balance of capital reconstruction also they have cancelled here only. Okay, so that is the reason we have got the difference. But otherwise this is fine. This capital reserve generally I will transfer in new asset. New entry I will cancel, but here they have cancelled here only, but totally fine. We can write. Differential figure will be transferred to capital reserve account. Okay. Simple question. So with this, we have also covered internal reconstruction chapter also. If you want to solve any other questions in this, or some 2 to 3 questions are also there here. Those 3 questions are already there in marathon. So if you have time, you can watch those. Otherwise, in this EO batch, this internal reconstruction chapter is also completed. We just have to practice these questions. Easily we'll get full out of full marks in this chapter. Okay. So that's it. We have completed internal reconstruction also. Afternoon, we will start with business combination. Okay. So that's it. We'll start at afternoon post lunch. Time is 1:07. We'll start at 2:15. Okay. We'll start at 2:15. ఈరోజేనా నాకు చిన్న పని ఉందిలే, నేను రేపు వస్తా. నువ్వు వెళ్తే వెళ్ళిపో సార్. Okay. So next chapter we will start is business combinations. In days 103 we will start. అది ఎందుకు అక్కడ స్పేస్ వస్తుంది అంతేనా? For 2 hours mindset. Okay. So in days 103 business combinations. Okay. See. Normally, if you purchased any asset, that is called as asset acquisition. And if you purchase any asset, the entry which I will be passing in my books of accounts is asset account debit to bank account. Correct? That is the normal entry which we have to pass. Similarly, if you purchase any business, here what we are doing is we are not purchasing any individual asset of the company. We are directly purchasing total entity itself. Okay, which means the major crux of this standard lies around the word which is called as control. If one entity have taken the control of another entity, it is said that business combination have taken place. Let us take few examples to understand what exactly is the concept of this business acquisition, business combination. So carefully understand this. Two companies are there, company A and company B. Company A have acquired company B. Company B means total company B it have acquired. See, in two types this control can be acquired. First way is, for example, let us assume A Limited and B Limited both are there. If A Limited wants to purchase this B Limited, one option is it can purchase shares of B Limited. Correct? This option is there. Shares of B Limited can be purchased. And one more option is there. Instead of purchasing the shares of B Limited, if A Limited wants, it can directly purchase the B Limited, which means it can directly purchase the net assets of B Limited. Second option is also there. In first option, if you observe carefully, A Limited will just acquire shares of B Limited. After this business combination, A Limited also will continue, B Limited also will continue, which means both will continue after this business combination also. Second type of acquisition, if you carefully observe, here this A Limited is not purchasing the shares of B Limited. A Limited is directly taking over this B Limited business. Total business is taken over by this A Limited only, which means after business acquisition, this B Limited ceases to exist, which means it will be closed. All the assets and liabilities of B Limited will be taken over by this A Limited. Whatever it is, all types of combinations are covered in this standard only, but ultimately one thing you have to check, which is nothing but control. Control should be transferred. It is said that business combination have taken place only when control of B Limited is taken over by this A Limited. If you observe carefully, the company which is acquiring is called as acquirer company, and other company, this B Limited, is called as acquiree company. Total Ind AS 103 is applicable in the books of A Limited, which is acquirer books. Acquirer, what he have to do, the total accounting is applicable in this standard Ind AS 103. Okay, and one more thing. Let us discuss some two very small examples to understand the concept. Company A have purchased a company B by paying some consideration of 1,000 lakh rupees. This 1,000 lakh is also called as purchase consideration. The consideration which it is paid to purchase the company of B, it is called as purchase consideration. It have paid 1,000 lakh rupees. If I observe the balance sheet of company B, it is having assets of 1,200, share capital 800, liabilities 400. What I have to do is, After this business combination gets happened, what I have to calculate is I will directly record the assets and the liabilities, which means I will directly take over this company B. All the assets of B I will record in my books of accounts. Similarly, all the liabilities of B also I will record in my books of accounts, and all these adjustments will be made while preparing consolidated financial statements. Okay, I will show you that chart also, don't worry. But first let us understand what will happen in separate financial statements. Separate financial statements, if you observe carefully, PC paid 1000 lakh rupees for company A. It is normal investment purchase. What is the entry which it will pass? Investment in company B account debit or consideration account debit to bank account. How much they are paying? 1000 lakhs they are paying. This is the entry which they will pass in their separate financial statements. One more statements this entity have to prepare, which is nothing but consolidated financial statements. While preparing those consolidated financial statements, I will assume company A and company B both are same. Since this company B is controlled by company A, company B is not a separate person. Legally they are separate, but from accounting perspective, if I check substance over the form, company B and company A both are same only. If both are same, assets of B are assets of A, liabilities of B or liabilities of A, except share capital. I will explain about this share capital also, but please little bit you have to wait. Here what will happen is, if you observe carefully, what are the total assets of company B? 1200. What are the total liabilities of company B? 400. If you tell me what is the net assets, 1200 minus 400, how much it is? 800 is the net assets. But I am not paying 800. How much I am paying? 1000 lakhs I am paying, which means I am paying extra. Why I am paying extra? Because it is called as goodwill. This is not self-generated goodwill. This is purchased goodwill. Therefore, I have to record this goodwill in my books of accounts. Correct? So, in consolidated financial statements, what I will be doing is, carefully understand. In SFS, I will pass this entry. Correct? In SFS, I will pass this entry. But if you observe, if both are same, if company A and company B both are same, how can company A invest itself in company A? Now both are same. Therefore, company B is not a separate entity. How come one entity invest in himself? Therefore, the first thing which I have to do is I have to cancel this investment. Because both are same, I cannot invest in myself. Therefore, while preparing consolidated financial statements, the first thing I have to do is I have to cancel this investment in company account to debit. It is having debit balance. If I want to cancel, what I have to do? I will credit to consideration or investment, like this I have to calculate. What I will be doing is all assets of company B will be recorded in the books of company A. Therefore, I will record assets account debit at 1200. Assets account debit 1200 I will record. At the time of taking the assets, you also have to take over liabilities also. Which means what? Two liabilities, 400 also I have to record. Carefully understand, assets 1200, consideration 1000, liabilities 1400. Take the credit side total. Credit side total is 1400, but debit side how much is there? 1200 is only there. Something I have to write. How much I have to write? 200, and that 200 is nothing but goodwill. This 200 is nothing but what? Goodwill. Okay, so combined entry what I have to pass is assets account debit, goodwill account debit to consideration or investment in company B account. This is very important. You have to understand why you are cancelling this, because both are same. One cannot invest in himself. Therefore, I have to cancel this investment in company B account debit 1000 lakh rupees. Okay, simple entry. Here in the statement form also we have to calculate calculation of goodwill or gain on bargain purchase. I have to compare two items. First item, purchase consideration. I have to compare this purchase consideration with what? Net assets. Net assets, how you will get? Total assets minus outside liabilities I have to calculate. Correct? Simple example, very basic example. And one more example you will solve, little bit advanced example. Here what I will be doing is, instead of giving total assets, I have given separate assets. Instead of giving total assets, I have given separate assets. And one more values also I have introduced, which is nothing but fair values in this question. Let us continue. Company A acquired company B for 1000 lakh only. But company B balance sheet, see, company A figures as it is I have to take. Company A figures, there are no changes. But along with company A figures, I also have to take a company B figures also. In this company B, if they have specifically given book values and fair values both, if they have given book values and fair values both, always remember all indices love this word called as fair values. What is more accurate? See, at the time of initially onwards, this company B is maintaining all these book values. But on the date of acquisition, if fair values are separately given, we have to consider these fair values only because these are more accurate. Correct? So standard is also saying the same thing. Standard is saying while taking over all the assets and liabilities of acquiree company, I have to ignore book values. I have to take over at what values? Fair values. If fair value is not given, I can consider both are same. I can consider book value equals to fair value. But if they have specifically given fair value, I have to consider that fair value only. Okay, one more thing. In SFS, we don't need all this information. In SFS, only single entry I have to pass. What is that single entry? Investment in B limited account debit or consideration account debit to bank account 1000. This is the SFS entry. But CFS, SFS means separate financial statements, single financial statements. CFS means consolidated financial statements, and what I have to do means I have to calculate something which is called as goodwill. First, I have to calculate goodwill. Correct, sir? How you will get goodwill? I have to compare two items. What are those two items? Purchase consideration. Second item, net assets. Another name for this net assets is identifiable net assets. Whatever the net assets which I am able to identify from the date of acquisition, I have to calculate all those identifiable net assets. Please check how many assets we are having. 4 assets. Should I take fair values or do I have to take book values? Fair values. Take the fair value of assets. Take the fair value of assets. How much? Minus this liability fair value also. Correct. 1000 is my PCE. 630 is my net assets. Can you tell me what is my goodwill? 370 lakhs. Is it rupees in lakhs? So 370 lakhs I have got. Correct. Now I have to pass journal entry. Correct. Use your minds and tell me, sir, what is the journal entry which I have to pass? In CFS. I want in CFS. Tell me one by one assets we have to tell. Land account debit, how much? 300. Plant account debit, 350. Inventory account debit, 180. Cash account debit, 100. One more thing. Goodwill also I have to get. Goodwill how much? 370. Two what I have to write? Liabilities 300. And one more thing. Investment also have to be cancelled. Therefore, investment in B limited or consideration. Your institute uses the word consideration, so let us stick to this word consideration. In business combination, they will use this word consideration. Okay, so let us write the same entry to consideration or investment in company B 1000. Is it matching? Please check. Entry have to match ultimately. Okay. Just because in 2 examples we have got goodwill, don't assume always we will only get goodwill. Sometimes it is not necessary always you have to pay extra amount. Correct. Sometimes my net assets are more. My net assets are more, but my consideration is less. Like this also can happen. Very good. So let us check this question. Company A have acquired the company B for same 1000 lakh rupees. But check the balance sheet and tell me what are the net assets of company B. Check the balance sheet and tell me what are the net assets of company B. Very good, 1600. But how much PC I am making? 1000 lakh. Tell me the journal entry in SFS. Consideration to bank. I won't write 1600. All these net assets in CFS. SFS, I have purchased investment. That's it. Investment in company B account debit to bank account. 1000 lakhs. But when it comes to CFS, I also want all these assets. Assets account debit, how much I will take? 2000. Two liabilities. 200. Goodwill. Here I will not get goodwill. Here I will not get goodwill. I have to cancel investment. To investment, I will write 1000. Credit side, 600 is coming less. That 600 is called as gain on bargain purchase account. This can be, you can write this amount in capital reserve account. Gain on bargain purchase, later that amount can be transferred in capital reserve. Okay, simple calculation. Till now, nothing is complicated. And one more thing. In all the questions, whatever we have discussed, 3 examples, I have made 100% acquisition. 100% acquisition I have made. But if you want to control, it is not necessary to purchase total 100%. Control can be acquired even if you just hold 51% also. Correct? So now what we have to understand is, sir, this time A Limited is not purchasing 100% of B Limited. A Limited, let us assume only it is purchasing 60% of B Limited. Now carefully understand. In SFS, no change in accounting. SFS, one entry, investment in B account debit to bank. That doesn't know whether you are purchasing 60%, whether you are purchasing 70%, whether you are 100% purchasing also. Same entry I have to pass in SFS. But CFS, if you observe, carefully think and tell me, sir, if this A Limited is having control in B Limited, if this A Limited is having 60% shareholding of B Limited, can I say that this A Limited is totally controlling the B Limited? Or do I have to say only it is controlling 60% of B Limited? Think carefully and tell me. If any situation comes, they have to go by voting. If they have to go by voting, it is not necessary you should hold 100%. Even if you have 60%, you are having control, which means 100% is not required to control total business. 60% is enough to control the total business. Any decision, if all the shareholders have said A Limited is only having the majority stake, even if other shareholders are saying no, if this A Limited says yes, it will only prevail. It will only prevail. Therefore, even though I am only having 60%, I am controlling total B Limited. If you are controlling total B Limited, while bringing assets and liabilities of B Limited, I have to bring total assets, not 60%. What I have, because I am controlling total B Limited. Therefore, what I have to do, assets account to debit, total 100% of assets I will take. To liabilities also I will take 100%. Liabilities also I will take 100%. But you should get one doubt. Assets I am taking 100%. But investment I have made only 60%. How can I compare both? It is not possible. Therefore, they have introduced one concept which is called as NCI. NCI means these people are not having control, but they are also shareholders. See, 100% of assets means out of this 100%, 60% assets belong to A Limited. 40% assets, I'm not saying control, assets I am saying. 40% net assets belong to which persons? Other shareholders. Those other shareholders are called as NCI, non-controlling interest. Very simple. If A Limited is holding 60%, tell me what does NCI holds? 40%. If A Limited is having 80, NCI holds 20%. Correct? Simple calculations. Let us take this example. A Limited is holding 70% for 1 crore. 70% it have purchased for 1 crore rupees. Net assets are 1 crore 20 lakhs. Net assets are 1 crore 20 lakhs. If you observe carefully, in the question they will give you NCI value. If they have not given, they will give you hints as to how to calculate. Some methods are there to calculate that NCI, but those are very common sense methods. Okay, we will understand all those things. But if they have given something in the question, I will take that directly. Here they have given NCI value on which date? Date of acquisition, most important. Whatever Ind AS 103 I am discussing, everything will be calculated, everything will be done in the date of acquisition. On the date of acquisition, we have to do all these calculations. Okay. Similarly, they have given 30 lakhs. SFS, no changes. SFS only one entry, investment in B account debit to bank or consideration. How much you are paying? 1 crore you are paying. That will not change. But one thing you have to do the calculation, one thing you have to compare the difference. While calculating goodwill or GBP, first forget about this NCA. Forget about this NCA. Normally what I have to write? Purchase consideration I will write. This PC should be compared with what? Identifiable net assets. Will I take 100% of net assets or will I take only 60% of net assets? Net assets I will take 100%. Subsidiaries company, I am getting total control. Therefore, I will incorporate 100% of the assets and liabilities of subsidiary company. Here, I will record 100% of identifiable net assets. But how much, for how much stake I am paying this PC? 70%. In this question, 70. 100 is the total value of assets, but I am purchasing only for 70%. Both are not comparing. Correct. So what I have to do, I have to insert something which is called as NCI. If I add this NCI also, my PC is for 70%, my NCI is for 30%, therefore it is for total 100%. 100% of PC I can compare for 100% of net assets. This is correct goodwill or GBP. Correct? Simple. I have to calculate 100% of consideration for 100% of net assets. Differential figure can be either goodwill or gain on bargain purchase. This is the statement form. Now I have to present this in the form of journal entry. Think and tell me what should be the journal entry. What should be the journal entry? Think and tell me. Assets will be debited. Here they have not given individual assets. They have given identifiable net assets. It includes liabilities also. So what I will write? Identifiable net assets account to debit. Carefully understand what I'm writing. Identifiable net assets account to debit. How much I have to write? 120 lakhs. 120 lakhs. Very good. Goodwill also I have to write 10 lakhs. Next up. Consideration also I will write. How much is the consideration? Last item. My entry will not tally because I have recorded only 70% of consideration, but I have taken 100% of net assets. Therefore, what I have to write? To NCI 30 I have to write. Correct? Now cross check, is the entry matching or not? Yes. Debit 130, credit also 130. Like this we have to do the matching. Okay? Now we know what to do if there is NCI. How to calculate goodwill also. Basic steps we have understood. In order to calculate goodwill, I have to calculate two amounts. What are those two amounts? Purchase consideration. NCI also I want. If it is not 100% holding. NCI also I want. One more thing I want. What is that? Net assets. Identifiable net assets also I want. Correct? Now what we'll be doing is come to concept book. First come to this chart, page number 108. Page 108. Okay, see. There is interlinking between Ind AS 103 and Ind AS 110. 110 means which standard? Consolidated financial statements. 103 means business combination. Understand the interlinking between those two things. Business combination also they will say some consolidation. Business combination also I have to prepare CFS. Consolidation chapter, the purpose is to prepare consolidated financial statements only. In both we have to prepare CFS. So what is the interlinking? Let us try to understand first. If one company invests in another company, if the shareholding is less than 20%, can I say that control is transferred? Answer is no. If you want to control, how much you have to purchase? More than 50 you have to purchase, correct? At least 51% you should have. Therefore, if it is less than 20%, you are not having any control. In order to even get significant influence also, I should hold more than 20%. But if it is less than 20, I am not having any control. I am not having any significant influence also. This is a normal investment. This is a normal investment. Okay. So here, if it is normal investment, I have to follow Ind AS 109. Ind AS 109 means financial instruments. In that it is a financial asset, investment in equity. I have to classify either as FVTPL or FVTOCI. That is as per Ind AS 109. Okay. Simply we have to pass only single entry. Investment in shares account debit to bank account. That's it. So here what they have given, it will only prepare SFS. It will not prepare consolidated financial statements. Okay. I will explain, sir, why we have to prepare this consolidated financial statements also. I will explain. Don't worry. Sir, I am having control more, greater than or equal to 20%, but less than 50%, which means I have purchased it 30%. Still, I am not getting control, but some influence I can show in that company. Correct. So what the standard is saying is here also you have to prepare two set of financial statements. Here also you have to prepare two set of financial statements. One set of financial statements is SFS as per Ind AS 27. Another set of financial statements also you have to prepare, which is nothing but Ind AS 28. They will show equity method. This is also one type of consolidation, but it is limited consolidation, which means I will not do assets, all assets I will not add. Line to line consolidation I will not do. I will only do limited consolidation. But this is most important. This only they are going to ask in your exam. If I am having more than 50%, other company is called as my subsidiary company. Investee company will be called as my subsidiary company, correct? It will prepare two sets of financial statements. Sir, how many set of financial statements it will prepare? Two sets. First one SFS, second one CFS. This CFS also, it have to prepare on the starting day of acquisition. While preparing on the date of acquisition, I have to follow Ind AS 103. On the date of acquisition, I have to follow Ind AS 103. But date of acquisition will be completed. Subsequently, every year 31st March will come. Parent company will do its own business. Subsidiary company also will do its own business. Assets and liabilities of subsidiary company will change. Parent company also will change. Therefore, it is not one-time consolidation which I have to do. On the date of acquisition, anyway, I have to do the consolidation, but each reporting period also, my figures will change. Therefore, I have to do consolidation at each reporting period. 31st March of all periods after date of acquisition, I have to follow Ind AS 110. But on the date of acquisition, what I have to follow? Ind AS 103. All these standards will be applicable only for the preparation of CFS. SFS, nothing is there. Single entry, investment to bank, that's it. But CFS on the date of acquisition, which standard I have to prepare? 103. On each reporting period, which standard I have to prepare? 110. These calculations you have to understand. Okay. And one more thing. The purpose of preparing CFS is to show your status to the public. If one person, let us assume he have purchased 60% shares of Geo Limited, no one will believe if he says that. For example, suddenly today, if I purchase at 60% of Geo Limited, if I say to anyone, no one will ever believe that. Correct? So in order to prove them, what I have to do, I have to prepare something which is called as consolidated financial statements. Okay, let us assume you have purchased one new brand BMW car. You have purchased brand new BMW car. Then what you will do? You will keep statuses. Correct? You want to show to the total public that you are having one BMW. On the date of purchase also you will keep status. On the date of purchase also you will keep status. While holding the key of that car, you will keep one status. And every reporting period, for example, see, on the date of acquisition, you have kept the status. After that, you have stopped keeping the status. Then public will forget that you are the owner of the car. Therefore, every year you have to prove to them that I am only the owner, I am only the owner. Like this, you have to prove. Correct? So, while doing some long journeys and all, again, I have to keep some status to showcase to the public that still I am only the owner. Correct? In the same manner, CFS also, it is not one-time exercise. Date of acquisition, definitely we have to prepare, but both are different also. I cannot keep the photo of me receiving the key every year. If I keep like that also, it will become boring. Correct? So every year what I have to do, I have to keep new statuses. Correct? Similarly, this consolidation also, each reporting period I have to follow 110. Date of acquisition I have to follow 103. Okay, fine. Now, let us directly start with what are the steps we have to follow in approaching this business combination question. Quickly come to page number 93. Here the steps are there. 8 steps totally we have to prepare. Okay, so let us understand. Step number 1, see, this business combination question will comes from 14 marks. 8C question also, sometimes they will ask business combination only, but sometimes they will ask consolidation. So whatever I'm trying to say is, out of these 8 steps, at least even if you attempt 5 steps also, worst case they will give you 5 marks. Worst case they will give you 5 marks. Even if you don't know anything, still you can attempt some of the steps. But for example, if you are preparing 2A, 2B question, if something unexpected comes from the standards, you cannot even attempt that question also. But these kind of questions, you may not be able to complete the total question, but at least you will get step marking, because this chapter and consolidation, both chapters, what I have did is I have classified into some standard steps. Even if you don't know anything, even if you don't know the complete question also, still if you do some steps, at least they will give 3 marks. At least they will give 4 marks. I have seen most of the students mark list who have got 38 last time, CFR. None of the students have attempted this business combination or consolidation. And one more thing, starting only I have said that most of the students who are doing CA or CMA parallelly, every person will clear CMA, especially CFR, because he won't take these 2 questions as choice. Okay. Now I am not saying if you just listen now also, still you can properly get some good marks, but at least out of these 2 questions, you have to prepare 1 question. Both questions may not be possible, but prepare any 1 question perfectly. Any question you can select. It can be CFS or business combination. Both are interlinked. If you select both also, if you practice well, then easily you can get 70 plus score. But if you are not having time, I recommend you not to prepare for both, but at least 1 question you have to prepare. All exam questions also we have to solve. Okay. So fine. Step marking is there. That's why even if any question is completely out of the syllabus, at least you can write some steps and you can come. But best part is this business combination, they will not ask any new questions, because whatever the questions which they wanted to ask, they have already asked in the past, or they have to copy paste from ICMAI. Okay, these things only they have to do. All the questions, all the toughest questions I have already asked in your past attempts only, which means again repeated question only is going to get asked. In your recent MTP also they have asked one repeated question only, which means high chances only repeated questions, that too limited questions will be asked from this chapter. Okay, but still even if any new question comes also, with these steps we can easily attempt those questions. What is the first step we have to calculate? Tell me. We have to identify the acquirer company. Acquirer company, very simple. Generally, who is paying the purchase consideration, that person will be called as acquirer company. Correct? One exception is there. That exception is reverse acquisition. In reverse acquisition, what we have to do, let us slowly understand. But normally, if I am purchasing 80%, obviously I will be the acquirer. Correct? So normally, who is paying the PC, that person will be called as acquirer. Second thing, what is that? Tell me. Determining the date of acquisition. Sir, what is the purpose of this date of acquisition? Is on this date only I have to apply Ind AS 103. PC also I have to calculate on this date. Net assets also I have to calculate on the date of acquisition. Goodwill also I have to calculate on the date of acquisition, which means everything will be calculated on the date of acquisition only. Okay, now I have one doubt, you have to tell me. A Limited have purchased 30% of shares in B Limited on 1st April 2021. Is control transferred on 1st April only? I'm talking about control. Is control transferred on 1st April? Answer is no, because what is the shareholding? 30%. With 30%, anybody cannot get the control. Correct? Now what have happened is, next year, it have purchased another 10%. Is control of B Limited transferred to A Limited? Again, no. One more date, next year, 1/4/23, it have purchased plus 20%. Now tell me, is control transferred or not? On which date the control is transferred? On this date, I have to prepare CFS. On this date only, control is transferred. On this date only, I have to apply Ind AS 103. But understand, in this case, initially I have purchased a 30% stake. Later I have purchased a 10% more. Later I have purchased a 20% more, which means control is not acquired on a single date. Correct? Control is acquired through a series of investments, which means not in a single date I have not made the purchase. One day, next day, like this I have made the purchase. Here what I have to say is date of control will be such date on which cumulative shareholding exceeds 50%. Cumulative shareholding I have to calculate on the date which the cumulative shareholding is more than 50%. That date I have to consider as date of control. Sorry, date of acquisition. Okay, very simple calculation, very important also. This is most favorite question. This is called as step up acquisition, and questions are also there based on that concept. They are going to test this because I think last 4 attempts back or 3 attempts back, they have asked the question step up acquisition, which means there are high chances that may able to ask that question. Okay, second question is fine. We have to determine the date of acquisition. Next is step number 3. What is this step number 3? Purchase consideration I have to find out. Okay, purchase consideration means, always remember, whatever the consideration which is payable to equity shareholders of the company. If they have given any consideration which is payable to debenture holders, that is not PC. If they have given any consideration which is payable to preference shareholders, that is also not PC. So consideration means only that amount which is payable to equity shareholders of the company. Okay, that is third point. Step number 3, I have to find out PC. Step 4, what I have to find out? Everything is written here, don't worry. I'm just explaining the brief, everything is down. Okay, step 4, what I have to do? I have to identify the net assets taken over by the acquirer company. This also I have to find out on the date of acquisition only. Okay, and one more step. What is the next step? NCI calculation on the date of acquisition. Next step, calculation of goodwill or gain on bargain purchase on the date of acquisition. Okay, understand. Step number 7, what we have to do? Journal entry we have to write for business combination on the date of acquisition by acquired company. See, the question is for 14 marks. Question is for 14 marks. Ideally, 14 marks question means they have to ask this consolidated balance sheet also, but sometimes they will not ask this consolidated balance sheet. Still, the question is for 14 marks. As a student, you have to tell me, sir, if the question is for 14 marks, how many journal entries will it contain? Common sense. 14 marks means normally how many journal entries have to contain? 14. Worst case, at least 10 also should be there. Correct? But what you have to do is come to page number 96. Come to page number 96. Step number 7. This single entry you have to pass. This single entry you have to pass. What is that entry? Read that entry. This one. Asset account debit, goodwill account debit, 2 liabilities, 2 NCI, 2 GVP, 2 investment in subsidiary. Investment in subsidiary, or it can be called as consideration. This is the only entry which you have to pass to get 14 marks. Most of the worst part is most of the students don't know that we have to pass single entry because they will not even open this business combination. Okay, they will feel it is too much lengthy, we have to skip. That is most of the notion. Even if I say, many of you students will still take this as choice, but fine. Whoever have do this chapter, they will never regret. Minimum 50 they will get if they attempt business combination. Okay, see, you can check other, what should I say? Those papers also, if you check, not past papers. Valuation chepistaru kada danni emantaru. Certified copies, yes. Even those certified copies also we can check. Most of the students who failed at 38, see, what 2 questions రాయడు, business combination వదిలేస్తాడు, CFS వదిలేస్తాడు, మిగతా 4 questions, మిగతా 3 questions ప్రిపేర్ అవుతాడు. ఆ 3 questions కూడా ఎలా ఉంటాయి చూడండి. ఫస్ట్ దే విల్ రైట్ ఇన్ డేస్, సగం వస్తుంది, సగం రాదు. నెక్స్ట్ వాల్యుయేషన్ ఆఫ్ గుడ్ విల్, మనకు ఆన్సర్ వచ్చినా వాడు మార్క్స్ వేయడు, ఎందుకంటే కీలో తప్పు ఉంటుంది. కీలో తప్పులు ఉంటాయి వాల్యుయేషన్ ఆఫ్ గుడ్ విల్ క్వశ్చన్. ఫైనాన్షియల్ ఇన్స్ట్రుమెంట్స్ సగం చదువుతాడు, అదే ఉందనుకుంటాడు సిలబస్ లో, మళ్ళీ చాయిస్ అది పోతుంది. ఇంటర్నల్ రీకన్స్ట్రక్షన్ బాగా రాస్తాడు, అది కూడా లాస్ట్ లో క్యాపిటల్ రిడక్షన్ అమౌంట్ మిస్ అయిపోతుంది. ఓకే, MCQs 15 ఉంటాయి, అందులో ఒక 8 MCQs కరెక్ట్ అవుతాయి, కానీ వాడు బయటకు వచ్చేటప్పటికి 12 MCQs కి క్యాలిక్యులేషన్ చేసుకొని వస్తాడు. సో 12 × 2 24 పాస్ అయిపోవచ్చు అనుకొని వస్తాడు, ఒక 8 అవుతాయి. థియరీ తెలిసిందే కదా, మనం ఎలా రాసినా వాడు 7. సో వరస్ట్ కేసులో స్కోరింగ్ వచ్చే మార్క్స్ అంటే ఇవే. ఎంట్రీస్ ఉంటాయి కాబట్టి లిమిటెడ్ ఎంట్రీస్ ఉంటాయి, ఓన్లీ సింగిల్ ఎంట్రీ వీ హ్యావ్ టు పాస్. correct? So that is the reason, don't take this chapter completely as a choice. Okay, try once, try twice. If you are not getting, then you can leave. But without trying, if you are leaving, no one can save you. Okay, only single entry I have to pass. Now again we will come back to steps. Again we will come back to steps. Step number 8 also they are saying. What is step number 8? I have to prepare CBS of acquirer company after the business combination on the date of acquisition. Balance sheet is also very simple. What I have to take is parent company balance sheet they will give. For the parent company balance sheet, whatever the entry you have passed it, I just have to add that entry. If assets are there, I have to add to assets. If liabilities are there, I have to add to liabilities. Goodwill, I have to record. Correct? NCI, I have to record. That's it. That single entry I have to add to the balance sheet. Then I will get the consolidated balance sheet. Okay. Once read all those 8 steps. Once read all those 8 steps. Okay. So tell me, what is the first step? Acquirer company identification. Step 2, date of acquisition. Step 3, purchase consideration. Step 4, identifiable net assets. 5, NCI. 6, goodwill or GBP. 7, journal entry. 8, CBS, consolidated balance sheet. Step number 1 and step number 2, nothing we have to use your minds. From the question you will understand. If A Limited acquired 80%, A Limited is only acquirer. Date of acquisition also they will specifically give in the question. But our real deal will start from the step number 3 only, which is nothing but determining purchase consideration. Understand? Sometimes, first of all, read this. Consideration paid to owners of acquiree company. Please change that to acquiree company. Consideration paid to owners of acquiree company to obtain the control of its business. To obtain the control of its business. Okay. Sometimes acquirer company will pay cash to acquiree company owners. If any cash is paid, I have to write that cash. I have to include that cash. For example, company is paying 80 lakh rupees cash as consideration. Along with that 80 lakhs, one building is there. That building is also transferred. If any building is transferred, I have to take fair value of that asset transferred. For example, they have given that building fair value is 10 lakhs. I have to take 10 lakh rupees. I have to take 10 lakh rupees. Along with that asset also, I am issuing my own equity shares. I am issuing my own equity shares. For example, I am issuing 30,000 equity shares. I have to calculate fair value. My company's fair value I have to calculate. Assume it is 15 rupees. Assume it is 15. 30,000 into 15, how much? 4 lakh 50. Huh? This also will be included in PC. 45 lakh. 4 lakh 50. 4 lakh 50 also I have to take. And one more thing. Sometimes I will issue debentures to equity shareholders of acquiree company. See, here debentures I am not issuing to debenture holders. My company debentures are issued to equity shareholders of the company. That also I have to take. Which value I have to take? Fair value I have to take. But one more thing can be deferred consideration. Deferred consideration means I said that I will pay 10 lakh rupees. But this 10 lakh I will not pay immediately. After 2 years I will pay. If after 2 years I will pay, will I record this directly 10 lakh rupees or do I have to record present value of 10 lakh? Present value of 10 lakh. Assume it have got 8 lakh rupees. Now take the total. Take the total PC. 90. 1 or 2, 80,000. No? 50. This should be my total PC. Very simple. Directly you can get this PC. Okay. Carefully understand. First I have to write cash. Second, if any asset is transferred, I have to take fair value of that asset. If any shares are issued, equity shares, I have to write fair value. If I have issued debentures, I have to write fair value. If I have issued deferred consideration, at which value I have to record present value. Sometimes one more consideration will be paid, which is nothing but contingent consideration. Contingent consideration means they will attach some condition. For example, if the acquiring company market price is increased by 20%, I will pay you additional consideration. This is called as contingent consideration. Understand the difference between deferred and contingent. Deferred means compulsorily I will pay, but not now. Contingent means whether I pay, whether I will not pay, that is dependent upon some another situation, another condition. Correct? May or may not. Very good. So this contingent consideration, which value I have to calculate? Fair value I have to calculate. Sometimes your question will not give you fair value. If fair value is not given, I have to take present value as fair value based on the question. If question specifically says fair value, I have to take that fair value. If nothing is given, then what I can do? I have to calculate present value only. Okay, simple. Very, very important. This step you have to understand. Next. Most important, this point number 4. Point number 4. What is this? Acquisition related costs. Don't confuse this acquisition related costs with morning whatever transaction cost which I have discussed. That is in financial asset. This is in business combination. Okay. Tell me what is the definition of purchase consideration? Purchase consideration means, read this. Consideration paid to owners of acquired company. Think and tell me, acquisition cost means, will I pay to equity shareholders of acquired company? Acquisition cost means, see, since fair values are required, I may have to employ one professional. I have to pay professional fees to that person. Legal fees I have to pay. Stamp duty I have to pay. Valuation fee I have to pay. Will I pay all these amounts to equity shareholders? Will I pay all these amounts to equity shareholders? No. Therefore, this will not be included in PC. This will not be included in PC. Sir, what I have to do? P&L account. What I have to do? I have to transfer to P&L account. Most important treatment. Transaction cost will be always transferred to P&L account in case of business combination. In case of business combination, always they have to be transferred to P&L account. Right beside the question, beside that point, if it is share issue expenses, I have to write off those expenses not to P&L account but to securities premium account. Question, they will specifically give you share issue expenses, then only I have to do this. Write off to securities premium account. If you remember your CMA Inter, securities premium will be used for specific purposes, very restricted purposes. Some 5 purposes or something is there. Only for those 5 purposes, I have to use those securities premium. One of that purpose is to write off issue expenses. Okay, if they have given any issue expenses separately, instead of transferring to P&L account where I have to transfer, securities premium I have to transfer. Most important point. In one of the exam, I have tested this point, securities premium. Okay, fine. Step number 3, that's it. Simple step. Purchase consideration calculation is completed. Check this step number 4, what we have to do. Step number 4. Identifying net assets taken over of acquiring company by acquirer company. What is the first point they have written? All assets and liabilities are taken over at which values? Fair values on the date of acquisition. This is the first point. Read the second point. Intangible assets, if they met the recognition criteria as per Ind AS 38, but if they are not recorded in acquiry books, those are also should be recorded at a fair value in the books of acquirer. Please change this acquirer. Next line, this is not acquiry. Please change this to acquirer. Please change this to acquirer. Please change this to acquirer. Now what have happened is, yesterday I have said recognition criteria for intangible assets. Two conditions are there if you remember. First condition is future economic benefits. Second condition is cost should be measured reliably. Correct? Acquiry company is having one asset which is called as internally generated customer relationships. Customer relationships is nothing but, for example, if you observe Zomato is having all the list of customers along with their preferences. They know at which time you will order which item. According to your moods, they know total customer data of yours. For Zomato, it is an internally generated intangible. If it is internally generated intangible, I cannot find out what exactly is the cost to develop those assets, those relationships. Therefore, Ind AS 38 is saying, if you are unable to measure cost of any asset, you cannot recognize that asset. You cannot recognize that asset. Like that, Ind AS 38 is saying. For acquiry, it is not possible. Therefore, acquiry have not recorded this internally generated customer relationships in its account. But what have happened is, at the time of business acquisition, I have assigned separate value for that customer relationships. I am saying now I am purchasing those relationships. While I am purchasing those relationships, if I am able to allocate any purchase price, that I have to record. Sir, but it is not satisfying Ind AS 38 in acquiry books, but you have to check acquirer. Now, this accounting we are doing in the books of acquirer. So acquirer books, what I have to check is this recognition criteria satisfied or not. If you are treating that item as a purchased intangible, therefore, what I have to do is I have to record that which value? Fair value. One question is there. In that question, what they will say is one brand is there. That brand is there in the books of acquiry company books, but that acquiry company books have not recognized that brand because it is self-generated intangible. But they will give you fair value. You have to record that item in the books of acquirer because it is satisfying the recognition criteria as per Ind AS 38. Most important point that you have to understand. Second point, you can keep on star. One question is there. I will show what is that question. Okay, but first copy this. One more thing, third example, third point. Carefully check this third point. They are saying contingent liability of acquiry company is also taken over as a liability at fair value on the date of acquisition. We all know that contingent liability will not be recorded in the books of acquiry, but at the time of acquisition, acquirer and acquiry both will sit together. While negotiating, acquirer will also ask that you are also having one contingent liability. Correct? So what if suddenly that contingent liability becomes my liability? Then I have to pay that amount because after acquisition you will be closed. Everyone will come to me. I only have to make the payment. Therefore, while deciding the PC itself, I will also adjust if there is any non-current, if there is any contingent liabilities. I will consider the fair value of that contingent liability and I will determine my purchase consideration. Therefore, if any contingent liability is there in the books of acquiry, I have to record that which value? Fair value only. Everything will be given in the question. You just have to remember which value we have to take. Just you have to remember contingent liability will be taken over at which value? Fair value. Okay, important point. Next, come to point number 5. There is no question in this point number 5, but they may ask one new point based on this. So this point also you have to understand, if there is any reacquired right by the acquiree are also taken over and recognized at fair value on the date of acquisition. Just to highlight this word reacquired rights and remember this fair value we have to calculate. In the question they will give you if they have given any reacquired rights. In brackets I have written pre-existing contractual relationships. If anything is there between acquirer and acquiree, that also will be included in the net assets, and I have to take which value? Fair value I have to take. Fair value I have to take. Last but not the least, sixth point. If any non-current asset held for sale, if there is any non-current asset held for sale, see, normally I have to record everything at fair value only. But non-current assets, one exception is there, I have to record at this value. FVLCTD, because another standard is saying this part. Ind AS 105, not there in your syllabus. But I think I have explained this point. You have to value at FVLCTD if any asset is held for sale. Okay, so this point you have to highlight. 6 point also you can keep on star mark. 6 point also you can keep on star mark. 7, 8 points and 9. If you are not having any knowledge of deferred tax asset or deferred tax liability, I recommend you to by heart these 3 points, because it is not possible for me to conclude these 2 points, these 3 points. So you can just by heart these points if you want, because I don't know whether they can ask this point or not. But if they have given tax rate in that question, in the business combination, only one additional entry we have to pass, which is nothing but this entry. If they have not given 99%, they will not give tax rate. But worst case, if they have given, you just have to pass this entry. But it is not possible for me to complete this in the CO batch, so I am ignoring. If you want, you can by heart this, otherwise you can leave also. Okay. Step number 4 is also completed. Identifiable net assets also we have completed. And step number 5. Step number 5, what I have to calculate? Non-controlling interest I have to calculate. First of all, what is the meaning of NCI? We have to understand. NCI represents ownership owned by other than parent entity. Other than parent, which means other than the person who is having the control. What about other shareholders who are having the stake? That is nothing but NCI calculation. Okay. NCI calculation also, I should be calculate on which date? Date of acquisition I have to calculate. Sir, in order to calculate this NCI, 2 methods are there. First method is fair value method. Second method is proportionate share in net assets method. First method is which method? Fair value method. Second method is proportionate share in net assets method. Carefully let us understand what about these methods. If your institute have given fair value of NCI, if they have given directly, take that directly. Don't do any calculations. Don't apply proportionate share method. Don't apply fair value method. Whatever they have given, blindly take that value. If they have specifically given any NCI value, you have to blindly take that value. So first preference will be obviously given in the question directly. Second preference. See, for example, in NCI, total 1 lakh shares are there. Total 1 lakh shares are there in, subsidiary company, totally 1 lakh shares are there. Each share fair value is 14 rupees. Each share fair value is 14 rupees. Now I am calculating A Limited have purchased 70% of shares of S Limited. A Limited have purchased 70% shares of S Limited. Now tell me how much percent is NCI? 30% is NCI. 30% means how many shares? Tell me. 30,000 shares. Into each share value is how much? 14. Each share value is 14. So just multiply this and tell me the amount. 4,20,000. This is only NCI value. This is only NCI value. They will give you fair value per share of acquiree company I have to take. See, NCI, I am finding of which company? Am I finding of acquirer or am I finding of acquiree? Acquiree company NCI I am finding out. Correct? Therefore, I have to take which company fair value? Acquiree company fair value. Take the fair value of acquiree into number of shares held by NCI. Then I will get NCI value. Okay, so check the formula what they have given. Number of shares held by NCI in acquire re company multiplied by fair value per share of which company I have to take? Acquire re company I have to take. Most important calculation this is. This is method number 1. Fair value method. Sometimes they will ask you to use fair value method, but they will not give this. They will not even give this also. First is also not given, second is also not given, but they will ask you to calculate fair value. Now what we have to do is understand. They are saying A Limited purchased 70% of B Limited for 35 lakhs. A Limited purchased 70% of B Limited for 35 lakhs. If for 70% it is 35 lakh, can't you calculate how much is for 30%? How much is for 30%? Tell me. 15. Huh? This is also NCI calculation. Multiple methods are there. This is also NCI. Correct? They are asking you to calculate fair value, but they have not given in the question, nor they have not given fair value per share of accounting acquiree. Per share of acquiree company also. Then what I have to do is I have to find out. This is called as unitary method calculation. Unitary method. For 70% if it is 35, for 30% it is how much? Very basic maths. Okay. So here you can write that. Here you can write one point. If in the question, comma, both preferences are not given. Both preferences are not given. Both preferences are not given, but they are asking us to calculate fair value. But they are asking to calculate fair value. Then apply unitary method. Apply unitary method. Then I have to apply unitary method. Okay. So carefully understand. This is first method. NCI calculation. What is the first method? Fair value method. One more method is also there, which is nothing but what? Proportionate share in net assets method. Let us understand this also. Very simple. I have calculated identifiable net assets of acquiree company. Which company? Acquiree company. Sir, if acquiree company identifiable net assets are 30 lakhs, for example, I have got this 30 lakh. Assume H Limited purchased 70% of S Limited. Carefully think and tell me, sir, I will calculate identifiable net assets of which company? S Limited only. S Limited, what are the net assets? Tell me. 30 lakhs. Sir, out of this 30 lakh, how much net assets are belonging to NCI? Out of this 30 lakh, how much share of assets are belonging to NCI? 30%. So just do 30 lakh into 30%. This is also NCI value. This is also NCI value. Don't think whatever method you are using, we will get the same answer. No, that is not correct. If method changes, NCI value also will change. Correct? All these methods are prescribed by the standard only. According to your wish, you can use these methods. Another method is what? Proportionate share in net assets method. It is not a separate formula. Just check this what they are saying. Net assets taken over by acquirer company multiplied by NCI stake in acquiree company. Okay, simple calculation. NCI is also completed. NCI is also completed. So now what we have to do is another step, step number 6. Step number 6. Step number 6, what we have to calculate is goodwill calculation or gain on bargain purchase on date of acquisition. Correct? If you want to calculate goodwill, what all the items we have to calculate? Tell me, what is the first item? Purchase consideration. Already we have calculated in step number 3. Correct? One more item I have to calculate, NCI. Already I have calculated in step number 5. Minus what I have to do? Identifiable net assets. So where I have calculated? Step number 4. Then I will get either goodwill or gain on bargain purchase. If your step 3, 4, 5 are correct, step number 6 will be correct, balance sheet also will be correct. If any step is wrong, this will be wrong, balance sheet will be wrong. Correct? You have to be very careful. Very careful. And one more thing you have to understand. This is most important. You can keep one star mark here. You can keep one star mark. You can keep one star mark. What they are saying is goodwill cannot be amortized like other intangibles, but it is tested for impairment annually. What they are saying is normally if there is any intangible asset you are having, you can do amortization of that asset. But if it is goodwill, you cannot do amortization. Earlier it is allowed, but later they have removed the concept of amortization for goodwill. But if you remember, for goodwill, I have to do something which is called as impairment testing. If in my CGU, if goodwill is there, what is the first item which I have to charge that impairment loss? First, I will charge completely the goodwill. Balance only I will apportion to other assets. Correct? Therefore, goodwill will not be amortized, but it will be tested to what? Impairment. This is the point you have to remember. And one more thing, sir, if I have calculated fair value, if I have calculated NCI using fair value method, whatever the goodwill which I am getting, that is called as full goodwill. If I am using fair value, I have got full goodwill. Full goodwill means that is applicable to both parent and NCI. Because it is full, it is applicable for both parent as well as NCI. Sir, if I have selected proportionate share method, that goodwill is called as which goodwill? Partial goodwill. And this goodwill is only applicable to parent only. This partial goodwill is only applicable to parent only. This you have to remember. If NCI as per fair value, it will be full goodwill. You can remember like this. Here F. Proportionate method, partial goodwill, P and P. Both are important. If you are solving consolidation chapter, this is most important point which you should not skip. Okay. If as per fair value method, it is full goodwill applicable for both. If it is proportionate share method, partial goodwill applicable only for parent company. Okay, that's it. Goodwill also we have completed. Goodwill also we have completed. And next thing, if you observe carefully, it is nothing but journal entry. Journal entry is very simple. Already I have been discussing from the starting onwards. What I have to do, assets account to debit, goodwill account to debit, 2 liabilities, 2 NCI, 2 GBP, 2 investment and subsidiary. For single acquisition, I will not get goodwill and GBP both. Any one only I will get. Correct? This also we have to understand. Read this. In SFS, see, in SFS, if I am passing this entry, investment in subsidiary account to debit. If I am paying cash, I have to credit cash. If I am issuing shares, I have to credit equity share capital. If I am issuing debentures, I have to create debentures. If I am paying any deferred consideration, I have to create provision for that amount. So I have to create provision for deferred consideration. And last, if any contingent consideration is there, I have to create provision for contingent consideration. Okay. This will be passed in your SFS, but in your CFS, this is the only entry which will be passed. Okay. After that, check this step number 8 also. Check this step number 8 also. They are saying prepare consolidated balance sheet of acquirer after business combination on the date of acquisition. What they will say is you have to take all assets, liabilities, share capital and reserves at a carrying amount of which company? Acquirer. Acquirer take everything at carrying amount, even share capital also. plus what we have to do, give the effect of business combination entry, step number 7. Subsidiary company, don't take share capital, don't take reserves. But other than subsidiary company, parent company, every amount I have to take at which value? Carrying amount only I have to take. Carrying amount means book value only. Sometimes to confuse you, in that question, they will also give you fair values for the parent company also. But ignore those parent company fair values. If they have specifically asked you to take fair value, then only we have to take. But subsidiary company, always I have to take fair values only. Okay, don't get confused. Parent company, sometimes they will give fair values also, but I have to take at which values? Carrying amount only, which is nothing but book values only. Carrying amount is nothing but book values only. Okay, so if any basic question comes, you have to blindly follow this 8 steps. 8 steps you have to follow. But other than a normal traditional balance sheet question, other 4 models are there in this chapter. Those 4 models are nothing but first one, step up acquisition. Second, reverse acquisition. Third, common control transaction. Last one, demergers. Last one, demergers. These 4 models are there in this chapter. Any model can be asked for 14 marks. In last attempts, this is asked, this is also asked, this is also asked, this is also asked. I think demerger they have not asked till enough. Maybe in very past they may have asked, but as of now, recent papers they are not asking this demerger. Any model can be asked for straight away 14 marks. Other than this, whatever steps we have discussed, some traditional balance sheet basic questions are also there. They are also our institute is asking. Okay, any of this step. Trust me, there are only 1 to 2 questions for each model. Step up acquisition, only 2 proper questions. If you do, that is fine. Reverse acquisition, only 2 questions are there. Already they have asked it 2 times in the past. Those 2 times also they have just doubled the figures and they have given. Common control also same. Demerger also very limited questions. Maybe 1 question I will only explain in demerger. Okay, like this we have to solve. Any model can be directly coming from 14 marks. Any model they can ask. Okay, now what I wanted to show is, let me open the workbook. Let me show you the workbook question number. Okay, see, open page number 200. Open this question, question number 8. Everyone, question number 8. Question number 8. Question number 8. Compare that question number 8 and question number 9. Question number 8 and question number 9. Don't read the total question, just see the figures. They have just doubled the figures. Correct? That is exam question. This is your study math question. They will just double. Another questions are also there. I will show. See, this question they have asked in your recent MTP. Question number 13. Definitely you have to solve this question. Okay, they have asked in your recent RTP. Question 13. Okay. So later I will show like this. There are questions where they have just doubled the figures. But fine, let us come to concepts. See, step up acquisition is nothing but previously I have discussed one example wherein control will not be acquired on a single date. Initially, I have purchased 30%. Later, I have purchased another 10. Later, I have purchased another 20. The date on which your cumulative shareholding is more than 50%, that is called as date of control, date of acquisition. Acquisition, correct? So here what we have to do is just read, see. Only these 3 points you have to remember. If you remember these 3 points, your step up acquisition concept will be completed. Sir, what are those 3 points? Let us understand carefully. See, first read this point. In this case, acquirer company obtains the control in acquiree company on the date when the entity purchases more than 50% of the shares in the acquiree company. Correct? This is the first point. Just read these points. If you understand these 3 points, step up acquisition question will be completed. Sir, what they are trying to say is the date, this we have already know, more than 50% will become my date of acquisition. Second step, I have to calculate PC. Correct? Second step, I have to calculate PC. Now you have to tell me, sir, see, in this date, in this question, let me continue. Person have paid 2 lakh rupees to purchase this 30%. Another, in order to purchase this 10%, assume this person have paid 1,50,000. 1,50,000. Now, in order to purchase extra 20%, this person is paying 3 lakh rupees. Now, can I say that only this 3 lakh is my purchase consideration? Answer is no. What is my total stake? My total stake is 60%, which means I have to consider my previously held stakes also. Correct? But if you observe carefully, sir, this stake I have purchased on this date. This stake I have purchased on this date. This stake I have purchased on this date. Standard is saying, don't keep all these different dates. Whatever the stakes which you are purchased earlier, calculate the fair value of all those stakes on the date of acquisition. On the date of acquisition, whatever the difference between book value and fair value is there, you have to transfer the difference to P&L account. You have to transfer the difference to which account? P&L account. What I have to do in case of step up acquisition is, in the question they will give me fair value. The difference between fair value and carrying amount I have to find out because just read this. While recording, sorry, this is recording, not recording. While recording journal entry for business combination on date of acquisition, what is the first item I have to write? Credit previously held investment in acquiring company at its carrying amount. And one more thing they are saying, I have to recognize the gain or loss due to remeasurement of previously held investment in acquiring company at a fair value in profit and loss account. Which means, so ultimately what they are saying is, let us write here, recognize previously held investments at a fair values. Previously held investments I have to recognize at fair value, and any difference will be transferred to P&L account. Any difference will be transferred to P&L account, difference between carrying amount and fair value. Most important step this you have to understand. This is the only step which you have to remember. That's it. Nothing is there other than this. And one more thing, this thing. If previously held investment in acquiring is greater than or equal to 20%, which means if it is associate company, sir, I have already said that. If it is associate company also, still I have to do limited consolidation as per Ind AS 28. As per Ind AS 28, I have to do some limited consolidation. So what this standard is saying is, what I have to do, first of all, whatever the consideration which is there, I have to calculate at fair value and I have to adjust that in my PC calculation. And one more thing, what I have to do is, if previously held investment in acquiree is greater than or equal to 20%, share of acquiree company in OCI reserve of share of acquiree company in OCI reserve. Just write this as share of acquiree company in OCI. You can strike off this. You can strike off this. Share of acquiree company in OCI reserve till the date of acquisition will be de-recognized by transferring it to P&L account or retained earnings according to the nature of the OCI reserve. What they are trying to say is, associate company, there is some OCI balance. Associate company, there is some OCI balance. Sir, what I have to do is, I have to cancel that OCI balance. If it is reclassified item, I have to transfer to P&L account. If it is not a reclassified item, I have to transfer to retained earnings. Ultimately, OCI balance should not be there in associate company. Okay, that should be eliminated. If it is reclassifiable, I will transfer to P&L. If it is not reclassifiable, I will directly transfer to retained earnings. Okay, OCI balance should be transferred to those accounts. Here, that's what I have written, transferring to P&L account or retained earnings according to the nature of the OCI reserve. For example, if that OCI is created because of revaluation surplus, that is not reclassifiable item, therefore that should be transferred to retained earnings. Correct? If it is, what should I say, reclassifiable item related OCI you have created, that balance will be directly transferred to P&L account. Okay, this is the concept of step up acquisition. So what I wanted to do now is, I will explain little concept of all the concepts I will explain, but questions I will keep, which questions you have to practice. Sir, where we have to get those solutions is, already one video I have recorded total business combination. You just have to go to timelines and you can check the question numbers, because questions will, I cannot discuss those fastly because crux of the questions will be missed. So what you have to do, you can keep it 2x speed. Concept I will explain, but you just have to watch those questions because those are very important. I cannot discuss in shorter period of time. Okay, I will explain you which questions we have to solve. Okay, after completion of this step up acquisition, immediately come to workbook. Here, after respective question, what I have did is, I have also given the model also. Page number 208 if you do. Page number 208 if you do. Question number 11 you have to solve. Question number 11 you have to solve. Very in detail I have explained this question. So I recommend you to watch that video. Question number 11. Must you have to solve this question. That's it. One question for step up acquisition done. Okay, very important question. You have to definitely see that. Now, little bit challenging area. Most of the students will feel this as a challenging, but it is not at all challenging. But this concept also, I will try to explain 100%. I will give 100% clarity, but complete clarity you will get only after solving questions. Only one question, nothing more than that. Only one question we have to solve. But let us understand the concept of reverse acquisition first. Reverse acquisition means, let us understand this example. A Limited acquired B Limited by issuing 2.5 shares in exchange of one share of B Limited as PC. First of all, tell me, who is the company which is acquiring shares in this question? Who is the company which is issuing the shares? A Limited. A Limited have purchased B Limited. Shares are issued by A Limited. Sir, what they are saying, 2.5 shares will be issued for every one share of B Limited. Correct? Total number of shares are 1 limited for A. For B Limited, how many shares are there? 60,000 shares are there. Carefully tell me, sir, if the number of shares of B Limited is 60,000, how many shares A Limited have to issue to B Limited? Correct. For every one share of B, I have to issue 2.5. Sir, if B Limited is having 60,000, how many shares I have to issue? 1,50,000 shares I have to issue. Carefully, we have to understand. Sir, before this business combination, A Limited is already having 1 lakh shares. A Limited is already having 1 lakh shares. Plus now new company, new shares are how many being issued? 1,50,000 are being issued in A Limited only. Sir, if I take the total, what is the total? Number of shares. 2,50,000 number of shares are there in A Limited. Now the thing is, sir, out of this 2,50,000, how many shares are held by earlier shareholders of A Limited? 1 lakh shares are only there by A Limited old shareholders, which means if I calculate a percentage holding of A Limited, it will be 1 lakh divided by 2,50,000. Tell me how much it is. Who issued the shares? Tell me. A Limited. Who have acquired? A Limited have acquired B Limited, which means normally control should be transferred to A Limited only. But if you check this, it is not A Limited who is actually controlling A Limited. Correct? B Limited shareholders are indirectly controlling A Limited by acquiring 60% shareholding, which means this is not a normal acquisition. This is not a normal acquisition. Person who is paying PC is A Limited, but person who is actually controlling is which person? B Limited. Correct? It is not a normal acquisition. It is which acquisition? Reverse acquisition. But you have to understand one thing. Whole world is thinking A Limited is only acquirer. Correct? If we don't know this Ind AS 103, we will also feel that A Limited is only the acquirer. Correct? Whole world is thinking A Limited is acquirer. Therefore, this A Limited is called as legal acquirer. A Limited is called as what? Legal acquirer. And one more thing. Consolidation will be prepared in the books of A Limited only. Consolidation will be done by A Limited because it is only actually the acquirer. But accounting only we will change. CFS will be prepared by A Limited only, but we will do accounting as if B Limited have acquired A Limited. This is the only difference in this reverse acquisition. CFS will be prepared by which company? A Limited only. A Limited only. But I will not do the accounting as A Limited have acquired B Limited because I clearly knows that I have checked the substance over form. It is not A Limited who is actually taking the control. Who is taking the control? B Limited is taking the control. Therefore, for accounting purposes, I will assume B Limited is the acquirer. B Limited is the acquirer, but actually B is not the acquirer. Actually, who is the acquirer? A Limited is the acquirer. But for accounting purposes, what I have to think, B Limited is acquirer. But two acquirers names are there. In order to confuse what they have did is they have given a new name for B Limited, which is nothing but accounting acquirer. B is called as accounting acquirer. A is called as legal acquirer. A is called as legal acquirer. One question I am having. In this question, who is actually paying the PC? Tell me. A Limited is paying the PC, correct? But now my assumption is what? Who is taking the control? B Limited is having the control. But tell me, sir, is B Limited paying any purchase consideration? No. But according to this accounting, I am assuming B have acquired A. Therefore, B have to pay something. It will not actually pay. It will not actually pay. Therefore, I have to calculate something which is called as deemed or notional purchase consideration. Deemed PC I have to pay because PC will be actually paid by A Limited, but only for accounting I will calculate what if B have acquired A, how much PC it have to pay. Like this I will do internal calculations in my books of accounts. Correct? This is the only thing which you have to understand. Sir, here what I have to do is purchase consideration calculation. First preference will be, they will be giving you fair value of the business of the accounting acquiree. Accounting acquiree is nothing but legal acquirer. Accounting acquiree is nothing but legal acquirer. In our example, who is accounting acquiree? A Limited is accounting acquiree. Who is accounting acquirer? B is accounting acquirer. Therefore, A is accounting acquiree. First preference, I have to check this. Sir, if this is not given in the question, I have to use this formula. If this is not given in the question, what I have to use? I have to use this formula. Always 99% they will give in this question. They will give in the question fair value of the business of accounting acquiree. They will give in the question. But in case if they have not given, I have to consider this formula. I have to consider this formula. Okay. So just remember this formula. Just remember this formula. Again, I'm having some questions. Who is the legal acquirer? Tell me. A. Legal acquirer. A is the legal acquirer. Who will prepare CFS? A will prepare CFS. Who will prepare CFS? A will prepare CFS, but assumption will be changed. My assumption is A have not acquired B. Who have acquired B? B have acquired A. In question, always they will give you consideration which is paid by A, but that is irrelevant. That is irrelevant because my assumption is not A have acquired B. Who have acquired whom? B have acquired A. Therefore, I have to calculate something which is called as deemed purchase consideration. Sir, how I will get deemed purchase consideration? How I will get deemed purchase consideration? First preference is fair value of the business of the accounting acquiry. I have to calculate. Correct. If this is not given, I have to use this formula. Okay. Just remember that formula. But in all the questions, they will give you this. In all the questions, they will give you this. Okay. But in case if you want to understand the logic of this formula, you have to watch that marathon. Directly they will give. Directly they will give. Which one? If they have not given the fair value of the business of the accounting acquiry, here I have given example also how to calculate and all. Okay, we can check. Percentages anyways they will give. But one more thing, if reverse acquisition is there, they will not give NCI. If reverse acquisition is there, they will not give NCI. That much complicated they will not make for you. Okay, reverse acquisition itself is complicated, is most of the students are thinking. Therefore, they will not give you NCI in this question. Okay, PC calculation if we have done. After that, check this. Step number 4, what I have to do? All net assets of accounting acquiree are taken over at a fair value. Tell me, for accounting purposes, which company have acquired which company? Which company have acquired which company? B have acquired A. Therefore, which company fair values I have to take? A limited fair values I have to take. Reverse. One more thing I can say. In your exam, if you are having any doubt, first ask your common sense what is the correct answer. Just to do the opposite. Okay, just to do the opposite. Maximum cases that will only be correct, but don't do in all cases. Okay. Step number 5, NCI is not applicable. Step number 6, what I have to calculate? Goodwill I have to calculate. Sir, goodwill how you will get? Tell me. Goodwill is very simple. Goodwill or GBP, I just calculate 2 items. First, I will compare consideration with net assets. Correct. Consideration means don't take the consideration given in the question. They will give you consideration which is paid by A, that is irrelevant. We have to calculate deemed consideration paid by B, that I have to take. That should be compared with the net assets taken over of accounting acquiree. Net assets taken over of accounting acquiree, I will compare and I will be getting either goodwill or gain on bargain purchase. Okay, I will be getting either goodwill or gain on bargain purchase. Important adjustment, you have to understand this part. Okay, next. So that's it. If you understand this much, carefully you have to understand who is actually acquiring whom. Exact reverse is happening. Who is paying the PC? That person is not the acquirer. Okay, like that we have to do the calculations. After completion of this reverse acquisition, go to that chapter, go to that video, and you have to check which question means reverse acquisition. You have to directly solve question number 9 or question 8, I guess. 9 or 8. Don't solve both because exactly half. Okay, I think I have solved both the questions in that video, but you can solve any one question. Don't waste time. Any one question is fine, but solve properly. Properly, you have to practice. If you don't practice this question, you can answer nothing in this chapter, in this question especially. Reverse acquisition, complete practice you have to do. Day before exam also, I recommend you to practice this question. Easily you will get. Not even a single new point they will give in this question. Exact copy paste they will give. See, balance sheet is this much only. They will only write 2 lines. That's it. Okay. And one more thing, sir, how to identify whether it is reverse acquisition? You have to understand. Carefully, if you check, here you can understand LS and MS. LS Limited and MS Limited were amalgamated to form a new company, LMS Limited. If you observe carefully, this LMS Limited is the new acquirer company. This LMS is actually the new acquirer company. These two are called as acquiree companies. Okay, I will explain this point while we discuss merger concept. Okay, I will explain there, don't worry, because here you need to understand about merger, then you will understand this point. I will cover, but after completion of reverse acquisition, please solve either question number 8 or question number 9. Most important, you have to solve. Okay, now the next concept. Next concept. Do you want any break or something? ఎప్పుడు కావాలి break? Okay, time is 4. Let's come at 4:15. One more hour discussion will be there. We will complete this business combination chapter and we will go. Okay, so time is 4. Let us come at 4:20. Okay, 4:20 means 4:20 exactly you have to be there. I have already added grace. Don't add further grace to that 4:20. Okay, fine. Okay, so reverse acquisition we have completed, and after that one more very important topic, which is nothing but this common control transactions. This common control transactions, I just wanted to explain a little bit upon this, because till the last attempt, what your institute have been doing is, first let me explain what they are doing. Okay, fine. This is nothing but common control transaction. Sir, common control transaction, if you understand the example, see, A limited is there. A limited assume. Okay, let me explain the thing. See, A limited have acquired 100% of B limited. A limited is having one more subsidiary, 100% subsidiary of C limited. If you observe, both B and C are subsidiaries of A limited. Now what have happened is B limited have acquired C limited. Now what is the acquisition? B limited have acquired C limited. If you observe, there is no transaction in substance. Correct? Earlier also A is controlling B and C. After this acquisition, what have happened? C is acquired by B, but ultimately C is also controlled by A only. Correct? Which means if you observe, common control transactions are those transactions which are controlled by same party before the business combination and after the business combination. Very simple. Before the business combination and after the business combination, if both are controlled by the same party, that is known as common control transaction. Normally what we have to do in purchase method of accounting, see, purchase method means whatever we have discussed till now. NCI we have to recognize, goodwill we have to recognize, fair values we have to record. All these things is explained in purchase method calculation. But with respect to common control transactions, that purchase method is not applicable. Sir, that is not explained in Ind AS 103 directly. They have given in Appendix C. Main standard they are explaining we have to follow, what should I say, common purchase method of accounting we have to follow, acquisition method of accounting, but in appendix, which means at the end of the standard they have given some appendix. In that also, Appendix C of Ind AS 103, they have given the treatment with respect to this this common control transactions related, they have explained the thing. Here what you have to do is, first thing, forget about fair values. Forget about fair values. Normally, acquiring company, I have to take which values? Fair values I have to take. But if it is a common control transaction, forget fair values and take book values only. First thing is this. What I have to take? I have to take book values only. I have to forget fair values. Correct? That is the first point you have to understand. And one more thing what you have to do is, this method is called as pooling of interest method. This method is called as what? Pooling of interest, not acquisition method. Acquisition method means I will record the goodwill, I will record that fair values. But in this pooling of interest method, I will not recognize goodwill, I will not recognize fair values. So then what I have to do? I will record that book values. I will record that book values. And one more thing you have to understand here. All assets and liabilities of the acquiree company will be transferred, including reserves and surplus also. Earlier questions I have not transferred reserves and surplus, correct? But here only assets and liabilities have transferred. But here assets and liabilities also, including reserves and surplus also, I have to transfer. At which values? Not fair values, book values. This is the most important thing. And one more thing, NCI is not applicable in case of common control transactions. That much complicated they will not do. NCI they will not give. What you have to calculate is, we have to calculate here what I have written, calculation of capital reserve. In brackets what I have written, gain or loss on restructuring. Sir, the main crux of this common control transactions is, if you observe this example, before the acquisition and after the acquisition, it is controlled by the same person, which means the crux is you should not record goodwill. If they allow them to record goodwill in case of common control transactions, what most companies will do, for example, B Limited's net assets book value is only 10 lakh, but just for the purpose they have inflated to 1 crore rupees. 1 crore rupees, they will inflate the fair values and they will inflate purchase consideration and they will book huge amounts of goodwill. If more amount of goodwill is there, investors will get cheated that the companies may be performing well. Most of the investors don't know this is common control transaction. Therefore, what the standard is saying is, if it is common control transaction, I should not recognize goodwill. But this can happen. Consideration, for example, consideration I have got 10 lakh rupees minus net assets including reserves. If I take, assume I have got only 8 lakhs. The difference I have got 2 lakh rupees. Now the difference is 2 lakh, but I should not call the 2 lakh rupees as goodwill. What I have to call is that the 2 lakh rupees is nothing but loss on restructuring. This is called as loss on restructuring. Instead of goodwill, I have to write this as loss on restructuring. Till the last attempt, your institute have used the word goodwill only in your study materials. Everywhere they have used the word goodwill only. But suddenly what they have did is, in workbook questions, one of the workbook question, instead of goodwill, they have started writing loss on restructuring. Sir, sometimes I will get credit balance there. Negative balance if I have got, that is nothing but gain on restructuring. Similar to gain on bargain purchase, here I will get gain on restructuring. But the difference is, instead of goodwill, I will get loss on restructuring. This is the major point which you have to observe. Sir, if it is loss on restructuring, I have to transfer that loss to capital reserve. I have to transfer that loss to capital reserve. So first what you have to do is strike off here goodwill. Page number 100, strike off that goodwill and please write, instead of goodwill, you have to write loss on restructuring. You have to write loss on restructuring. If it is negative, I have to write gain on restructuring. If it is negative, I have to write gain on restructuring. If it is positive, I have to not write goodwill, I have to write loss on restructuring. This is the important point which you have to understand. But this method is called as which method? Tell me. Pooling of interest method. Always remember, if it is pooling of interest method, at which values I have to take over? Book values. All assets, including reserves and surplus also I have to take over. Including reserves and surplus also I have to take over. At which values? Book values I have to take over. Okay, very, very important. You have to understand this concept. Here, please write this part. Here, please write this. In main answer, always write loss on restructuring only in the entry. In the entry, don't write goodwill. If the difference is debit side, you have to write loss on restructuring only. Loss on restructuring only. And I have to give reference to Appendix C of Ind AS 103. I have to give reference to Appendix C of Ind AS 103. Appendix C of Ind AS 103. And you also have to write a note. Alternatively, goodwill can also be written. Because I don't know your institute will give marks if you write this much, because inconsistency is there. In study material, they are using the word goodwill. Latest workbook question, they have used the word loss on restructuring. So safer side, in the main answer, write the loss on restructuring. This is only correct as per the standard. But write, give a note also. Alternatively, we can write goodwill also there. This much you have to understand. Okay. And one question what you have to solve is, come to workbook. In workbook, which question is there? That common control transaction. I think one question, DA limited and TA limited, data limited, one question is there. Which page number? Sorry, question number 9. Adi kaadu, inko question untadu. Mark that question number 6. Very important, only one question we have to solve. Mark that question number 6. Okay. This question also we have to check from that marathon only. But one small warning I am giving. At that time I am recording this video, your institute have recorded goodwill only. I have explained goodwill. At that time also I have explained they will change in future. If they have changed in future, I will let you know is what I have explained in that video. Okay, so please don't get confused. There I have used it goodwill only. At the same time, I have explained your institute is going to change in the future. That also I have explained. But now it is changed. So now I have to write loss on restructuring only instead of goodwill. Okay, this is the important point which you have to note. And you have to understand this very, very important question, important point of the standard. So you should not miss this common control transaction. Only one question is there in this common control transaction. We have to check that one question. Here also strike off goodwill and write loss on restructuring account debit. In this journal entry also strike off goodwill and write loss on restructuring account debit. Loss on restructuring account debit. Okay. Another concept number 12, accounting for mergers. Accounting for mergers, here what we have to do is, see, mergers can be anyways. Two companies can form completely new company, that is also acquisition. One company can completely absorb another company, that is also acquisition. Whatever it is, we have to follow purchase method only if it is not common control. But if it is common control, I have to use which method? Pooling of interest method. In pooling of interest method, what I have to do, tell me? All assets and liabilities, including reserves also, should be taken over at which values? Book values. Very good. So here what we have to do is, merger, if it is in the nature of business acquisition, I have to apply acquisition method of accounting as it is. If A Limited and B Limited both have formed AB Limited, AB Limited is the acquirer company. Correct? AB is the acquirer, it will pay the consideration. Therefore, I will apply acquisition method of accounting in the books of AB Limited. In the books of AB Limited, I will apply acquisition method of accounting. Okay, and one more thing. Merger in the nature of reverse acquisition. Merger in the nature of reverse acquisition. If you observe here, what will happen is, see, earlier A Limited is controlled by Mr. A, B Limited is controlled by Mr. B. Now, new company which is formed AB Limited. New company is formed AB Limited, and AB Limited is also controlled by Mr. B. AB Limited is also controlled by Mr. B. If you observe carefully, sir, legal acquirer is AB Limited. Legal acquirer, which means it is actually issuing the purchase consideration. But if you carefully observe, here control is there with which person? Mr. B. Mr. B means indirectly B Limited is only having control. Indirectly, who is having the control? B Limited is only having the control, which means acquiree is having the control. If acquiree is having the control, in this case, what I have to do is, B Limited will be called as accounting acquirer. Acquirer. A Limited is called as accounting acquiree. Reverse acquisition, I have to do like this. Okay. Reverse acquisition, this B Limited will be called as accounting acquirer. A Limited will be called as accounting acquiree. One question I have said correct, that LS Limited, MS Limited. After reverse acquisition, I have asked you to solve one question. That question is related to this concept. Okay, same point they will give. LS and MS both have formed LMS. They are saying this new company is, what should I say, controlled by MS Limited is what they will say. This is a case of reverse acquisition. Okay, same concept as whatever we have learned. Accounting acquirer, deemed consideration, all those things are commonly we have to calculate. Reverse acquisition, one standard question they will give, that is nothing but, you can write here only, LS Limited and MS Limited both have formed LMS Limited. I will write like this. Last concept in the standard, demerger. Demerger, I think you already know that. If two companies have formed a new company, that is called as merger. If one company have split into another company, that is called as demerger. Exact opposite of merger will be called as demerger. Here, I think you already know that demerged company will be there, and new split up company will be called as resultant company, correct? I think in your DT, those are there, amalgamations, demerged company, resultant company, okay? And one more thing, demerger, what I have to understand is, Reliance Industries Limited, one company is there. That company is splitted into Geo Financial Services Limited, resultant company. Now, what they will say is, this company, whatever the demerged company is there, this is also called as transferor company. This is also called as transferor company. And this is also called as a transferee company. Transferor company means this company will issue assets and liabilities to new company. This is also called as acquirer. This is also called as acquirer and transferee. Don't confuse. Acquirer and transferor, both are not same. Transferor and acquiree, both are same. Transferee and acquirer, both are same. Okay. Whoever is transferring the assets, that person is called as transferor. Whoever is purchasing the control, that person is called as acquirer. Okay. Both are different. Don't get confused. So here what you have to do is, in case of demerger, same copy paste pooling of interest method only I have to apply. But in this case, just highlight this part, except reserves of demerged company will not be taken over. Assets and liabilities will be normally taken over at book values, except don't take reserves. That's it. Demerger is also completed. Demerger is also completed. All assets and liabilities of demerged company I will take, except which item? Reserves. Highlight this part. And one more thing, pooling of interest method I have to apply, because demerger is in the nature of what? Common control. If common control is there, always I have to apply which method? Pooling of interest method. Okay, simple point. Demerged company reserves will not be taken over. Demerged company reserves will not be taken over. Okay, so just right here, if space is there, right, in the books of resultant company, these are the entries which I have to pass. In the books of resultant company, these are the entries which I have to pass. Assets will be debited, liabilities will be credited, consideration also will be credited. If the difference is debit, I will let loss on restructuring. If the difference is credit, I will let gain on restructuring. Very important entries. Demerger also only one question is there. We have to check that only one question. That's it. Loss on restructuring account debit. Credit I have to write to gain on restructuring account. Okay. Demerger also only one question is there. Just check your workbook. I think one question AK limited, some question is there. 2 divisions. Once check that question. Which question number? Question 7 also we have to do. Question number 7. Everything I have explained in that video, not even a single question I have left. Okay, so just complete the concept and watch that video. Business combination will be sorted. So that's it. Chapter is completed. Internal reconstruction already we have it in morning. Okay. Now, conclusion, what I wanted to give is, business combination also we have done. So one Okay, so now what we will do is, in recent developments in financial reporting chapter, generally they will ask one theory question from this 7A and one question which is there. 7A they will ask, 7B they will ask theory question.
7A, what they will do is they will ask economic value added or market value added. This is practical portion. Compulsory 7 marks they are going to ask. Sometimes they will ask economic value added or market value added, or some cases they will ask value added statement. So out of these two questions only, one question they are going to ask. All the items they are asking like this only. So now what we'll be doing is, this theory we will not discuss now. We will complete this EVA or MVA calculation. Okay, since it is already there in your SPMBV, we can complete this faster. We just have to tell me the formulas for this economic value added or market value added. Okay, so tell me what is the formula of this economic value added. No pattern. No pat. No pat. చూడండి, బుక్ ఉంటే ఓపెన్ చేయొచ్చు కదా. No pat minus working capital. No pat minus weighted average cost of capital into invested capital. If you by heart, you have to always check whether it is correct or not. If you truly understand, there is no need of checking back. Okay, if you just understand what is the full form of this EVA, economic value added, which means what is the actual value addition which is there, that you have to find out. Generally a company will earn profits, and instead of PBT, instead of profit before tax, what I will be doing is I will be taking operating profits after tax. What I will be taking is, because this is more accurate measure of a company's earnings. So I will take this no pat. This is nothing but the actual income which is earned by the entity. This I have to compare with whatever the cost which your entity is having. Cost means which cost I have to take? I have to take the cost of capital. I have to take the cost of capital. Cost of capital means what? I don't want in percentages. I want in amounts. Cost of capital means what? Your overall cost of capital is nothing but K naught. Or this is also called as WACC, weighted average cost of capital. In your entity, there may be debt, there may be equity, there may be preference share capital. What you have to do, you have to take the weighted average cost of all those items, and this I have to multiply with the capital. Invested capital, or anything you can say, capital employed, whatever it is you can say. For example, your NOPAT is 15,000 lakhs. You have find out your capital cost and assume that cost of capital is 12,000. Then what is your actual value added? Your actual value added is 3,000 lakhs. That's it. It is not a big formula. So economic value added is nothing but you just have to calculate two items. First one is NOPAT, second one is capital charge. That whatever you have calculated, WACC into capital employed or invested capital, whatever you have got, that is nothing but your capital charge. That is also called as capital charge. Okay, we will complete that concept and we will solve some questions also. So quickly open page number page 139 in your concept book. Concept number 38. Okay, so check this. Economic value added and market value added. Definitions they have given. Economic value added is to assess a company's true economic profit over time, often referred as economic profit. This is just some knowledge they have given. EVA is nothing but it measures a company's economic success by calculating net after tax operating profit. It is nothing but what? Operating tax you want, operating profit you want after tax. So this is nothing but what? NOPAT, net operating profit after tax. From this what I have to subtract? The cost of capital associated with invested capital. This is also called as capital charge. This is also called as capital charge or cost of capital, anything you can say. Okay, anything you can say. It can be cost of capital or capital charge or cost of capital associated with invested capital, anything you can say. EVA equals to NOPAT minus WACC into invested capital. Sir, how I will get this invested capital? Very simple. You would have to take equity share capital, reserves and surplus also we have to take, preference share capital also, plus long term debt if they have given, that also we have to take, minus non-trade investments if there are any, we have to eliminate those non-trade investments. This is important. If you remember, we have already completed valuation of shares and goodwill related topic. There I have explained why we have to deduct non-trade investments. Because we are calculating value of the entity, therefore I want only pure business related goodwill. Therefore, what we have decided, if any non-trade investment is given, I have to exclude. Similarly, this EVA also is the value addition, which we have to do is what is the true economic operating profit. Operating profit means what? Only operating incomes and operating assets we have to take. Since it is non-trade investments, you have to always deduct something which is called as non-trade investments from your invested capital. This is the first important adjustment which you have to remember. Invested capital means if any non-trade investments they have given, I have to deduct that non-trade investments. Okay. NOPAT, it is very simple. How I will get this NOPAT? It is nothing but EBIT into 1 minus tax. It is nothing but after tax EBIT. Other formulas are also there. If you are comfortable with other formulas also, we can use other formulas. But in this subject, this formula is more than sufficient. EBIT into 1 minus tax rate. With this, you will easily get this net operating profit after tax. How you will get this weighted average cost of capital? It is nothing but weight of E into cost of equity plus weight of debt into cost of debt, plus if preference shares is also there, I have to find out weight of preference share capital into cost of preference share capital. Weight of preference share capital into cost of preference share capital also I have to take. Weighted average cost of capital means everything I have to add. Simple formula, NOPAT minus capital employed into weighted average cost of capital. Now we will solve some problems so that in exam, even if any question comes, we can easily attempt. So quickly open workbook. Quickly open workbook. Let us solve some questions also. కనిపిస్తుంది 284. Okay, so check this question. They have given second question. First question will come later, that is value added statement. First we will complete EVA and then we will start with that. LG and Co provides you with the following as at 31st March 22. They have given some balance sheet. Please check the totals, are they matching or not, assets and liabilities. Please take the totals. Okay, if yes, quickly check this additional information. Profit before interest and tax they have given, which is 1000 lakh rupees. It is nothing but PBIT or EBIT. 1000 lakhs they have given. Okay, interest is also 20 lakhs. Tax rate they have given 35.875%. RF 10%, market rate 15%, beta 1.5, 1.4 they have given. Okay, in the question, first of all, you have to find out NOPAT. Tell me what is the NOPAT in this question? Amount. EBIT into 1 minus tax. I want amount. $640. Antena? 641.25 lakhs. This is your NOPAT. 641.25 lakhs is your NOPAT. Next, what we have to find out? capital employed we have to find out. Tell me what is the capital employed in this question? Capital employed. Capital employed means equity share capital plus reserves and surplus plus long term debt. Take the totals and tell me. 3,200. Very good. 3,200 is your capital employed. Next, weighted average cost of capital we want. Do one calculate and tell me what is the weighted average cost of capital in this question. Weighted average cost of capital. In the question they won't give, we have to find out. Once overall kavali. Total weighted average cost of capital of the total entity I want. Very easy. Weight of debt into cost of debt plus weight of equity into cost of equity. Don't check the answer. You try on your own, then let us check. Formulas you have said, which means easily you can calculate. Weighted average cost of capital, K naught. In your CMBA Inter also it is there. Weighted average cost of capital, very simple calculation. What is the total? ఇంకా చేయలేదు ఎంతసేపు అది రఫ్లో చేస్తున్నా. Online students, you also try and tell me what is the weighted average cost of capital. How much? 16.5562. First you have to find out KE in this question. Cost of equity you have to find out. Tell me what is the cost of equity in this question? KE they have not given, but we already have some different formulas to find out this KE, and one most popular formula is RF plus RM minus RF into beta. What is risk-free rate of return in this question? 10 plus RM minus RF enta 5 into 1.4. Tell me this, 5 into 1.4 plus 10. 17%. 17% is your cost of equity. Cost of equity I have to multiply with weight of equity. Weight of equity means what? What is your total equity? We have to find out, divide by total capital. So tell me 17% into how much is your value of equity? 3,000. Your total investment value is 3,200, which means 17% into 3,000 by 3,200 plus KD ichchada question lo. So find out, tell me. 20 divided by 200, which means how much? 10%. So 10% into KD we have to take post-tax. Correct? These are basic points. KD we have to take post-tax, which means tell me 10% into 1 minus 0.35875. 6.4125% is your post-tax KD. 6.4125 41 14 6.4114 వాడిచ్చింది మనకెందుకు, వాడు తప్పిస్తాడు. 200/3200. టెల్ మీ దిస్. 16.3375 వచ్చిందా? 75 వచ్చిందా? 34 16.338% is your K naught. This is weighted average cost of capital into invested capital. That is how much? Tell me this. 3,200 into 16.338%. 52,000. ఎంత? 3,200 into 16.338%. 520. దేని నుంచి మైనస్ చేయాలి? 641.25. ముందు క్యాలిక్యులేట్ చేస్తాం కదా, నో ప్యాట్. 641.25 minus this figure. 641.25 minus 522.816. How much? 11. This is your EVA, economic value added. Okay, so let's solve this question. వద్దా అంటే కొంతమంది ఎస్పీఎం తర్వాత వినేవాళ్ళు ఉంటారు కదా, ఫస్ట్ ఇది వినేవాళ్ళు. ఆన్లైన్ స్టూడెంట్స్ ఎవరైనా ఉంటే చేద్దాం. సో స్టార్ట్ రైటింగ్ ఇన్ అవర్ నోట్స్. ఎకనామిక్ వాల్యూ యాడెడ్. క్వశ్చన్ 2. ఈవీఏ అని రాస్తే సరిపోద్ది కదా. సరే రాయి, చాప్టర్ నేమ్ రాయి, రాసాయి అంతే. Recent developments in financial reporting, question number 2. Okay, so write step 1. Step 1, calculation of NOPAT. Calculation of NOPAT, EBIT into 1 minus tax. EBIT into 1 minus tax, you will get NOPAT. So in the question, what is EBIT? 1000 lakhs into 1 minus what is tax rate? Tell me this. 1000 lakh into 1 minus 0.35875. 640. 641.25 lakhs. Yeah, 641.25 lakhs. Step 2. Calculation of weighted average cost of capital, weighted average cost of capital and invested capital. Weighted average cost of capital and invested capital. Okay, first let us write invested capital. I have given share capital, share capital, and reserves and surplus long term debt. Thousand share capital, 2000 reserves, 200 long term debt. Take the totals. 3200 will become your invested capital. This will become your invested capital. Next, let us calculate WACC. A weighted average cost of capital equals to weight of debt into cost of debt plus weight of equity into cost of equity. Weight of debt into cost of debt plus weight of equity into cost of equity. Okay, let us write KD first. KD, let us write. KD is nothing but post tax we have to find out. Post interest cost we have, post tax interest cost we have to find out. First of all, they have not given that interest also directly. We have to find out this 20 divided by 200. 20 is the interest and borrowings is 200. Therefore, first I have got 20%, sorry, 10% into 1 minus tax we have to write 0.35875. Tell me this. %6.4125%. This is your cost of debt post interest tax. Post tax interest cost we have to take. Next, let us find out KE also. KE, we have one popular formula, RF plus RM minus RF into beta. Both are same. Tell me how much is RF? 10 na? Plus RM minus RF into beta. Tell me this. 17% is your KE and KD is 6.4125%. Okay. Next, write weighted average cost of capital. (6.4125%) into 200 by 3200 plus very good 17 into 3000 divided by 3200. Take the direct total and tell me. 16.338 మీకు నచ్చింది రాయండి. 16.338%. కావాలంటే 16.34 రాయండి, 3375 రాయండి, మీ ఇష్టం. 16.338%. లాస్ట్ స్టెప్. Last step, we have to calculate economic value added. NOPAT minus NOPAT minus WACC into capital invested. 3,200. $118.37 lakhs. This is your economic value added. This kind of question they can ask for 7 marks, but little adjustments they will give. Okay, so quickly copy this, and those who have completed, check the next question. June 24 question we will see. One more small doubt I have got. What we did with these investments? Why ignore? ఏంటమ్మా ఒకసారి ఆ నోట్ చెక్ చేయి గుడ్విల్లో ఏం రాసాం గుడ్విల్ చాప్టర్లో చూసాం కదా ఇఫ్ నథింగ్ ఈజ్ మెన్షన్ వాట్ వీ విల్ అజ్యూమ్ విల్ we assume them as non-trade investments or trade investments? Non-trade investments we will assume. Antena? If nothing is said in goodwill chapter, what we have decided those are treated as non-trade investments. Here nothing they have mentioned. Your institute only knows why they have not taken these investments. Okay, but suddenly in next suggested answer they will take these investments and they will give you new suggested answer. Okay, so those who have written this, they will keep a big strikeout. So what we have to do, one note we have to write on a safer side. Okay, we have assumed these investments as, if you are assuming these investments as non-trade investments, please calculate invested capital once again. Emi radu, minus 150 cheste vachestadi, other things will remain same. Okay, you just have to find out that capital charge once again, and then we have to find out. So here only let us write some note in the question. At the end of this, let us write some note, because we don't know what your institute will do with suggested answers. So they will change sometimes. So let us write. We have assumed investments as trade investments. In this question, we have assumed as trade investments. Okay. Alternatively, they can be assumed as non-trade investments also. If those are non-trade investments, tell me what is your invested capital? Invested capital will be how much? Minus 150. Investments also we have to deduct. Non-trade anukunte illa minus cheyali invested capital. 3,200 minus 150 is how much? 3,050 lakhs is my invested capital. Non-trade capital less chesa. Non-trade goodwill lo kuda chusavu kada. Non-trade investments will be excluded from capital employed, and income from non-trade investments also will be excluded from adjusted profits. All those things we have seen. If you have any doubts later after going home, you can check goodwill related notes. If you want, you can check in concept book also. There also we have already discussed at that point. Now tell me what is weighted average cost of capital into this invested capital. Tell me this 3050 lakhs into something we have got that 16.338%. 490 308 498.309 lakhs. We have got some NOPAT earlier. Your EVA will also change. Weight ante untadi. Overall cost of capital will not change. Only your invested capital will change. Your capital is that only, but your investments are different. Okay, so you will not change this cost of capital. Cost of capital will remain same. Your invested capital only will change. Okay, because for your entity the cost is this much only, but how much investment you are making in your business, on that only I have calculated my cost. Okay, fine. 498.309 lakhs. Then tell me what is my EVA. Have you got that? 641.25 minus 498.309. How much is this? 94. You have to be little clear with your assumptions, otherwise your institute may not give you full marks. So these kind of questions though, we should not lose any marks, because easier 7 questions they will give. Easier 7 marks they will give. Okay, 142.941 lakhs. Those who have completed, please check the next question. Try the next question. Try the next question. Question 3, please check. Find out economic value added in that question. In this question, they have not given EBIT or NOPAT, they have not given, but you have to find out. Financial leverage they have given, or you can easily find out that. KE also we have to calculate carefully a little bit. KE. Only three items you want: NOPAT, weighted average cost, invested capital. Easily you can find out if you got those three. What is your EBIT? At least have you got that EBIT? ఎంత 504 EBIT. Have you got that? What you did? What is this financial leverage 1.5 times? What is the formula for this financial leverage? Very good. EBIT divided by EBT. How I will get this EBT? How I get this EBT? EBIT minus interest. Correct? So I have to write like this: EBIT divided by EBIT minus interest. This will become how much? 1.5. నాకు రెండిట్లో ఏదో ఒకటి తెలియాలి. EBIT కానీ ఇంట్రెస్ట్ కానీ తెలిస్తే అదర్ ఫిగర్ ఐ కెన్ ఈజీలీ ఫైండ్ అవుట్. In this question we don't know EBIT, that is only we are finding out, but we know interest. How much is interest? 1120 into 15% you can do. 168. This 168 will become your interest. You have to do the cross multiplications and your basic math you have to apply, and then you will get this EBIT. How much is your EBIT? 504 crores, sir. 504 crores is your EBIT. Okay. Tell me what is your NOPAT. 504 crore into tax they have given 30%, which means into 70% you have to do. 504 into 70%. 504 into 70%. How much? 8. And then your NOPAT is correct, 352.8. Find out K naught in this question. Find out WACC in this question. NOPAT is correct only, everyone got the correct answer, but find out WACC. WACC, if you want, if you find out KE correctly, the question is very simple. KE we have to find out, beta they have given, RM they have given, RM minus RF also they have given. You just have to find out KE. If you find, question will be simple. Okay, so let us write this question. So we don't have much time, so let us complete this question fastly. So write question number 3. Okay, let us write question number 3. Write step 1. Step 1. Calculation of NOPAT. Let us find out calculation of NOPAT. Okay. ఎవరు వచ్చారు? దయ్యం వచ్చిందా? అదేం చేస్తుంది మిమ్మల్ని? NOPAT we have to find out. Okay. This NOPAT how we will get? NOPAT is nothing but EBIT into 1 minus tax. In this question, we don't know about this EBIT. Therefore, I have to find out EBIT. So, I have to use this financial leverage. How much is financial leverage in this question? 1.5 times. Okay. So, this financial leverage formula is what? EBIT divided by EBT equals to 1.5. First write. So the tarvata EBIT divided by EBT, how we will get? EBIT minus interest equals to 1.5 times. Times you can eliminate. EBIT by enti? EBIT minus interest. Tell me how much is your interest? Very good. 68. Huh? Have we got that 168? 1120 into 15% equals to 1.5. Do all your cross multiplications and tell me what is my final EBIT. ఆ క్యాలిక్యులేషన్ నోట్ చేసుకుంటున్నా, అంటే తర్వాత మళ్ళీ మర్చిపోతావు. నిన్ను అనలేదు కదా, నేను నిన్ను అడగలేదు కదా. ఈబీఐటీ ఈక్వల్స్ టు 504 lakhs. EBIT equals to 504 lakhs. But I want NOPAT. NOPAT equals to 504 lakhs into 1 minus tax rate, which means 0.3. 504 into 1 minus 0.3. How much? The 360. 352.8 lakhs is my NOPAT in this question. Okay, 352.8. You can directly write into 0.7 also, anything. Second step. Step number 2, let us find out weighted average cost of capital and invested capital. Tell me what is the equity share capital in the question? 420. Yeah? Next, reserves level. Reserves level. Prescribed share. Preference share capital. How much have they given any dividend percentage? Amount? 140. Next. Debentures ichchada. 15% debentures. Very good. Take this total. 1680. Yeah? 1680 crores. So next we have to find out individual costs. Tell me what is my KD in this question? 15 ichchada. So 15% into 1 minus 0.3. ఇదెంత? నెక్స్ట్ కేపీ వేద్దాం కేపీ అయిపోయాక. Do we have to take preference dividend also after? Do we have to take KP also after tax? No. Very good. Which means how much? 15%. Last one, KE. KE formula. నువ్వు దాన్ని చూస్తే నీ దగ్గరికే వస్తుంది. అది నీ పన్ను చూసుకుంటే అది ఏం చేయదు కదా. దానికి అటెన్షన్ ఇస్తే మీ దగ్గరికే వస్తుంది. KE formula. What is this KE formula? Tell me. RF plus RM minus RF into beta. Very good. Tell me what is RF in this question? RF లేదా? RF ఇవ్వకుండా ఎందుకు ఇస్తాడు? What is this? What is this market risk premium? RM minus RF. Have they given RM also? Which means you can easily find out RF, correct? What is RF? 15.5 minus 9. If you do, you will get a RF as 6.5. Plus RM in this question 15. Directly they have given RM minus RF, so let me write that figure directly. 9%. Into beta. ముందు ఇవ్వలేదు కాబట్టి అలా తీసుకున్నాం. బీటా ఎంత? 1 point. Very good. Tell me this total. 20%. 20%. సమ్మ చేయమంటున్నా. నెక్స్ట్ ఫైండ్ అవుట్ weighted average cost of capital. Okay, very good. Weighted average cost of capital equals to KD into weight of debt plus KP into weight of preference plus KE into weight of equity. KD how much? 10.10. 10.5% into what is weight of debt? 1120 డివైడెడ్ బై 1680. అది మీరు క్యాలిక్యులేట్ చేద్దరు కానీ. ప్లస్ కేపీ ఈజ్ హౌ మచ్? 15% ఇంటూ, వెరీ గుడ్, ప్లస్ వాట్ ఈస్ కేఈ ఏంటమ్మా? 20% అది. 20% ఇంటూ 1680. Now take the totals. $140 divided by 1680. We have to cross check. నమ్మకపోవడం అని కాదు, అదే చేయాలి, క్రాస్ చెక్కే చేయాలి. 140 divided by 1680. టోటల్ ఎంత? 24. 13.60. సరే, ఒక్కసారి క్రాస్ చెక్ చేసుకోండి. దానికి కూడా మళ్ళీ క్యాలిక్యులేటర్లో ఒకసారి క్రాస్ చెక్ చేసుకుంటే. వీళ్ళు ఏమైపోయారు? ఫస్ట్ బెంచ్ 2-3 ఉంటారు. రాలేదు ఈరోజు. 13.25%. నెక్స్ట్ ఒకసారి క్రాస్ చెక్ చేసుకొని ఫైనల్ ఫిగర్ చెప్పండి. 28. వాడికి ఎంత వచ్చింది? వాడికి ఆన్సర్ ఇవ్వలేదు. వాడు 13.25 అనుకుంటా కరెక్ట్ ఫిగర్. ఒకసారి చెక్ చేయండి. 13.25 వచ్చిందా? అయితే అదే వేద్దాం. ఇన్వెస్టెడ్ క్యాపిటల్. టెల్ మీ వాట్ ఈస్ ఇన్వెస్టెడ్ క్యాపిటల్ ఇన్ దిస్ క్వశ్చన్? Very good. 1680 crores is your investment, but something they have given, land and building they have given which is held as investment. అంటే వాడే క్లియర్గా చెప్పేశాడు కదా, ల్యాండ్ అండ్ బిల్డింగ్ ఉంది, జస్ట్ ఇన్వెస్ట్మెంట్ పర్పస్ కోసం హోల్డ్ చేసుకున్నాడు అంట. ఓకే, విచ్ మీన్స్ వాట్ దట్ ఈస్ నాట్ రిలేటెడ్ టు యువర్ బిజినెస్. దేర్ఫోర్ ఐ విల్ ఎలిమినేట్ దిస్ 140 crores. Okay, I will eliminate this 140 crores from this capital invested, minus 140 crores. Now take the total. 1540 crores. 1540 crores is your invested capital. $1540 crores is your invested capital. Step 3. Step 3 EVA calculation. EVA calculation. NOPAT minus weighted average cost of capital into invested capital. Okay, what is my NOPAT in this question? 352.8 minus weighted average cost of capital is 13.25. Now take the total. 75 crores. 148.75 crores. Is the answer matching whatever they have given? అదే చెప్తున్నా, వాడు ఎలా ఇస్తాడో వాడికి కూడా తెలీదు. ముందు క్వశ్చన్లో కూడా ఏం చెప్పలేదు, ఓన్లీ ఇన్వెస్ట్మెంట్స్ అని ఇచ్చాడు. బట్ దే హ్యావ్ అజ్యూమ్డ్ ఇట్ యాస్ ట్రేడ్ ఇన్వెస్ట్మెంట్స్. But in this question, suddenly they have assumed as non-trade investments. So in exam, we will write alternative note also. don't forget to write alternative note, because I don't have trust on their suggested answers. They will keep on changing this type of questions. They will keep on changing. Okay. So remember, and in exam, please write an alternative note also. Okay. One last question we will check for today. I think we can complete that question. Question number 4, June 25, let us check. Okay. Question 4, June 25. First of all, how I will get this market MVA, tell me. What is the formula for this MVA? Market value. Total formula చెప్పు, సగం సగం కాదు, ఇన్స్టాల్మెంట్స్లో కాకుండా ఫుల్ ఫార్ములా చెప్పు. మార్కెట్ వాల్యూ యాడెడ్. యూ కెన్ చెక్ ఇన్ యువర్ SPMBV ఆల్సో, ఆర్ ఇందులో కూడా ఎతకచ్చు, ఈ బుక్లో కూడా ఉంటుంది. MVA గూగుల్ చేస్తారా, అవసరం లేదు. మార్కెట్ వాల్యూ యాడెడ్, total market value minus, wow, total market value minus total invested capital. How I will get this total market value? Total market value, how I will get? Market value per share into number of equity shares. If I do, I will get market value of equity. Similarly, market value of each debenture into number of debentures I have to do, plus market value of preference share into number of preference shares I also have to do, which means I have to find out the market value of total preference dividend equity minus total invested capital I have to do. Okay. But from your exam perspective, they will only give you market value of equity shares, which means they will assume for preference shares and debentures, market value and invested capital both are same. Which means what? Indirectly we are finding out market value added of equity only we are finding out. This will become market value of your total entity, because what? Market value of preference share capital and invested capital of preference share capital both will become same. Similarly, debentures also. If there is market value, if there is market price, then only difference will be there. If market price itself they have not given in the question, I will assume that preference share capital and the debentures, both market value and invested capital will be same. Okay, fine. So let us check this question. Brahmaputra Limited is interested to calculate EVA of the company. You are provided the following information. Something they have given, but ignore this and find out EVA in this question. This para we will come a little bit later. They have given to find out the market price of that share, but ignore that and check this financial data and find out EVA of this question. Economic value added we have to find out. EVA find out in this question, easier question. How much? 370 crores. Intena? 372 crores. Please check others also. No PAT minus WSEC into cost of WSEC into capital invested. ఫోర్ వన్ ఫోరా? అవునా? ఒకసారి క్రాస్ చెక్ చేయి. ఫాస్ట్గా అయిపోద్ది కదా. కేఈ ఒకటి వస్తే కరెక్ట్ ఆన్సర్ వచ్చేస్తుంది మోస్ట్లీ. కేఈ ఓన్లీ వీ హ్యావ్ టు చెక్. ఐ థింక్ నో ప్యాట్ దే హ్యావ్ ఓన్లీ గివెన్. సో దానికి ఏం వేరే క్యాలిక్యులేషన్స్ ఏం చేసేకండి. ప్రాఫిట్ ఆఫ్టర్ ట్యాక్స్ వాడే ఇస్తాడు కదా. వన్స్ క్రాస్ చెక్ 372 వచ్చింది అనుకుంటా. 372 అనుకుంటా, ఒకసారి చూడండి. ఏంటమ్మా? అంటే డైరెక్ట్గా వాడు నెట్ ఆపరేటింగ్ ప్రాఫిట్ ఆఫ్టర్ ట్యాక్స్ అని ఇస్తాడు కదా. మరి నో ప్యాట్ అంటే అదే కదా. నో అంటే నోవా? ఆపరేటింగ్ ప్రాఫిట్ అంటే వాడు ఆల్రెడీ అది కూడా అడ్జస్ట్ చేసి ఇచ్చినట్టు ఇంకా అంశం తీసుకోవాలి. నో ప్యాట్ అంటే క్యాలిక్యులేషన్ అదే కదా. అప్పుడు ప్రాఫిట్ ఆఫ్టర్ ట్యాక్స్ అని ఇస్తాడు కదా. అంటే మేబీ ఫినాన్సింగ్ యాక్టివిటీస్ కూడా అడ్జస్ట్ చేసాక వచ్చిన ఫిగర్. నార్మల్గా నో ప్యాట్ అంటే అదే కదా. 372 వచ్చిందా? ఇఫ్ ఇట్ ఈస్ ప్రాఫిట్ ఆఫ్టర్ ట్యాక్స్, ఐ థింక్ వాట్ ఎవర్ యూ హ్యావ్ డిడ్ ఇస్ కరెక్ట్. ఎందుకంటే నో ప్యాట్కి 2 ఫార్ములాస్ ఉంటాయి. ప్రాఫిట్ ఆఫ్టర్ ట్యాక్స్ ప్లస్ ఇంట్రెస్ట్ ఇంటూ 1 మైనస్ ట్యాక్స్ ఒక ఫార్ములా ఉంటుంది. ఇంకోటి ఈబీఐటీ ఇంటూ 1 మైనస్ ట్యాక్స్ కూడా చేయొచ్చు. బట్ ఇక్కడ డైరెక్ట్గా ఆపరేటింగ్ ప్రాఫిట్ ఆఫ్టర్ ట్యాక్స్ ఇచ్చేసాడు కాబట్టి వీ హ్యావ్ టు అజ్యూమ్ దిస్ ఈస్ ద ఫైనల్ ఫిగర్ విచ్ వీ హ్యావ్ టు టేక్. ఓకే, సో లెట్ us కాపీ దిస్ క్వశ్చన్. ఇక్కడ రఫ్ సొల్యూషన్ ఇక్కడే ఉంది, ఇది ఒకసారి కాపీ చేసేసుకోండి. నో ప్యాట్ విల్ బి 2100 crores. No PAT will be 2100 crores. Weighted average cost of capital you have to find out. Weighted average cost, I think they have given RF, RM minus RF, beta also they have given. I think it will come to 19.5%. $19.5 into equity plus reserves divided by total capital is 10,000. So 8 by 10 plus KD we have to take post tax we have to take. Directly I have written, but you can easily solve this. KD post tax we have to take. I think in the question they have given 12 into 70% you have to take. Then you will get this 8.4%. Capital charge. క్యాపిటల్ ఛార్జ్ అని కూడా పిలుస్తారు. అది మీరే రాసుకున్నారా గోడ మీద? ఎవరు? మహా లక్కీ. పక్కన నిల్ల. ఓకే. Capital charge is 1728 crores. Economic value added equals to 2100 crore minus 1728 crores. Very good. Okay. Now read whatever they have. We have ignored some 3 to 4 lines, correct? Now read that and find out what they are trying to say. ఇచ్చాడు కదా, ఫైండ్ అవుట్ చేయదు. ఓకే, అంటే ఎంబీఏ ఎలా ఫైండ్ అవుట్ చేయాలో ఫైండ్ అవుట్ చేయని చెప్తున్నాం. Easy point only, that is. Quickly check that. So what will become market value added? Last year EVA is 250 crores. Current year EVA, how much we have got? 372 crores. What is the percentage change? What is the percentage change? 372 minus 250 divided by, should I take 250 or 372? 250 we have to take. At the దాని మీద percentage కింద explain. 48.88%. వాడు ఏం చెప్తున్నాడు అంటే, if your EVA increases from 26 to 50%, which means if your current year EVA, if it is increased from 26 to 50% when compared to last year, your share price will be increased by 25%. If your increase in EVA is more than 50%, above 25%, but up to 50%, what they are saying is that will be 30% increase in the share price. Which means what, you have to calculate the percentage change. If it is 26 to 50, 25% increase will be there in the share price, correct? Any increase up to 25%, what is this? Up to 25%, zero, no change in share price. More than 25 to 50, 25%. ఇక్కడ ఇచ్చాడు చూడండి, 25% increase in the share price. If it is more than 50%, how much it is? 30%. But our case, what is the increase? 48.8, some 48.8, which means what, it is in between 26 to 50. Therefore, my share price will increase by 25%. First of all, what is my current share price? 200 they have given. Now it will become 200 into 125%. Okay, so do 200 into 125%. That will become your market value per share 250. Number of equity shares is how much? ఇక్కడ ఇచ్చాడు కదా, ఫేస్ వాల్యూ ఇచ్చాడు 50 crore. 50 crore into 250. 50 crore into 250 per share price. 50 crore into 250. 12,500. This is what market value of your equity. ఇంకేం ఉన్నాయి? Market value of debt they have not given, which means it will become same 2,000 minus invested capital I have to take. What is the invested capital in this question? 10,000 crores is the invested capital in this question. So 12,500 plus 2,000 minus 10,000. 4,500. This 4,500 is nothing but your market value added. Okay. So let us write that market value added calculation. First write this percentage change. Calculate this percentage change. Based on this, my new share price will depend. Since it is more than 25 but up to 50, share price will be increased by 25%. Next line I have written expected increase in share price at the end equals to 200 into 125%, which is 250. Market value of equity is how much? 50 crore shares into 250 plus market value of debt, there is no change. So I will write that 2,000 crores. Minus invested capital is how much? 10,000 crores. Okay. Copied. So one more question is there from this EVA, which we will solve in evening class. And along with that, let us also complete value added statement also in evening class. Plus, we will also start with internal reconstruction chapter, another 7 marks question. So we will try to complete by today evening only. If not, maybe one more extra class is what we are expecting. Okay. So we will complete both the topics. We will try to complete by today only. So that's it for today. We'll continue next class. So one last question is there in this EVA. So let us complete this question also, and then we will move to value added statement. Okay, so please check this question and try to find out what is the NOPAT in this question. From this data, try to find out the NOPAT. Page 287. Try to find out the NOPAT. ఎందుకు వచ్చావు, ఎందుకు వెళ్ళిపోయావు? మూటలు మోస్తున్నారా? Okay, so NOPAT, how much it is? 15? 1540, huh? Okay, so see, మీకు ఎస్పిఎంబివిలో ఇవి లేవా? అకౌంట్స్ డిప్రిసియేషన్, ఎకనామిక్ డిప్రిసియేషన్. ఒకసారి చూడండి అందులో ఉందో లేదో. వీ హ్యావ్ టు క్యాలిక్యులేట్ సంథింగ్ విచ్ ఇస్ కాల్డ్ యాజ్ అడ్జస్టెడ్ NOPAT. ఏం చేయాలి, ప్లస్ ఆర్ మైనస్? అది కాదు. ఓకే, సో ఒకసారి బుక్ ఉందా? బుక్ లేదా? ఎస్పిఎంబి ఎవరి దగ్గర లేదు. ఓకే, so fine. What we have to do is, normally we can directly take this NOPAT as, we already know one formula which is nothing but EBIT into 1 minus tax. This thing we can use, but if any adjustments they have given, what we have to do is we have to find out something which is called as adjusted NOPAT we have to find out. Sir, how to find out this adjusted NOPAT? It is very simple. Here we have to find out what is the exact true economic profit you have to identify. Which means what? In your P&L account. See, this NOPAT means as per your accounts, as per your books of accounts, whatever the profit which you are getting, you will take that figure. But our purpose is, in order to find out this economic value added, we have to find out the true profits of the entity. Which means what? If any non-cash expenses is there, you have to add back those non-cash expenses. Similarly, for example, deferred revenue expenses. If there is any research and development expense, those kind of expenses, earlier what used to be there is something, a concept of deferred revenue expenses is there, but now they have deleted this. So whatever the expenses which you have incurred, all those expenses should be charged to P&L account. But if you observe, in reality, if I incur any advertisement expense or research and development expenses, what I have to do is, that benefit is not only related to 1 year. So what I have to do, this will be related to over the period of, for example, let us say 3 years or 5 years or 4 years, like this, it will be there. But as per accounts, what you have to do, you have to write off total research and development expense or deferred revenue expense in single year only. So what we have to do, we have to make adjustment for that. If your P&L account have already debited this deferred revenue expense, I will add back this deferred revenue expense. But amortization I have to do, which means what? Every year I will be utilizing some of that expenditure. So what I have to do, I have to deduct this amortization of deferred revenue expense. And one more thing, whatever the depreciation which is there as per your books of accounts, that we have to eliminate, that we have to add back. Sir, why we have to add back means, they will give you one depreciation which is nothing but economic depreciation. This economic depreciation is calculated based on the actual usage of the machine. For example, your machine is there, your machine cost is 10 lakh rupees, and that machine is having a capacity to work for 1 lakh hours. In current year, what you have did is, in current year, you have utilized it for 20,000 hours. Okay, assume as per books of accounts, you have charged 10% as depreciation, which means as per your books of accounts, how much depreciation you have debited? 1 lakh you have debited. But how much you have used? Out of total 1 lakh hours, you have used 20,000 hours, which means what should be the actual depreciation? Real depreciation is how much? 2 lakh rupees is the real depreciation. Okay, because total hours is 1 lakh, but you have used it 20,000, which means what? 1/5 you have already used. Therefore, out of this 10 lakh rupees, total 1/5 have to be amortized, which means what? That is the economic depreciation, real depreciation. So what we have to do, in case in the question, if they have given any economic depreciation, you have to deduct that economic depreciation, and finally you will be getting adjusted NOPAT, which means you have to find out the true economic profits of the entity. Okay, so please make note of this somewhere in your notebook, and then let us solve that question. Because in that question, they have given some adjustments. R&D related expenditure they have given, so we have to check this part. And economic depreciation also they have given. So first write this format, then we will understand the question. EVA equals to, okay, let us write 1 point. If any adjustments are given in the question, EVA shall be calculated as follows. Adjusted NOPAT minus WACC into capital employed. This also we have to calculate adjusted capital employed. Capital employed also we have to make few adjustments, those also we will see. Okay, adjusted NOPAT. Now let us solve that question. Okay, so let's write question number 5. Calculation of adjusted NOPAT we have to do. Okay. First, we have to start our calculations with NOPAT. So quickly tell me what is the NOPAT in the question. 15? Have you got that 1500? Two alternatives are there. You can directly take this profit after tax. For this profit after tax, you can add interest after tax. You can add interest net of tax. Okay, like this also we can get, which means what? This is 910 plus what is your interest? Interest is 300. What is your tax rate? 30%. Please add interest after tax, which means 300 into 70%. 910 plus 300 into 70%. How much you are getting? 11. That is your NOPAT. Profit after tax plus interest net of tax. Unda leda formula? Okay, so let us write NOPAT in brackets profit after tax plus interest net of tax. Profit after tax is 910 plus 300 into 70% or 0.7. This value is how much? 1120. Okay, 1120 is your NOPAT. We have to make adjustments. So check our format and check the question. Whatever the adjustments are there, we will make. Check this point. If you observe this second point, they are saying entire research and development expenditure of 200 lakh is considered as a capital investment with an estimated economic life of 4 years. Economic life means this is actual life, which means the company is estimating whatever the research and development expenditure which they have incurred, that is for the next 4 years. The closing balance of the capitalized R&D asset should be included in the invested capital. Okay, they are saying, but if you observe the P&L account, what they have did, they have totally expensed this 200 lakh, which is incorrect. So first what I have to do, I will add back this 200. What is correct? I will only get amortization of that research and development expense. How much is the economic life? Economic life is 4 years. So tell me 200 by 4 if I do, I will get yearly amortization of 50. Okay, I will add 200 and I will deduct 50. R&D expense. Wrongly debited to P&L account. R&D expense wrongly debited to P&L account. What is the total they have debited? They have debited 200. 200. As per accounts, it is correct only because there is no concept of deferred revenue expense as per accounts. So accounts, it is correct only, but we are finding out true profit. In order to find out the true profit, I will add back the 200 and I will only deduct that amortization. So minus amortization of R&D expense. 200 by 4. 50 I have to make an adjustment. Check the P&L account and tell me what is the next adjustment which I have to do. Or you can even check the second point also. Second point of adjustment, if you check, you will tell me what I have to do. Accounting depreciation I will add back because that is not correct. I want the true depreciation. They have given economic depreciation. So I will add back accounting depreciation and I will deduct economic depreciation. So add accounting depreciation. Add accounting depreciation. How much is the accounting depreciation? 400 will be added. Economic depreciation is how much? So that will be deducted. I think these are the only adjustments. Okay, so let us take the totals and tell me what is the adjusted NOPAT in the 1.3. This is your adjusted NOPAT. Adjusted NOPAT. Step number 1 we are done. Step number 1 done. Step 2. Calculation of weighted average cost of capital and capital invested. Weighted average cost of capital and capital invested. Tell me what is the capital invested. Capital invested 3000. Na? Tell me the breakup. Equity share capital how much? 500 equity share capital. Next. Other equity how much? Next. Long term loan. Long term loan is how much? 1000. అంతనే ఏమైనా చేయాలి ఒకసారి చూడండి. నాన్ ఇంట్రెస్టింగ్ కరెంట్ లయబిలిటీస్ కదా. ఓకే, నెక్స్ట్. ఎనీ అదర్ అడ్జస్ట్మెంట్? థింక్. See here also, since we are finding out real profit in this case, we have found out adjusted NOPAT. By applying this same logic, I also have to find out something which is called as adjusted capital invested. As per accounts, total research and development expense have to be charged to P&L account. But economic profit is saying what? No, total amount is not amortized. 50 is only amortized. What about 200? That will be amortized in the future. That will be amortized in the future, which means in your balance sheet, this should be sitting as an asset as per economic value added method. But what? As per normal accounts means what? As per normal accounts, total 200 have to be charged as expense only because there is no concept of deferred revenue expense. Earlier it is there. Advertisement expense gaani alanti emanna unte over the 5 years we can write off like that. Those concepts are there in old accounting days. But now they have removed all those things. Whatever advertisement expense or deferred revenue expense is there, completely that should be written off to P&L account. That is as per accounts. But here EVA is saying whatever you do as per accounts, that is fine, but we want true profit. Here, for the purpose of calculating true profit, I have only considered the amortization. Which means what? Balance amount is how much? 150 is there, and that 150 is sitting in your assets. Okay, so that 150 is not there in the balance sheet. That 150 is not there here. So what I have to do? That I have to add back in my capital invested. Which means what? Because of that 150, my net assets will be increased. Net assets or capital invested or capital employed, everything is same. Okay, so now what I have to do? I will add back that R&D expense. I will add back that R&D expense. Is there any opening balance for that research and development expense? See the question and tell me. Is there any opening balance? Check the second point. They are saying something about that opening balance. Nil, which means 0. Plus what is the current expense which they have incurred? Total expense 200 minus how much is amortized? 50 is amortized. Therefore, this should be your closing balance in your balance sheet. Which means how much? 150 will be your unamortized research and development expense, which means it will be amortized in the future. It will be amortized in the future. Now take the total. This will become your adjusted capital invested. 3150. This will become your adjusted capital employed or adjusted capital invested, whatever it is. Adjusted capital invested is 3150. Okay. Next, we have to also calculate weighted average cost of capital. Okay. So find out the weighted average cost of capital calculate చేసినప్పుడు ఇవేం చేయకూడదు. Only whatever is your capital, whatever is your cost, only you have to consider those. Okay. So find out weighted average cost of capital. ఇవి స్ట్రైక్ ఆఫ్ చేసేయండి. అది ఎక్సెల్ సమ్ ఫార్ములాస్ ఏవో అట్లా ఇచ్చేసింది ఈక్వేషన్స్ ఇచ్చినప్పుడు. సో ఇవి తీసేసి రిస్క్ ఫ్రీ రేట్ ఈస్ 6%, మార్కెట్ రిటర్న్ ఈస్ 14%. జస్ట్ కీప్ దట్. Risk free RF 6%, market return 14%. Find out KE, find out KD also, and weighted average cost of capital also I want. ఇది అది బిఫోర్ ట్యాక్స్ కదా, ఆఫ్టర్ ట్యాక్స్ కన్వర్ట్ చేయాలి. ఆఫ్టర్ ట్యాక్స్కి కన్వర్ట్ చేయాలి. కేడీ అంటున్నాను. What 300 వేసాడా? Once take the total of this balance sheet. Take the total of this balance sheet. Is it matching liabilities and assets? 5200. Okay. We do fixed assets, working capital 3200. సరిపోయింది 3200 సరిపోయింది. అంటే ఇక్కడ వీడి అజంప్షన్ ఏంటంటే నాకు తెలిసి మధ్యలో ప్రిన్సిపల్ రీపేమెంట్ అయి ఉంటుంది. ఈక్విటీకి నేను చెప్పేది వేరే పాయింట్. ఒకసారి నీ పాయింట్ చెప్పు. ఈ ఇంట్రెస్ట్ మ్యాచ్ అవ్వట్లేదు అంటున్నావు అంతేనా? ఇక్కడ 1000 ఉంది, 1000 into 10% 100 రావాలి, కానీ ఇప్పుడు 300 వేసాడు అంతేనా? ఐ థింక్ సమ్ ప్రిన్సిపల్ ఈజ్ రీపేడ్ డ్యూరింగ్ ద కరెంట్ ఇయర్. ఇక్కడ మనకి ఇన్ఫర్మేషన్ లేదు కదా. సో మనం ఏం చేద్దాం అంటే కాస్ట్ ఆఫ్ క్యాపిటల్ 10% ఇంటూ ట్యాక్స్, ఆఫ్టర్ ట్యాక్స్ ఎఫెక్ట్ ఇచ్చి చూద్దాం. అంటే సమ్ ప్రిన్సిపల్ మే బీ రీపేడ్ ఇన్ ద కరెంట్ ఇయర్, బట్ దట్ ఇన్ఫర్మేషన్ దే హ్యావ్ నాట్ గివెన్. ఓకే. ఎగ్జాక్ట్గా 200 డిఫరెన్స్ అసెట్స్లో వస్తుందా? ఓకే. క్వశ్చన్ ఎలా ఇచ్చాడు? ఒక్కసారి క్వశ్చన్ పేపర్ చెక్ చేద్దాం. అలానే ఇచ్చాడు క్వశ్చన్లో కూడా. వాడు 1300 + 1700 3000 వచ్చింది. ఐ థింక్ క్వశ్చన్ ఈజ్ రాంగ్. క్వశ్చన్ తప్పించాడు. ఓకే, we will check this later. question lo mistake undi something. Okay, but fine, let us do our calculations. Take 10% into 1 minus tax, and then we will get our KD. Tell the weighted average cost of capital. 16 వచ్చిందా, which means KD into weight of debt plus KE into weight of equity. First tell me what is KD. 10 into 0.7, which means 7%. How much is KE? Let us use that formula only, RF plus RM minus RF into beta. How much is risk-free rate of return? 6 plus market rate 14 market minus 6 into now tell me this KE. 16 KE is 16%. Next, let us find out weighted average cost of capital, which means 7% into what is the value of debt? 1000 divided by 3000. Plus 16% into 2000 divided by 3000. 16% into 2000 divided by 3000. Total 13%. Weighted average cost of capital is 13%. Okay, so step 3, let us find out. Step 3, EVA equals to adjusted NOPAT minus okay, so adjusted NOPAT 1370 minus 13% into 3150. Total 960 point. $960.5 is your economic value added in this question. The crores lakhs ఒకసారి క్వశ్చన్ చూడండి. Okay, 960.5 lakhs. Okay, so నీకేమైంది? Okay, so check this 7A question. They will either ask this economic value added or market value added or value added statement. We have already seen all the questions of value, economic value added in all the last attempts. We will also cover this value added statement also. Okay, fine. Just let us complete this part here also. Open page 140 in the concept book. Open page 140. Okay. So see this market value added. Meaning they have given of market value added. It indicates how much value a company has created or destroyed for its investors. Formula they will give market value added equals to, we already know this, market value of the company minus total capital invested. Company means what we have to take? Market value of equity, debt and preference share capital, everything we have to take. Minus I will take a total capital invested. Total capital invested means I will take initial equity, debt also, and even preference share capital also. If it is there, I will take that part also. Or preference share capital. Preference share capital. But one point we have to observe, while finding out market value added, don't deduct this non-trade investments. Okay, because if you remember valuation of share chapter, for the purpose of calculation of goodwill, I will exclude non-trade investments. But for the purpose of calculating value of share, I will include even non-trade investments also. Because shareholders are only concerned about their wealth. Whether it is trade investments or non-trade investments, that doesn't matter. But economic value added calculation, please exclude non-trade investments. Okay. But here, while finding out market value added, we should not deduct non-trade investments. This is the observation which you have to make. Here they have given some theory. Interpretation of MVA. If the result is positive, we know that shareholders have created wealth, which means what, it is favorable for the company. Indicates the market value, the company above the capital invested, which means if the capital invested is only 1000, if your market value is 1500, which means what, your company is having a positive value and it is favorable when compared to the market. Suggests a strong future performance expectations. Some theory points they have given. You can just go through these theory points. Okay. But now this concept is completed. Economic value added and market value added. Quickly come to value added statement. Value added statement. Just read this concept 35. Some theory they have given. Practical aspect will start from here, concept 37. But 35, just read once. Hello. ఏంట్రా డిస్టర్బెన్స్? Concept of value added. Okay, so let us check this. They will say that value added is a crucial measure of an enterprise's performance, reflecting the net wealth created during a specific period. See, here what they will say is, this value added statement is directly taken from your profit and loss account only. The main basis for this value added statement is your profit and loss account, which means first they will give either profit and loss account or trial balance of a company they will give. What you have to find out is this value added statement will be divided into two sections. First one is creation of value added, creation of value. And the second one is whatever the value which is created that should be distributed. So distribution of value is the second aspect which we have to focus. Creation of value means first we will understand how much wealth or value the company is generating. Sir, how we will find out how much wealth is the company generating? It is very simple. We have to take sales minus some expenses we have to do, which means what? If you remember P&L account, if you remember traditional P&L account, okay, if you check this, traditional P&L account, whatever the revenue from operations, you will take that. From this revenue from operations, you will also add this other income minus some expenses they will give. If you remember, first they will write cost of materials consumed, purchases of stock in trade, changes in inventories, all these stock related expenses they will give here. After that, what they will give? They will give some employee benefit expenses, finance cost, depreciation and amortization. At last, what they will give? Other expenses they will give. How this value added statement is viewing is, whatever the employee benefit expenses is there, that is nothing but you are distributing your wealth to your employees. Correct or not? You are paying employees your salary from the wealth which you have created. Which means what? Whatever the wealth you have created, that you are distributing to your employees. Similarly, if any finance cost is there, which means this is also a kind of distribution. This is also a kind of distribution for providers of finance. This can be either interest, or sometimes this can be either dividend also, whatever it is. If any person have provided you finance, whatever the cost which you are paying, that is also nothing but from the wealth whatever you have created, from that wealth you are making some distribution. So this is nothing but distribution to providers of finance. What you will do? From the wealth whatever you have created, only some amount of taxes you will pay to the government. Which means what? That is also from the wealth which you have created, but now the distribution is making to which persons? Distribution is making to government. Which means what? Whatever the wealth you have created, you will make distributions to which persons? Employees you will make, providers of finance you will make, next government you will make, and what about the balance? Balance will be retained by the entity. Retained by the entity means what? Ultimately it will be available for the shareholders. Correct? Simple. First, value will be created. Sir, how we will understand what is the value which is created? Very simple. Take revenue from operations plus other income minus some expenses. Not all expenses. Sir, why not all expenses I will do? Because I will show these items, whatever employee benefit expense, I will show this item as distribution to employees. Whatever finance cost is there, I will show this item as distribution to providers of finance. If I am paying any taxes, I will show that as distribution to government. And if I am retaining any profits, balance, if I am transferring to reserves, that will be retained by the entity, which means it is available for which persons? Shareholders. You have to understand one most important thing, which is nothing but depreciation and amortization expense. Understand why we will create this depreciation and amortization expense. For example, You have purchased one asset 10 lakh rupees. Useful life is 10 years. Now what you will do, every year you will charge depreciation of how much? 1 lakh rupees to your P&L account. Understand the intention. Which means what? After completion of 10 years, you have to replace your asset. Because the useful life is only 10 years. So what you are doing, whatever the profits you are getting, you are retaining 1 lakh rupees every year. And after completion of 10 years, you will add this 1 lakh into 10 and you will purchase new asset. Which means what? Depreciation is also one type of retention amount only. Therefore, always remember this depreciation I will not show as distribution to employees. I will not show this as distribution to providers of finance, nor I will not show this as distribution to government. Where I will show this is nothing but retained by the entity. If any amount is transferred to reserves, where I will show that is also retained by the entity only, or shareholders I have to present. Okay. First you have to find out what is the wealth which is created. Later that wealth should be distributed to how many parties? 4 parties we have to distribute. What is the first party? Employees we have to distribute. What is the second item? Providers of finance. Third item, government. Last one, retained by the entity. Okay, this you have to understand. This only you have to present in the form of statement. Okay, so we will solve one question, then you will get the clarity. So check this. Quickly come to this concept format of value added statement. That's theory we will come. We will check later that theory. But come to this format of value added statement. In last 5 attempts, they have asked EVA maximum times, which means high chance this time they are going to ask this value added statement, which means you have to definitely check this. Okay. So check first you have to find out what is the value which is created. Here how I will get this creation? First you have to take sales, including sales tax and excise duty, but net of rebate, commission, returns, discounts and goods for self-consumption, etc. All these things we have to take. Sales figure you will take, plus what we have to add, income from services, which means other incomes also you may get. For example, royalty, dividend, interest, these are incomes, not expenses. Okay, so I will take this also, and minus I will deduct the cost of bought in materials, which means what? Raw materials, consumables, packing, stationery, fuel and oil, electricity, repairs, all these items I have to deduct. And the cost of bought in services also. For example, audit fees. Understand, audit fees is not a contribution to your employees. It is not a contribution, it is not a distribution to your employees, it is not a distribution to your government, it is not a distribution to providers of finance also. You are not retaining that amount also. Therefore, it should be shown in a creation of value added, which means you will deduct that item and you will find out the value added. Okay. Next item is what? Advertisement, postage, telegram, subscriptions, other expenses. All these expenses you have to deduct, then you will get creation of value added. From that creation of value added, what I have to do? I will distribute the value. How? Which persons I have to distribute? Employees I have to distribute, government, providers of capital or finance, both are same. And last one, retained earnings. Retained earnings, what I have to write? Depreciation and retained profit. Which means, for example, current year you are earning a profit of 2000. Out of this 2000, 1000 rupees you are transferring to any reserves. That 1000 also will be included in your retained earnings only. Okay. One more thing you have to understand. If it is interest on bank OD or cash credit, if in the question they have given it as interest on bank OD or cash credit, don't treat this item as provider of finance, because these are short-term finances only. So what we have to do, short-term finances also please include in the calculation of added value created only. But if it is long-term contribution, I will write here to providers of capital. Okay. But if it is short-term interest on bank OD or cash credit, I will write here only. And one more item, if any tax is there, if any duties and taxes which is paid, I will write as a contribution to government. But if it is deferred tax expense, if it is deferred tax, always remember deferred tax means I will not make any payment in the current year. Deferred tax means what? In the future, either I may have to pay more taxes or either I will get more deductions. Because of this timing differences only, I will create deferred tax, which means what? From my current year profit only, I am keeping some amount aside for this deferred tax expense which will happen in the future. So what? This is also not a contribution to government. So what you have to do? This also I have to transfer to, this also I will include in retained earnings only. Okay. But see here, your added value created and disposal of value added, both should be same. Because whatever the value you have created, that you will only distribute to 4 persons. Either you have to distribute to employees or government or providers of capital, last one yourself. That's it. Ultimately it should match. Okay. That is the thing which you have to remember. Please write this point: interest on bank OD or cash credit. And last one, deferred tax expenses will be included in this retained profits, and the interest on bank OD or cash credit will be included in this value added creation format. Okay, we will solve one question, then you will understand. Once check this total format. All expenses, if they are not falling in this 4, we have to adjust in this calculation only. Okay, if any item is payable either to government or employees or providers of capital or retained, please show in distribution. Otherwise, you will adjust in creation of value added calculation only. Okay, this is P&L account format. If any balance sheet item is there, I will ignore that balance sheet item. Okay, while solving the question, you will understand more. So quickly open this first question. We will complete this value added statement also. Okay, so identify from this question which are balance sheet items. If it is balance sheet item, we will exclude. Other items, please check whether I will include in creation of value added or do I have to show in distribution. If it is distribution, you have to find out whether it is distribution to government or employees or cap providers of finance or whatever it is also. Please identify. Very easiest question. So please check this. If it is balance sheet item, I will exclude. If it is balance sheet item, I will exclude. If it is P&L account item, I will consider. Out of that also, whether it is value creation or whether it is value distribution, you have to find out. If it is distribution, again you have to do the bifurcation. Okay, easier question. This type of question only they will ask. Check for 1 minute and identify all those amounts. Easiest question only. Prepare a statement. See. Okay, so you have to tell me whether this turnover will be shown as distribution or it will be shown in creation. Creation. Plant and machinery, ignore. Ignore because it is balance sheet item. Loss on sale of machinery, is it balance sheet item or it is P&L account item only? P&L account item only loss. We will check this point. Okay. Depreciation on plant and machinery. Tell me, is it creation or distribution? If it is distribution, you have to tell me where, whether government or retained or providers, which means it will be retained distribution. Next one. Dividends to ordinary shareholders. This is also distribution to providers of finance or capital. This is also distribution. Next, debtors. Ignore. Creditors. Ignore. ఇదేం చేయాలి చెప్పండి. Total stock of all materials, work in progress and finished goods, opening stock, closing stock. P&L అకౌంట్లో ఓపెనింగ్ మైనస్ క్లోజింగ్ స్టాక్ చేయాలి కదా. చేయాలా? క్లోజింగ్ స్టాక్ బ్యాలెన్స్ షీట్ ఐటమే, కానీ ఫస్ట్ P&L అకౌంట్లో అడ్జస్ట్ చేయాలి కదా. ట్రేడింగ్ P&L అకౌంట్, ఓపెనింగ్ స్టాక్, పర్చేజెస్, సేల్స్, క్లోజింగ్ స్టాక్ ఇచ్చేయాలి కదా. బట్ దిస్ వీ విల్ నాట్ డూ లైక్ దిస్ ఇన్ కంపెనీ. This is the format which we have to follow. Correct? Revenue from operations, other incomes, cost of materials consumed. Here I have to take changes in inventories of finished goods. Okay? Read the question and tell me whether because of these stock adjustments, whether I am getting a profit or loss. Because of these stock adjustments, whether I am getting a profit or loss. Your opening stock is 320, closing stock is 400, which means what? Profit of 80. Profit of 80. Two options are there. Two options you can present. First option is what? You can add that 80 to your sales amount. And P&L account lo estam kada. Sales, closing stock, like this also we can write. Second option is what? You can reduce this 80 from your expenses. Expenses నుంచి reduce చేసిన, income యాడ్ చేసిన, you will get the same effect. Because in this vertical P&L account, what I will do is, I will write changes in inventory of finished goods, which means opening stock minus closing stock I will write here. If the difference is negative, I will write in negative amounts only, which means my expense will decrease. If my expense will decrease, my profit will increase. Anyways, you can present your wish. Okay. Next item. Raw materials purchased. Is it generation or creation? Sorry, is it distribution or creation? Creation. Next one, cash at bank. Ignore. Printing and stationery. Creation. Auditor remuneration. Creation. Retained profits, opening balance. Ignore. Balance sheet item. Opening balance we will ignore. Current year profit we have to take. Okay. So 1998 I will ignore. What about this 576? Retained profits for the current year. Is it creation or distribution? Distribution. Distribution to which person? Which means distribution to retained earnings. Very good. Rent rates and taxes. Creation. Rent rates and taxes. Creation. Other expenses. Creation. Ordinary share capital. Ignore. Ignore. Interest on borrowings. Interest on borrowings. Distribution to providers of finance or capital. Next item. Income tax for the year. Distribution to government. Last three items. Distribution to employees. Wages and salaries. అంటే we employees కోసమే ఇచ్చేది కాబట్టి we will transfer these items also to employees. Employees related distribution. Okay. So start writing in your notebook. Value added statement. Keep the heading. Value added statement. Value added statement of X Limited. X Limited for the year 23-24. For the year 23-24. Okay. First we will write generation of value added. First we will write generation of value added. Okay. In that generation of value added, whatever items we have classified as value added creation or generation, we will take one by one those items. First, we have written sales or turnover. So write that sales figure or turnover figure. In the question, they have given 4,600. 4,600. From this sales, we have to deduct purchases also we will deduct, and stock adjustments also we will do. We already understood that 320 minus 400. 80, you can deduct it from your expenses or you can add to your incomes. Both are fine. Here your institute have added to sales. You can deduct from expenses also. Anything you can do. Okay, so you can write plus stock, closing stock minus opening stock. Plus you can write closing stock minus opening stock. In brackets 400 minus 320. 400 minus 320, you will get 80. You will get 80. Check, is there any other income in the question? Other incomes we are not having. Okay, other incomes we are not having. So we can keep the heading expenses. We can keep the heading expenses. After those two items, keep the heading expenses and write raw materials purchased. Raw materials purchased 1250 negative, write in brackets 1250. Printing and stationery also will write in value creation part. Printing and stationery we will write there 44 negative. 44 negative. Audit fees also we will write 56 negative. ఆడిట్ ఫీజ్ లాస్ ఉంచుదాం, ఆ పాయింట్ డిస్కస్ చేయాలి. లాస్ వద్దు, లాస్ ఇక్కడ అడ్జస్ట్ చేయకూడదు, డిస్ట్రిబ్యూషన్లోనే అడ్జస్ట్ చేయాలి అది కూడా. సో ఇంకేమి ఇచ్చాడు, రెంట్ రేట్స్ అండ్ ట్యాక్సెస్, డివిడెండ్ ఈజ్ ఆల్సో డిస్ట్రిబ్యూషన్. Dividend is also distribution. Rent rates and taxes 330. Rent rates and taxes 330. Other expenses 170. Other expenses 170. Other expenses 170. Now take the total net figure, how much you are getting in the 1850 no? Why 2830 వచ్చింది? రెవెన్యూ మైనస్ ఎక్స్పెన్సెస్ టోటల్ చెప్తా, నువ్వే చేస్తావు. 2830 is your total value created or value added. That value added I will distribute to all other persons. First you will distribute to employees. Okay, so how much you are distributing to employees, please write that. Next keep the heading distribution of value added. After that value created, please keep the heading distribution of value added. Highlight that 2830 amount and you have to write value added or value created. Anything is fine. Value added or created. First we will make the distribution to employees. First we will make the distribution to employees. Wages, ESI, PF. Last three items please write there. Wages, ESI, PF. This is distribution to employees. Next item, distribution to providers of finance, you can write. Second distribution to providers of finance or capital. Distribution to providers of capital or finance. Okay, identify the amounts which I have to write as distribution to interest on borrowings. How much amount is there? 80, please write that. Interest on borrowings 80. And one more item, dividends they have given in the starting. Dividends to ordinary shareholders 292. That is also distribution. 292. Next to government. Next to government. To government, we have to write income tax. I think they have paid some 552. Distribution to government 552. 552. Okay. Last retained by the entity. Last retained by the entity. Retained by the entity. There we will write depreciation. Depreciation and retained profit for the year also we will transfer there. Depreciation and retained profit for the year also we will transfer there. 576 and depreciation 400. Both we have to transfer. Both we have to transfer. Now take the total of all distributions. Take the total of take the total of all distributions. All distributions if you take, how much? 2680. What is your total wealth you have created? 2830. Which means what? Some difference is getting. How much difference you are getting? 150. That is what? Loss on sale of a plant. That loss also should be ultimately borne by the entity only. Okay, which means you have to remember if it is related to PPE, whether it is related to depreciation, whether it is related to selling, if you are getting loss or profit, everything will be adjusted in the distribution to entity only. Okay, don't show this loss on sale of machinery in your wealth creation, because it should be ultimately borne by the shareholders only, because they have only sold their machine to get some loss. Therefore, that should be ultimately borne by shareholders. Okay, if you add, now your total disposal of value added will come to 2830. My wealth created and my wealth distributed both are same. Okay, once check this total question, because same question they have asked, I think in December 24. So that is the reason I have not given December 24 question once again. Same question, figures only they have changed. Every item they have kept the same only. December 24 they have asked. So once check this total question. We have completed this chapter, EVA, MVA and value added statement. 7 marks question from any one of those 3 topics. Very, very important. So you have to check this. Okay, you can check this. So we will not start internal reconstruction right now. We will start that internal reconstruction tomorrow, because that is also very important and compulsory 7 marks question they are asking. Okay, so what we will do is we will start that internal reconstruction in tomorrow's class. So that's it. We'll continue in next class. Please practice this. Easy 7 marks you are getting from this chapter. So definitely practice this.
Hi guys, welcome to BCCA. So this is Ravi Teja and I'm your faculty for corporate financial reporting at CMA final level. This is the most awaited video of Ind AS 113. most of the students are requesting me, sir, please make a video on this standard, which is Ind AS 113. It is about fair value measurement. Trust me, this is the easiest standard. Only spend 25 to 30 minutes. 25 also is more than enough. I can even complete that in less than 20 minutes also. Okay, but do this properly, solve the questions in our workbook. That too, you can even practice the super 75 questions also. I think some 1 or 2 questions I have given from this standard in days 113. I don't know why I am getting a feeling that our institute is going to test based on this standard. So without making any further delay, let us directly start with the standard. The name of the standard is Ind AS 113 fair value measurement. Sir, from the CFR starting onwards, we have been hearing the word fair value in number of standards. First, I have written, sir, wherever we have used the word fair value in multiple standards we have used, sir, whole indices love this word called fair value. So first, let me summarize this, sir, wherever we have used the fair value. Yes, sir. Index 105. Assets should be valued at FVLCTD. Index 109, sir, financial instruments chapter also we have heard this word number of times called fair value through P&L account, fair value through other comprehensive income. Sir, Ind AS 41 not there in our syllabus, but with respect to biological assets. Sir, Ind AS 16, Ind AS 103 also PPE at fair value and asset and liabilities at fair value. All these standards we will use fair value. Sir, how to find out the fair value? How to find out the fair value? Because fair value in all these standards they have given in the question. Sir, practically, you just have to find out this fair value. Sir, how to find out and all guidance has been given in this Ind AS 113. Sir, what are the assumptions? What are the inputs which I have to do in order to find out the fair value of any asset or any liability? That the related guidance is given in Ind AS 113. But remember, some items are excluded. Sir, Ind AS 102, share-based payments also, fair value, we will not calculate based on this standard. The reason being, Ind AS 102 is a very comprehensive standard. In that standard only, they have prescribed the complete accounting. If you remember, sir, fair value, for example, on each grant date, we have to take into number of employees expected to vest those shares and all. Some different kind of accounting and some different kind of formula is already given in Ind AS 102. So don't come to this standard. If nothing is said, come to this standard. If already it is explained in any other standard, how to do the accounting and all, so don't come here. Ind AS 116 leases also, comprehensive accounting. Already they will say, sir, how to do the fair value clearly. ROU asset and lease liability. Sir, that standard itself prescribes the calculation of lease liability. That standard itself prescribes, sir, how to do the valuation of ROU asset. So don't come to this standard. If in another standard, if accounting is clearly explained, Ind AS 113 says, oh, get out and follow that standard only. Aram say, simple. Sir, second point though, sir, what is the meaning of fair value? Fair value can be found out either for asset as well as for liability. Sir, for asset, what is the fair value? Guys, very simple. Sir, if I am having any asset, if I sell that asset right now, whatever the amount which I will be receiving, that is called as fair value. Sir, my intention may not be to sell, but while finding out the fair value, I will be finding out that price which I will get if I sell the asset. Reason is very simple. Sir, what is the meaning of fair value? Fair value is nothing but how much amount I am going to recover from the asset through its sale. So that is only your fair value of an asset, guys. Sir, for liability, what will be there? Liability means you have to pay some amount now. Asset means you will receive the cash. Sir, liability means I have to pay. So whatever the price which you have to pay to transfer a liability to some other party, that will be called as a fair value of liability. Simple point. Asset means price received to sell the asset. Sir, liability means price paid to transfer the liability. Is a point, sir, in an orderly transaction between market participants. Sir, orderly transaction means unrelated parties should be there. Sir, because if related parties are there, their price will be influenced. If related parties are there, sir, obviously the price will be influenced now. So the standard is saying, guys, don't take related parties. You have to take unrelated parties between market participants. Market participants is also talks about buyer and seller should be there. Buyer and seller should be there. Of course, their price should not be influenced with any relationship, which means they will clearly say that, sir, any transaction, if it is entered between unrelated third parties, in case of asset, whatever the price which you will be received if the asset is sold. In case of liability, whatever the price which you have to pay to transfer a liability, that is only simply will be called as fair value. I hope the point is clear. Yes, sir, the point is clear. Okay, yes, sir. The most important note you have to understand, sir, entity-based restrictions are ignored while calculating fair value. The point is simple. While finding out fair value, if any specific restriction is there with the entity, I will not include that restriction while calculating fair value. So the reason being, fair value will be calculated assuming that transaction will be undertaken between some market participants. Unrelated third persons, if they have entered, so what is the value that will be called as fair value. Therefore, entity based restrictions are ignored while calculating fair value. Sir, please give us an example. One entity is there. That entity is having some land. In the MOA of that entity, it have clearly written that, sir, I cannot use the land for commercial operations. I cannot use the land for commercial operations. This is the restriction for the entity. So later, if the entity sells the land to any other person, that buyer is not having any restriction to land the use for commercial purposes, which means, sir, restriction is there, but that restriction is available only to me, only to the entity. It will be called as entity-based restrictions. Sir, while calculating fair value, I will assume that the transaction will undertake between market participants who are unrelated. So those market participants to may not be having this entity-based restriction. Na? Therefore, this will be ignored while calculating the fair value. Important, most important point. Sir, second thing too, asset-based restrictions have to be considered. Sir, what is the meaning of asset-based restrictions? Guys, I have purchased, for example, one BMW car. I have purchased one BMW car. Sir, this car though cannot be used for transporting the cargo. For transporting the cargo, you need a Tata Ace. Correct. How can I use a BMW car for the transporting this cargo? That will not serve the purpose, na. That is asset-based restriction. So while calculating the fair value of BMW, don't consider Tata Ace related fair value because it is different. It is different. So this is asset-based restriction, na. So whatever the value which I will be getting, if I sell cargo based cars, that will not be included because it is asset or liability based restriction. Therefore, it have to be considered. BMW cannot do that. So I have to consider that restriction. I hope this point is pretty clear. Entity based restrictions will be ignored, but asset based restrictions should be considered. Sir, and one more thing, most important, straight away I will be going into the point. Sir, types of markets will be there. This standard assumes, sir, assets and liabilities are settled in market. Sir, which market? First preference to go for principal market. Sir, what is the meaning of principal market? Principal market is nothing but, sir, market where transactions with highest volume and highest level of activities will take place. Sir, what is the meaning of highest volume and highest level of activities take place? Understand. Sir, one for example, Reliance Limited shares are there. Sir, these shares are traded in NSE also as well as BSE also. Sir, assume in NSE 10 lakh shares are traded. Sir, in BSE 15 lakh trades are traded. Just example. Sir, in which market highest volume is there? BSE. BSE will become principal market. BSE will become principal market. Or, sir, I am trying to find out the fair value of the car. Sir, that car though, similar car ka model, assume 10,000 cars are sold in Mumbai. Sir, 8,000 cars are sold in Delhi. And another 10,000 cars, oh sorry, 9,000 cars are sold in, what should I say, Bangalore. Sir, 9,000, 8,000, 10,000. Sir, where highest volume is there in Mumbai, this will become my principal market. This is the first preference, which means, sir, if I decided to sell my asset in principal market, whatever the amount which I will be getting, that will become my fair value. Similarly, if I wanted to transfer my liability in principal market, whatever the amount which I have to pay, that will become my, what should I say, fair value. Simple as a point? Yes, sir. Understood. Sir, second point though, sir, if this is not available or it is unable to find out principal market. Sir, for example, Mumbai also 10,000 cars, Bangalore also 10,000 cars. So where I have to take? You have to take something which is called as most advantageous market. So this is second preference. First preference, so obviously you have to give to a principal market. Sir, if this is not available or if it is impossible to find out the principal market, then I have to go for what? Then I have to go for most advantageous market. The name itself is same. In case of asset, most advantageous market will be such market where you will get maximum cash flows. If it is a liability, MOM or most advantageous market will be that market where you will be having minimum cash flows. Liability means having minimum cash outflows is beneficial. Asset means having maximum cash inflows is beneficial. Answer is yes. Always remember, sir, how I will be getting the most advantageous market is based on net proceeds from sale after deducting expenses associated with such sale. Sir, simply speaking, if it is asset, at which market I am getting maximum cash flows, I will take that. If it is a liability, sir, where I will be paying minimum amount of cash outflows, I will be taking that as a most advantageous market. Sir, simple as a point. So this standard assumes two markets are there. Our assets and liabilities are settled in this market. Sir, what is the first market? Most advanced, sorry, principal market. Principal market money, market where highest volume of activities are traded and highest level of activities have taken place. Sir, if this is not available, I have to go for my second preference. Most advantageous market. So most advantageous market in case of asset is which market will be giving highest cash flows, cash inflows, that will become most advantageous market. So if it is with respect to liabilities, sir, what is the market which will be giving minimum cash outflow? That's it. That's it. Sir, how I will be getting minimum cash flows or maximum cash flows? Very simple. Just to find out the net sale proceeds after deducting any expenses. That's it. Easy as a point. Important discussion, super important discussion from exam point of view is this transaction cost and transportation cost. Understand, guys. First of all, sir, what is the meaning of this transportation cost? Transportation cost means, sir, this presumption of this Ind AS 113 is assets and liabilities are settled in which market? Principal market or most advantageous market. For example, sir, I am having a car. Sir, I am having a car and I have found out, sir, that the car fair value is 10 lakh rupees on principal market. If I sell the car, I will be getting 10 lakh rupees in principal market. Sir, but the thing is, entity is located in Bangalore. Sir, entity is located in Bangalore. Sir, but principal market is located in Mumbai. Sir, first of all, I have to transport my asset from Bangalore to Mumbai. I will be incurring some transportation cost, na? Sir, because, sir, why I will take my asset to Mumbai and sell? Guys, selling is not your intention. But to find out the fair value of an asset, standard is assuming that you will be settling the transaction in principal market, na? Which means, first of all, I have to transport that asset from my location to principal market. So whatever the transportation cost which you have incurred, that will be adjusted in the fair value of an asset. This is the point which you have to remember. Sir, not only principal market, even most advantageous market also. Most advantageous market also assumes the same thing. Sir, that asset should be transferred from the entity to the most advantageous market to get settled. So that transportation cost will be always adjusted in the fair value of an asset. Sir, why? Another thing is, guys, location will change the value of an asset. For example, car value in Delhi will have different value, in Mumbai will have different value. Sir, in Bangalore will have different value. Sir, is it possible? 100% yes, na. Practically that will be there. Sir, it is an inherent part of the asset. We cannot change that. But sir, if you observe transaction cost, Transaction cost will be taken for the transaction. It is not for the asset. For example, if you purchase shares through stock exchange, you will be incurring some transaction cost. Guys, that transaction cost is uh, entered because of the involvement of the broker. Because of the involvement of such purchase and sale, it is related to the transaction, not with the asset. So remember this point, guys. This is entity specific restriction. So whether the transaction cost is there or not, it will not change the value of an asset. But transportation cost, though, it will change the value of an asset. So simple thing, transportation cost will be included in fair value, but transaction cost will not be included in fair value. I hope this point is pretty clear for you. Treatment also I have given here very clearly. Sir, in principal market transaction cost will be excluded, which means I will not consider, but transportation cost though will be included in principal market while considering fair value. Sir, but most advantageous market may, sir, if I am finding out value of an asset, what I will be assuming is, sir, what is the market which will be giving me maximum amount of cash flows now? While calculating that maximum amount of cash flows, I have to even adjust for this transaction cost also. Question is there, while solving that question, you will understand whatever I am trying to say. Sir, most advantageous market finding out that I have to consider this transaction cost also. But once after finding out that most advantageous market, again, transaction cost will be ignored while calculating fair value. Sir, whatever you are saying, please tell us with some example. Now, guys, one question is there that will be understood, but the crux, transportation cost will be included in calculating the fair value. Transaction cost will be ignored while calculating the fair value. One question is there, guys. Let me show that question. Yes, sir. So let us solve this question number one. Important question. An asset is sold in two different active markets at different prices. An entity enters into transactions in both the markets and can access the price in those markets for the asset at the measurement date. In market A, the price that would be received is 26. So transaction cost to 3 and cost to transport or 2. Understand? In market number B, the price that would be received is 25. So transaction cost is 1 and cost to transport is market 2 rupees. Sir, if A is the principal market, guys, they are saying A is the principal market. Therefore, sir, it is very simple. Sir, in A, I will be receiving 26 rupees minus, sir, this transaction cost have to be ignored now. Sir, but cost to transport, I will consider. Yes, sir, I will consider, sir. 24 is nothing but fair value if market A is the principal market. I hope you are understanding the things. Yes, sir. Sir, if none of the markets is principal market, I have to find out most advantageous market. Sir, out of market A and market B, what will become my most advantageous market? Very simple, where you are getting maximum amount of cash flows because this is an asset. Maximum amount of cash inflows if you are getting in market A, that will become your most advantageous market. If you are getting in market B, that will become your most advantageous market. Sir, simple a point. Sir, in market A, what is the cash flows which I am getting? Sir, 26 minus this time less transaction cost also. Okay, sir. 3 is the transaction cost minus 2 the transportation cost. So 26 minus 3, 23 minus 2, 21 is my cash flows for market A. So market B, if you observe now, so 25 minus 1 minus 2, 25 minus 1, 24, 22. Sir, which is most advantageous market? Sir, from A I am getting 21, but from B I am getting 22. So most advantageous is market B. Now you find out market B is most advantageous market. While finding out the fair value, I will only exclude transportation cost. Therefore, 23 will become fair value if I chosen most advantageous market. I hope the point is clear. Once again, watch the video if you are having any doubt, guys. Simple discussion going on. Sir, while finding out most advantageous market, consider transaction cost also in most advantageous market. But sir, once again, but sir, after selecting the market, transaction cost would be ignored while calculating the fair value. This is super important point. You just have to understand this point. So next thing though, fair valuation of non-financial asset, not that much important from exam point of view, but let us understand quickly. Sir, non-financial assets means, sir, either plant and machinery, land and buildings, intangibles, investment properties, all these items. Understand, sir, here I have to find out highest and best value. Highest and best value I have to take. Sir, one land is there. Sir, this land though, it can be used for commercial purpose, it can be used for residential purpose, or it can be used for business purpose, or it can be used for office, what should I say, office establishment also. While finding out the fair value of the land, I have to take all the benefits, whichever is maximum, highest and best value I have to take as a reference point. Of course, not from entity point of view, but from market participants point of view. That's what I'm saying. Sir, entity-based restrictions will not be considered, sir, but what will be considered? Asset-based restrictions will be considered. Asset-based restrictions will be considered. Okay, sir, understood the point. And one more thing, you just have to stick. Standard uses the word, sir, physically possible, financially feasible, legally permissible. Once again, physically possible, financially feasible, legally permissible. These restrictions only will be considered. That highest and best value is there, na? Sir, that highest and best value, in order to take that point, it should be feasible for the asset physically. It should be financially feasible, and legal restrictions also should not be there. For example, if the land is having any restriction to use for commercial rights, land itself is having the restriction. This will not be considered, because it should be legally permissible also. Then only we have to take this part. Otherwise, we have to ignore this. I hope the point is clear. Yes, sir. The point is clear. Now, the next part. Okay. Yes, sir. The question. Aram to check that question, guys. Similar question is also there. One more question. That question you just have to practice. Sir, what is that one more question? That question is question number 6. Same to same copy paste question. Numbers have changed. High chances this question is going to come in your exam. Even if you can check this or that, any one question is totally fine. The rest of the question is aram say copy paste. Okay, so this question I am getting a feeling that this question may be tested. So don't take risk, check this part. Okay, now the next part, guys. Next thing, sir, this Ind AS 113 suggests some criteria, sir, as to how exactly you have to find out the fair value. Very simple. Sir, if the instrument is a listed company share, for example, if it is quoted instrument, sir, I can directly get the fair value now. From the exchanges, I can directly get the fair value. Correct. Sir, if it is market-based approach, what I will be doing is I will be directly taking the quoted instrument ka price of identical or similar assets. This is the best approach, and obviously the first approach we have to give our importance to. Sir, if this is not possible, sir, what I have to do is I have to find out something which is called as cost approach. Sir, listed company ka shares, I mean, every share will not be listed, sir. So how to find out the value of unlisted share? That they will be given. What I will be saying is that there will not be an active market for all the assets. Sir, if any asset is highly specialized, there will not be any, what should I say, quoted price for that asset. So I may have to use something which is called as replacement cost of such asset, and that will become its fair value. Replacement cost means that if I right now replace this asset and if I purchase something new, whatever the price which I have to pay, that will become my fair value as per this cost approach. Sir, one more thing is also there, which is nothing but income approach. Sir, here I have to calculate something which is called as present value of future cash flows associated with that asset or liability. That's it, guys. 3 approaches depending on the information which is given in the question. We have to find out. Practically, we have to check. Sir, if it is listed, directly take the quoted price. If it is not listed, I have to check the information. Sir, whether they have given some cost related data, I have to find out replacement cost. Sir, if it is income approach, very simple. In your SPMBB or in your SFM, I think there is something which is called as corporate valuation ka chapter. Business valuation. There we have to do present value of future cash flows associated with that asset or liability. That's it. Sir, one more thing what the standard will be suggesting is, sir, fair value hierarchy. You have to select such method which maximizes level 1 ka inputs and minimizes the level 3 inputs. If possible, forget about this level 3. You have to find out the fair value only based on level 1 ka inputs only, guys. Sir, what is the meaning of level 1 ka input? Level 1 ka input means quoted market price of identical assets. Sir, these are directly observable, no adjustments. For example, sir, if Reliance Industry Limited is trading in exchange, that trading price will be called as quoted market price. That itself will be called as fair value. Sir, level 2 input means this is also directly observable, but some adjustments needs to be done. Sir, assume Tata company is there. Sir, this Tata is not directly trading in the stock exchange, but its competitor is there, which is Bata. These are not competitors. Only for example, I am saying this rhyming so that I have used the word Tata Bata. Okay, Tata companies assume its competitor is there. So its competitor is listed. It is having some debt equity ratio. Sir, that company ka revenue is more, our revenue is less. Sir, that company ka profit is more, our company ka profit is less. Which means direct asset ka quoted market price is not available, but similar asset is available. I have to make few adjustments. Sir, if this is also not possible, I have to go for level 3 inputs. Level 3 inputs means these are not observable. You just have to make some assumptions and internal estimates. Based on this, I have to make some forecasts, which means this present value of future cash flows I have to do. So this cost approach also will become level 2 input only, guys. Because here also I have to make a few adjustments because that is also not for the direct asset now. That is also not for the direct asset. That is replacement cost of an asset or liability, which you have to check. I hope this point is pretty clear. And one more thing, that's what I'm saying. Sir, fair value of liabilities and entities own equity instruments also, sir. How I have to calculate simple maximize level 1 and minimize level 3 inputs. And one more thing, sir, if the asset or liability is transferred to a market participant, how I have to settle my liability and own equity instruments? I have to find out the fair value like that. Guys, that's it. Concept is completed. If you want to understand, I recommend you to watch the video once again and solve the questions properly. I will be explaining the questions also right now, but our concept is completed. I have already solved one question also, guys, already. Okay, so that's why 27 minutes it have taken, but concept is already completed. Now, balance questions also I will be covering even in this video only. Okay, I hope this point is pretty clear. Concept is done. This standard is a little bit dry standard, but the thing is I have directly given the points. Directly given the points are on how to find out the fair value. If we solve a few questions, we will be getting a proper comfort on that. Okay? So without making any further delay, let us directly solve some another questions also, guys. Sir, which questions? Check this question. Check this question. Sir, here what they will be given is highest and best use related they have given. Highest and the best use related they have given. So I recommend you to read this question once, guys. This type of questions chances are little less, but who knows, they may give one MCQ on this point. So don't miss. Highest and best possible use means asset based restrictions will be considered. Entity based restrictions will not be considered. Based on that, please take this question, guys. Question number 2. You have to go through this question number 2. Okay. Next, one more question which I wanted to solve is this question I wanted to solve, guys. So this is fair valuation ka question. Fair value of share they are asking. So let us check this. You are a senior consultant of your firm and are in the process of determining the valuation of KK Limited. You have determined the valuation of the company by two approaches, market approach and income approach, and selected the highest as the final value. However, based upon the discussions, you have been requested to assign equal weights to both the approaches. What you have said is, sir, whatever the highest is there, that I have taken and that it will become my fair value. That is what your answer is saying. But your management have said, don't do stupid things. Whatever market approach, whatever income approach, just to give equal weights. Just to give equal weights now, and then find out the fair value of KK Limited. Details they have given. Sir, value of this 5268.2, value as per income approach, which means present value of future cash flows. 3235.2. Sir, what they are saying, equal weights. Sir, equal weights means into 50%. Just to do into 50%, guys. Take your calculator, this into this, this into this. 50%, 50%. You will be getting this figure. 4251.74 will become equity valuation. Sir, but this is a total valuation of an entity. This is, sir, total valuation of an entity. Sir, this debt obligation is there now. This debt I have to deduct. Debt I have to deduct now. Yes, sir, sir. Surplus cash and cash equivalent will become my asset. Fair value of surplus assets also. I will be adding surplus 312.4 plus 106.4 minus 1465.9. That's it. Easy something, guys. Guys, this is easy something now. Sir, enterprise value will be the balancing figure. Sir, these are the number of shares. Sir, this is 8.52 crore. 8.52 crore. If I deduct, I will be getting value per share, which is nothing but 375.72. Most important question. Even if you don't know this standard, na, still aram se we can solve this question. That much easier it is, guys. Everything is given in the question only. Just take the weights. Debt I have to deduct because it is enterprise equity ka share valuation we are finding out. This is total value. Total company value. Company means including debt. So I will deduct the debt plus surplus assets, fair value of assets, cash. Divide by number of shares. I will be getting equity share ka value. That's it. Easy some point. Nothing big in this question. Correct. Yes, guys. Another interesting question. I think this similar question is there in your SPMB. There is another easy question. Sir, entity A is having 250 shares of XYZ Limited, which is an unquoted company, which means unlisted company. Company XYZ has a total share capital of 5,000 shares with a nominal value of rupees 10. Entity XYZ's after tax maintainable profits are 70,000 and appropriate price earnings ratio for the published industry data. So this is not entity XYZ. This is industry data. So it is how much? 15 before lack of marketability adjustment. Entity A manages, estimates the discount for the lack of marketability for XYZ shares and restrictions is 20%. XYZ limited shares cannot be traded that much. I mean, it cannot be traded. Those are not liquid shares, which means those cannot be easily traded like half the market will be traded. Therefore, this 20% I have to adjust. Entity A values its holding based on earnings. Guys, just check earnings data. Sir, earnings is 70,000 into this 15. If I do, sir, 70,000 into 15, if I do, sir, I will be getting 10,50,000. Sir, but this is before marketability adjustment. Sir, minus 20% if I do, sir, I will be getting 8,40,000. Sir, but this is for how many shares? Sir, 5,000 shares. 8,40,000 by 5,000. If I do, I will be getting 168 per share. Sir, into 250. If I do, I will be getting investment value, which is nothing but 42,000. Simple sa question. Just check the solution, guys. So this is the pre-ratio of the market. If I do this and adjust the discount factor, which means you can write directly into 0.8 or minus 20%. Anything is fine, guys. So 8,40,000 I have got divided by 5,000. This is not plus, this is divided by 5,000. Then I will be getting 168. So next rest of the question to aram se normal sa point. Sir, one more thing they have given. Assume that ND estimates it's using net asset valuation technique. They have given net assets, which is 8,50,000. So total number of shares is 5,000. So 8,50,000 here they have given, guys. 8,50,000 divided by 5,000 into 250 shares are held by entity A. Therefore, 42,500 is the answer. I hope this point is pretty clear. If yes, we will move with one more question. So which question is there? So another last question. This question is question number 3. With this, we will complete this chapter. Okay. Okay. One last question, guys. Question number 3. Some story they have given. I will not read that story. They are asking me to find out. I think they have given some draw decommissioning liability related cost, and the time period is 10 years. This is what they are giving. They are asking us to find out the fair value of this decommissioning liability. Simple sa point. So labor cost they have given. In order to do the decommissioning, I will be incurring certain labor cost and they have given some probability. Trust me, even if you don't know anything, if they have given some cash flows and probability, every student with a common sense will multiply these figures. Will multiply this, will multiply this, will multiply this, and they will add. That is my estimated labor cost. Like that only we will be doing. Sir, 100 into 20, wait, 100 into 25% plus 125 into 50% plus 175 into 25% plus if I do, I will be getting 131.25 is my labor cost. Plus, sir, assigned overheads to 80% of the labor cost. Sir, into 80%, let me do. I will be getting 105. 105 I will be getting, yes, sir. Sir, profit markup, next point they have given, sir, some profit is there on labor and overhead cost, which is 20%. Sir, on this total, 131.25 plus 105, I have to take 20% का markup value also, which will give me 283.5. Okay? Yes, sir, 283.5. Sir, they are saying the risk that the actual cash outflows might differ from the expected, excluding the inflation. Before considering the inflation, sir, what they are saying is, sir, these are my estimated cash flows, but it may increase by further 5%. It may increase by further 5%. Sir, here they have calculated this differently, but I can rather calculate that 283.5 plus 5%. Sir, 283.5 plus 5% if I do, I will be getting a 297.675. 297.675. Yes, sir. Sir, they are saying, sir, this is before considering inflation. Sir, inflation is also there. They are saying a rate of inflation of 4% over the 10-year period based on available market data. Inflation if they have given. Sir, our terms are real terms. Sir, every year 4%, 4%, 4% inflation will be there. So this amount will be incurred after 10 years. Therefore, sir, 1.04 whole power 10 if I calculate. 1.04 whole power 10 if I calculate, I will be getting this 1.4802. I have to multiply that 1.4802 with this figure. Then I will be getting approximately 440.62. It is approximately fine. Correct. Simple as a point, guys. I hope you are getting, I hope you are following the things. 5% they are saying, sir, here and there premium adjustments will be there because my expenses may be wrong, and 4% inflation is also there. Expense will be incurred after 10 years because inflation point is there. Sir, they have not given, what should I say? Sir, they have not given discounting factor. They have given information related to here. Sir, see, risk-free rate is 5%. Entity specific risk is 3.5%. आराम से 5% plus 3.5% if I do, I will be getting 8.5%, and this 8.5% will be my, what should I say, discounting rate. That's it. So 1 by 1.085 take for 10 years. This is 1.085 whole power 10, guys. You have to do the present value calculation and you will be getting 194.97. Guys, I know that I have gone a little bit faster, but the thing is, just watch the video once or twice and you have to solve these questions on your own, guys. I have explained the concept. So questions are answer you have to try on your own. Okay? So guys, this concept is already completed in less than 20 minutes only. But the thing is, since I have decided to take the questions here, it may extend it to 38 minutes. But trust me, this is the only time where you have to do this chapter at this much. So if I am a smart student, what I will be doing is I will be solving this question aram se, and this question I will check once. This question I will check once. The day before exam also I will check. KK limited ka question. That's it. In days 113 is sorted. So smart student, 20 minutes, 3 questions, 7 marks in his pocket. I know this may be unsure. We can't predict this time, but if this chapter comes, easily you have to grab the marks. Guys, I hope this point is pretty clear. Yes, sir, we have completed in days 113, guys. If you check this past paper analysis once again, if you observe, my suggestion is, if I were a student, what I will be doing is I will be definitely attempting these 2 questions 5 and 6, no doubt about this. But considering the average student, what I am suggesting is any one question you have to write out of 5 and 6. Any one question I have to write, you have to write out of 5 and 6. So 5 or 6 I will cover. The best part is both the chapters I have released detailed marathons. Very detailed marathons are there. Separate videos are there for business combination separate, CFS separate. Business combination video, I think it is around some 6 hours or something. Consolidation also, it is also something around 6 hours. I think business combination is 5 hours, I guess. I do not remember exactly. 5 hours. In those 5 hours or 6 hours, entire concept is explained along with all the questions in our material. All the questions in our workbook I have covered. So if you really want to attempt any one of these questions, I definitely suggest you to watch those things. Both the chapters, consolidation as well as 103. And one more thing also I have did. I have recorded 25 minutes summary of business combination also, 25 minutes summary of consolidation also. Day before exam, it is not possible for you to watch the total video. So what I have did, if you practice it once or twice, you can watch this 25 minutes marathon and one question from each model. Reverse acquisition, one question. Step up acquisition, one question. Demerger, one question. One more model, one question. That's it. 4 questions plus this 25 minutes video. Day before exam, it is sorted. Any one question. If you are very good, you can solve both the questions. Then also easily you can get. If you are aiming for 70 plus, at least one question definitely you have to write. Otherwise, it is highly impossible to get 70 plus in this subject. Okay, fine. One question I can attempt from these 2 questions. Second question, what I will be doing is 4A, 4B question is very much expected. 4A, 4B less riskier because always they are asking financial instruments. Even if NBFC is asked, that is also very simple. Correct? So 4B always they are asking internal reconstruction only, which means less riskier. So the second question which I will not be missing is 4A, 4B I will not be missing. 4A or 4B I will not be missing. And one more best part is I have recorded in detail marathons are also available in YouTube. Anyway, this marathon is also uploaded, but the thing is 4A or 4B financial instruments also I have explained 25 minutes summary. And one more thing, morning only I have said 2 additional questions I have solved at the end of the marathon. Definitely we have to solve those 25 questions. 2 additional questions. I think it is 40 minutes. Because of these 2 questions, extra 15 minutes I have used it. Additional questions, definitely we have watched that internal financial instruments. Okay. Other chapters also, if time is there, definitely I will uploading that short marathons. So 4A, 4B also easier questions which I will not be missing. If you want to solve detailed questions of internal reconstruction also, concept is fine, whatever we have understood, that is totally fine, but definitely you have to solve questions. Okay, since this is EVO, all the questions are not, it is not possible for me to solve. Okay, fine. One more question what I will be solving is 2A, 2B I will be solving. 2A, 2B also I will be solving because less riskier, but more standards I have to cover. 2A, 2B. 2A, 2B, my prediction is, I think they should ask in days 36, highly important. 115 also. Leases, they have asked in MTP, that's why it is important. Share-based payments, they have asked too many years back. So this also they may ask. These 4 chapters you have to be perfect. Don't waste more amount of time because this 116 they may ask it in MTP, but this 102 too many years back they have asked it. So don't spend hours and hours of time in this chapter. Okay, at least super 75 questions quickly you have to solve and you have to leave that chapter. Don't spend too much amount of time in this 102, but at least you have to see definitely. And one more chapter, 108. 5 minutes is required to complete 108. That's it. 3% you have to remember. Result criteria, revenue criteria, that thing you have to check. 5 minutes is more than sufficient for that 108 standard. And one more thing, 21. Only one question we have to check. 21, only one question we have to check. That yesterday only I have explained the foreign currency transaction, only one question we have to check. That's it. If I properly prepare this 2A, 2B, high chances 2 questions have to come from this. 2 questions have to come from this. These standards definitely we have to cover in depth. Definitely we have to cover in depth. Some students may ask, sir, what if any new question comes? If any new question comes, that should be definitely coming from Super 75 only. From Super 75 only, those questions are going to come. If you are leaving any standard, don't leave that standard completely, at least by heart some questions. Whatever those Super 75 questions which are there, they will not even change numbers also. They will double or half. That's it. You can by heart those questions, at least new questions, but don't leave any standard completely. Okay, that is I am suggesting. So this question you can write easily, you can write. And one more question what you can attempt is, if you are good at theory, attempt this 8th question. If you are good at theory, you have to attempt question number 8. Question number 8, 8B, 8C. 8C, some interlinking with business combination or CFS. Whatever 8C they can ask, already I have covered in business combination chapter or CFS chapter. If you already prepare for those marathon, for 8C, you need to prepare once again. Okay, 8C will be sorted in those two chapters itself. So 8A, 8B, 8C, if you are good at theory. Theory also already uploaded in YouTube. What I will be doing is after the end of this class, I will be sharing all the links in the WhatsApp group. So you have to check that. Theory is also uploaded. I think it is some 3 hours content, 3 to 4 hours is there. All the theory, all the questions I have explained, along with shortcuts also. Okay, exact copy paste from institute study material. If you want good marks in theory, you should be at least able to write 70% of the content as it is. 100% it is not possible, but if you are writing that theory in your own words, that is fine, but you cannot write your own theory. Okay, whatever is there you can write in your own words, but you cannot write your own theory. 8 is also fine if you are good at theory. If you are not good at theory, I won't study this theory. I'm not good at this theory, so what I will be doing is I will be skipping this and I will be writing 7A, 7B. 7A, 7B I have to write. 7A, 7B, one part is practical. They are going to ask about EVA or MVA. One part is totally theory. Very big chapter, 7th chapter. Very big chapter, huge chapter. 50 concepts are there in that standard. 50 concepts are there. So I will not skip this 8th question, I will skip this 7th question. Because here theory is limited. 8A, 8B. Government accounting is there. Some 10 marks of theory directly you will get. Plus MCQs also they are asking from government accounting chapter. Okay. So I will write this 8A, 8B. I will skip this 7A or 7B. One more question I will skip. 1, 2, 3, 4. One more question what I will be skipping is this one. Third question. Sir, why you are skipping this third question is, especially if you observe this share valuation topic, your institute will not follow any consistency. Especially one item is there which is preference share capital. Sometimes they will deduct this item, sometimes they will not deduct. Sometimes they will deduct preference dividend, sometimes they will not deduct preference dividend. Morning I have explained preference dividend and debentures both are same and both should be treated as financial liability. Correct? Normally this should be the treatment, but your institute is not following any consistency on this chapter. So even if you prepare well, in the suggested answers, if they miss your point, they will strike off that answer. Ruthlessly they will strike off. They will not even give you single mark also. So that is the reason I will take this 3B question as choice. Third question I will take as choice. Okay. Already my 6 questions are completed. 1, 2, 3, 4, 5. Here I have written 2 questions. Okay. So already my 6 questions are completed. If you are not that much perfect, you can leave any one question. You can leave any one question, still your 5 questions are sorted. Sir, I cannot even attempt 5 questions also. Then take one more question as choice. Then take one more question as choice. At least 4 you have to write. Don't take further choice. Okay, at least 4 you have to prepare properly. And see, 4 questions are there. 4 into 14, how much? Tell me. 56. With our preparation, easily we can get minimum 45 marks from these areas. 56. We will expect 56. We will write whatever we know we will write, and there are high chances that we will be getting only 45, but MCQs are there. MCQs also, trust me, out of 15 MCQs, 10 to 12 MCQs, even if you don't want the correct answer, you will still get the correct answer. That much easily they can ask. Provided you have to go through this concept book. See, how many pages it is there? I think it is less than 150 pages. Exactly 150 pages concept book is there. Okay, if you look at other materials, FR, I only have studied some 1500 pages of material. FR, 1500 pages of material I have studied. Okay, it is not at all possible for me to cover all those things in the day before exam. Okay, so that much you don't have to do at all. Whatever the chapter which is there, at least try to cover from the concept book directly. You can easily understand. This is not a difficult language or typical language I have used it, very basic language I have used it. Every person can understand this concept book. Okay, so MCQs also, if you are perfect in those, easily you can attempt 12 MCQs minimum you can attempt. 56 plus 24, how much? Worst case I am saying 78, 88, 80, okay. 80 is, oh sorry. Okay, 45 plus 24, how much? 69, sorry, 70 approx. 65 వేసుకుందాం. 65 you may get, but here we have attempted only 4 questions. That too I have assumed the worst possibility. Correct? If you prepared well, you may get 50, you may get 55. But don't do only selective, which means if you study only 4 questions without studying MCQs, without going, if you are expecting 56, you will get some 35 or 36 or 37. Okay, revaluation also they will not give you marks. 1 mark also they will not increase. Okay, so MCQs also separate video is there. I will be sharing all those links. So what is my responsibility after completion of this EO batches? I will be releasing a separate video only for one question, which is this EVA or MBA. This is already there, but I want to record one more time and I will give you the best video for this economic value added or market value added. But other than this, everything is already uploaded. If you want to watch, if you want to solve any question in depth, you have to refer to the marathons. At least super 75 questions you have to cover. Even if you are leaving any chapter or any standard, I recommend you to go through at least those super 75 questions. Because last attempt is the proof. Last attempt, I have only said that questions are going to come from 16, 36, 116, some 3-4 standards I have said. One question also they have not asked from those standards. But I have given super 50 questions. Other questions they have covered from the super 50 only. Last attempt, all the 3 questions are new questions only. They have asked from 21, 12, and one more question they have asked. 108 they have asked. Everything only one question is there in our that super 50 questions also. So if you are skipping any chapter, at least you have to cover those super 50 questions. If you are not understanding, by heart. Even if you by heart, it will work. Only those super 75 questions. Okay, that too not all. All business combinations and all you cannot by heart. Okay, so that's it. So we will complete our EVO batch. So that's it. Thank you so much. I will just stay tuned to YouTube. I will release 20-minute summary or 25-minute summary for all other chapters also. Okay, 4 days అవసరం లేదు, సరిపోతుంది. CFS అనేది ఏంటంటే ఇంకా నేను షార్ట్ కట్లో చెప్పిన క్రక్స్ మిస్ అయిపోతుంది. Okay, so we will conclude EVO batch. So that's it. Stay tuned to YouTube. Okay, that's it.